So welcome to our very small trading course. It's from 2022, 2023. It's over 6 hours long. Luckily, there's chapters below for you to kind of get a grasp of it, and you can always come back. Please do subscribe if you want more educational content and also real life analysis by Gaz. However, if you got some value, leave a thanks. It will make a big difference. Obviously, leave a like and share to your friends. As I say, this is a lot of content. This will basically teach you everything you need to know for technical analysis, how to trade, and also become a better investor. So before we start, let's get into trading risks. Most people want to do this very, very quickly. Most people want to get involved in trading straight away, but there's some massive risks that you need to understand. Myself and Gaz are going to help you out as much as we can, giving you some information before you start diving in. Disclaimer, very obvious, right? We are not financial advisors. This content is for educational purposes only, right? However, any methods mentioned within this online course are to be tested without real live funds, i.e. paper trading or just a simulation trading, however you want to know it as, right? Don't be just throwing loads of money at certain things in unproven methods that may not work with your trading style, the asset that you're on, until you got a good bit of education behind you. Cryptocurrencies and stock market trading is very risky. You could lose all your capital by doing the wrong thing. Too much leverage, too much risk, whatever it may be. You may not understand what you're doing. You are only responsible, you as an individual, for your own actions. Whatever platform you use, the leverage that you use, the asset that you're trading, the risk that you put on, it's down to you to be aware of that. So make sure you understand. So technical analysis, what is it and why is it important? Well, we're going to get into it in this little section because I think it's good to have a fundamental base of why it's important and understanding some of the terminology as well. But most important thing is people often pay lip service to it at the start in terms of how to do it and what it actually means. We're going to come through a lot of phrases that I will be repeating a lot. And the most of the new people in the space will want to go, right, let's go. Whether you're investing in the stock market, whether you're investing in crypto, or even into the foreign exchange market, right? Everyone wants to trade. Everyone wants to get into it without understanding how technical analysis works as a basis, and also how to build a strategy, which is what you're going to learn throughout this whole entire course. So the obvious, what is it? It's a discipline to evaluate investments and to identify trading opportunities via data such as price movement and volume. We will get into it in more detail in terms of how to set it all up and how to look at it at an obvious standpoint, but it is literally to evaluate. Remember that word. Tools are used to interpret data easier in a form of an indicator that could affect changes in price and momentum of an asset. Why? People will be looking at said indicator, said price movement, said element on the screen, and that is when emotion will kick in. Why prices move. When things go mad, it's often because something's triggered. Then all the influencers and all the people and the analysts on Bloomberg, etc. will start talking about said thing, that it's done something for the first time in so long. And that creates even more price going up. To interpret the data, you've got to see the data as well. That's why it's important. If you're often late to the party and you're seeing it on the news, well, it's already gone essentially, right? This was obviously first introduced in the late 1800s by Charles Dow, known as the Dow theory. There's many different theories. There's many different things that have changed over the course of this period. However, as we're getting more into the technology age, the world has changed in terms of technical analysis and putting on stock bids and stuff like that. It used to be through the phone. It used to be in the newspaper. You used to get the data on the newspaper, and then people would call up to buy stocks on a phone line to like Wall Street and stuff. It was mad. It's changed massively. It's all at our fingertips right now. We can, if done right, build an empire through your smartphone, through technical analysis, through investing in stocks in crypto and stuff like that, without having to worry about real big deep knowledge, because it's all learnable. It's all, practice makes perfect, right? And this is one thing that's a huge important thing about why technical analysis is, in my opinion, often overlooked when you're looking at, your research element of any asset. Over the decades, there's been many different patterns and signals developed. We will talk about those, the different types of theories out there, in terms of how to read data. But these are often used as an edge. It's technically called an edge for investors to, pick stocks, or traders to find opportunities in the short term. It's important that you remember that. Technical analysis is a tool that should be used for probability instead of certainty. I'm going to be using that phrase a lot. It's probability. It's putting the odds in your favour, right? It's a bit of a psychological kind of nightmare for a lot of people, but new people in the space will find an indicator, will see it being talked about as a real good influence from an influencer, that, oh, look at this, it's going to happen, as certainty. Then you start over risking and start putting money on the line when realistically you haven't understood the element of the indicator. Sometimes it goes wrong. Quite a lot of time it does go wrong. If everyone's gunning for the same way, yeah, you can see the picture. And technical analysis can be used with forms of research in multiple markets, not just finance. You can do technical analysis data on a lot of things, in terms of your car rides, in terms of house markets, obviously finance as well. There's all kinds of different indicators that can be used to give you forms of data and information. It just tells you what's happening in the moment of a certain thing. So you can go on Google and you can do technically analysis based off what websites are doing what, in what situation, in what country, at what time frame. It's mad when you think about it in terms of how companies will find out how busy, certain things are with certain. It's mad. It's mad when you think about it. But most of it is done in the financial market in terms of the indicators and how it's all worked. But in terms of the phrase and the terminology, you want to try and get deep information. The more information you've got without the lag of lagging data, the better you'll do. So let's understand how to become better with technical analysis and understanding some of the framework of perception of what you're going to be looking at. Probability. One of the main things that you need to get around is probability. This is the thing that I believe is on point with risk management, has been often overlooked in terms of making decision making. This is what gets people in the market at the wrong times because of certain factors, which we will come on to in more detail about the human emotions. Understanding that it's literally about this. It's the data in which you read, interpret, understand, however you want to word it, and making it a decision-making exercise. Is the asset that you're buying undervalued? Is the asset you're going to buy go up or down, depending on what way of the market you want to go? All of that matters massively, and I think people forget that. You can make better informed decisions on investments with entry and potential exit points with profit. Removes the emotion out of a lot of things when you're reading just data. The big thing is, and we all laugh and joke, is the FOMO will take over. It does. So does greed. Greed, fear, FOMO, whatever you want to word it as, will take over. And sometimes a plan will go out the window when you're just seeing something just keep on rising or just dropping if you're in the right way of it. Depending on what way of the market you go in, you want to have something that will give you, hold on a minute, I've made enough money here, I need to take some profit off the table. Likewise, if it goes to a certain point, remove the emotion of an entry. When the markets are crashing, you're thinking, oh my God, this is never going to stop. If you've got that, that level input of finding and identifying a place you want to buy, stick with it, because at the end of the day, if it bounces, it bounces. If it doesn't, you've already made a game of probability by waiting for that level. It's a hugely important factor. You can study elements of supply and demand, which can help improve when to be in or out the market. To understand this, it's like momentum. If there's good demand, usually it will go up. If the supply is there, it will usually go down. There's an A and a B in terms of where a price will go to. Often you find that people are the wrong side of it. This is why statistically a lot of people fail as a trader. It's just the way it happens. You are also able to forecast a return of investment without going into investments blind. Talking about the first course, we were literally just looking without technical analysis, like picking coins based off research, not understanding the current prices other than the fact of what the all-time high was and all the all-time low, understanding that data. But without information of key levels, without information of, you know, how much is it down, what's the structure look like, what's the momentum looking like. You know, you don't have to buy into a downtrend, which is going to be horrendous if you do that. Most people do that at the wrong time, thinking they're getting a fair value. It's all right, it's a dollar cost averaging exercise, but if you're looking to like try and make money on something in the short term and you buy the wrong thing, it's just going to bleed your account. And you can build a system that suits your needs as an investor or a trader. So you can build something that works for you, and that's what will get you better over time and consistency, understanding what you're looking at, which makes life really easy. And I always recommend that. As much as I've got proven methods that work for me, they may not work for you. You know, everyone sees and interprets data in a different way. Different indicators. Okay, so how to improve. These are just going to be very, very simple. There will be a full section on this in the course about how to use a lot of these stuff, which does make sense, right? So we've got trends. Up, down, whatever, sideways. A trend is a trend. Trend is your friend as well. Remember that. Charting patterns. Different types of charting patterns that are out there. Volume indicators. Often overlooked. A lot of data that can go out of TradingView and into other services to understand how volume works and how the market makers are moving the market. Momentum indicators. Oscillating data, so lines and graphs and stuff based off a load of different factors. Moving averages, which are relatively straightforward for a beginner. And the one thing, in my opinion, that people should always use is support and resistance, understanding key levels. This will majorly improve how you look at a market. So, running on the same sort of theme, it isn't perfect. Remember this, because a lot of people will find this being a pain, because you'll find the strategy that works for a little bit and then something will happen and then you'll be like, oh, it doesn't work anymore, damn it. Accept the fact that you're going to make losses with investments and also technical analysis. So let's go into it in a little bit more detail. The emotion, hugely important, right? You got fear and greed. In my opinion, this is what moves the market, whether it's good news, bad news, whether it's, you know, people talk about certain things that get you excited about it and you want to buy it straight away sort of thing without looking at the fundamentals or even the technical analysis on it. It happens. When I mention a project, people get excited and start buying it. It's like, okay, even though I've done like 3 or 4 weeks worth of research and I'm looking at a certain level, it's how people react because you want to be a part of something. It's the same in trading, it's the same in investing. You just got to be very, very emotional that emotional pull will always get you, because as a human being, we've all got it. We all have it. Indicators can be lagging and often result in what has happened within the news or multiple people speaking about something. Often you'll find that something will happen and all of a sudden all the indicators will trigger off a buy signal, and usually that tends to be the problem where people get in and it goes up higher, and therefore people will then go into supply areas and start to sell for profit. That is where the problem can be if you're getting caught out with emotion. Paper emotions have also become a problem because of assets that could lead to additional FOMO, and the technical analysis could become literally useless. If a big massive YouTuber talks about something and then it just rockets to the moon, and it's like, it's that distribution element. So you'll go on CoinMarketCap or you'll go on CoinGecko and you'll see the asset at the top of the website full of millions of people viewing it, and it'll be because it's up like 25%. So, oh, I want to buy that, that's amazing, let's go. And I'm like, it's mad. So you got to look at that as a factor as well with emotion. People's time frames and opinions could mess with your own analysis. This is another thing as well, right? As much as the technical analysis could be spot on, you may well be looking at a totally different landscape viewpoint of what someone is talking. This is why I say in the Discords, just be careful with what you're saying about trading, because if you're on the 5-minute time frame and someone's on the 4 hour, they're going to be looking at different things, and it kind of distorts you a little bit in terms of when you're going to get your entry point, when you're going to get your exit point, and then when it starts going against you and they're right and you're wrong, you'll be like, oh damn, you'll cut your position short when realistically you should have just held on with your own analysis. There can be millions of ways to view data and indicators as well. Like literally, like there's I always say a million ways to skin a cat in trading, because everyone will see a different indicator, they'll see a different divergence, they'll be on a different time frame, they'll be looking at different like charting patterns as well with different combinations. It's mad when you think about it. It's like winning the lottery. There is no perfect system, but what there is information that you can interpret yourself, but it's finding the right combination that suits your style. Now, this is kind of obvious, but you might be right, but, okay, because this is often a thing that happens with me. You might be absolutely spot on, but there'll be something out of your control or something within your control that you have like pulled your position, or you've stopped your investment buy-in, or you no longer hold that asset, or whatever it may be, based off something off this little list I've made here. So the obvious one is your risk management might be poor. You may have got liquidated. You may have been really, really bad at risk management, but actually your decision making in terms of the trade was okay, but something was off. Usually your account size was wrong, which would increase the risk management problems. And then you've got this one here, your timing has been off, and then that leads to a bad entry, and therefore your account size is either too big, or you're trying to chase it, or you've not got a stop loss, or whatever it may be, and all of a sudden you're like, yeah, I was really right, but ultimately I got stopped out, or you got liquidated before the move materialized, which is a shame. Another one is obviously you may not want to take profit. This is a thing that often gets a lot of people caught out with greed. It's like Bitcoin going to $69,000. Oh, I want it to go up to like 100k. You know, if you bought Bitcoin late at like 30k, you've only doubled your account essentially, right? Whereas if you bought at like 2k, 1k, or where I was at like $700, $600 back in the olden days, which does feel like that long ago, it's a while ago now, you're more likely to take profit because the money on the table is much higher versus if you entered at the wrong time. You may not trust the data and the information as well. You may be thinking, hold on a minute, that data seems a bit conflicting, and you may not trust it, or you may not think, because of what's happening in the macro climate, for example, right now, which is the current conditions of like a recession, etc. You may not trust the information on the charts because of the news. Right now we've had like a big collapse of one of the exchanges, etc. You may look at that and go, oh, hold on a minute, I don't really want to buy that just in case more stuff comes out. You start to get self-doubt. You may, and this is a big one actually, have too much information, too many indicators, too many conflicting opinions, and that is making it like literally really hard to analyze the data and the information. I will talk a lot more about this sort of thing on the third course, which is all about psychology, which it does help massively. So different ways you can interpret technical analysis either as an investor or a trader. Now, as an investor, your mindset will be very, very different versus a trader. One thing I will say before I start revealing the obvious here is when you're on social media or when you're on YouTube, you'll see different people's conflicting ideas, and I've mentioned this before. You will start getting a little bit caught up in it. So just make sure you have got a bulletproof kind of plan for what you're doing, either as an investor, your price targets, or as a trader. So, financial data. If you're in the financial markets, you can get, using TradingView and stuff like that, financial data on the screen to help you with your analysis. These can be done in a lot of graph forms. You can just data, numbers, and also how to see how certain trends will affect. So earnings season, for example, in the stock market can help you with a narrative of, well, maybe there's a short-term kind of element here where maybe the price may push down to a level or it may push up, so you can start to act. The obvious one is obviously past data. With technical analysis, you can see the past data. You can go, depending on how long or how old or whatever the asset is, you can see dividend streaks, you can see price data, information data around all millions of different metrics, so many different metrics that will help you form a decision alongside your fundamental analysis. Higher time frame stuff only. For obvious reasons, you are looking at a wider, bigger picture from the daily time frame and above. As a high time frame type of person, as an investor, you'd be looking much higher than that. More than likely, if you're in crypto, probably the daily and above. If you're in the stock market, probably the weekly and above. It just depends on what you're doing, essentially. Again, knowing your dividend payouts. Technical analysis can help you with this. You can understand that there is a genuine price movement when dividends are paid out on a lot of investments. You can start to act upon this as an investor and understand when certain things do happen within the asset. And growth of a portfolio with profits. The idea is to buy low, sell high, and to utilize this as an investor, you want to also be able to take profits. Technical analysis will allow you to do that, but you will be a much bigger, longer term holder, more emotionally attached to it, and that's where you want to use, the perks of understanding technical analysis to help you get profits. And finally, understanding sentiment hype. In crypto, this is massive. Even in the stock market, this is massive. You will find that a lot of things that are very, very similar will be going up in value as well. Understanding the sentiment of the market, whether it's a bull market or a bear market, which we will come on to in more detail, is a massive factor to know, are you investing at the right time or is it the wrong time? A trader, very, very different mindset, a massive change and a shift in that. Obvious is lower time frames. Yes, you could trade on the higher time frames, but you are looking to basically rinse, repeat, wash your hands with an asset and not be physically damaged by it by holding it. To make money, your goal is not to hold it, not to get regular income as dividends or staking rewards in crypto. It's to buy it in an open position and to sell it into a closed position. Simple as that. Constantly looking to grow an account. This should be as well separate to any investment funds or spot market holdings in crypto, because it's obvious you are looking to do this elsewhere with a percentage of risk, which we will talk about, and to understand that you are just growing that one account. Kind of obvious, I know, but a short-term bias for just direction. You want to go the right way. Probability has to be on your side. If it goes up and down, up and down, up and down, fair enough, that's the market. It does, and you'll learn that very, very quickly. The market will go up and it will go down. It's not just a straight line. However, your goal as a trader using technical analysis is to guess the right way. Simple as that. And not to get emotionally attached. The main thing. Traders will often cloud people's judgments based off what they think in the short term, and some people get a bit rattled by that, and that's a bad thing. So when you're a trader, you don't have that. So the misconceptions of trading. This is all about trading. The technical analysis you can learn as an investor, more than likely you will go from wanting to learn how to trade on the lower time frames into higher time frame stuff and then into investments, because you're going to learn that not everyone is into this. Not everyone has a life to kind of do it as well. You will find that a lot of your time is looking at a screen, and it's quite boring. I am not the avid day trader, put it that way. The obvious, real trading. Some of the misconceptions, some of the elements that you will learn, some of them are very obvious. It requires time. So the sort of thing that you can just get up and go. You need to learn a lot, you need to see a lot, you need to understand a lot, you need to practice a lot, and you'll learn that throughout this kind of little video. It requires a lot of patience as well, because not only are you being patient for the right setups, but also the time frame, and also to understand and figure out if what you are doing is right and the methodology that you're utilizing, whether it is psychological or if it is just data driven or acting upon instinct, technically, I can get my words out, is a thing that requires time to you to build up that data within yourself and understand it. It sounds odd, but trust me, when you go through this course, you'll figure it out. It's hard. It's really hard. And as much as it looks easy showing you past data and obviously showing you real-time elements, you're making a decision at the moment. And I mentioned it before in the previous course, I mentioned it at the start of this course, it's all about probability. And it requires time for you to get the methodology right, to get the odds in your favor. It requires patience to get the odds in your favor, to waiting for certain things. And it is hard. You will lose money. Simple as that. If you are wanting to be the best trader in the world, I would recommend not using any money at the start, maybe for a few years, and I mean that. Now, the reason why I say that is because Paper trading's great, but it only works so well. What I would suggest is, instead of losing money, play with a small amount of money and utilize the power of percentages. Percentages will mean that you will be able to replicate the exact same result whether you've got real money or not, right? If you've made a certain risk reward on a trade, regardless if it's 10p on that trade, 10 grand, 1 million, the number of the percentage is still the same. It's all about growing it, okay? So ideology should be, I want to grow an account, not input a lot of money into an account, which at the start, more than likely you're going to lose it. Sounds kind of obvious, but it will take a long time to find an edge, to find that what works for you. The way I trade is very, very simplistic, and it's based off momentum. It's based off market structure. In my opinion, market structure is key. It's king. But when you combine it with different elements to make it even better and more refined, whether that is candlesticks, whether that is Fibonacci levels, whether that is as simple as an RSI as well, other indicators, you've got a basis in a nucleus which works. If you're using market structure, it's a great foundation, and then you can utilize other things to make your edge work for you. It's all about momentum, in my opinion. Could take you years to become profitable. Going back to point number 4 there, it might take a long time. I certainly have not been a very profitable trader in the last few years. I have been at a time period where the prices were low and I was able to do it, but ultimately for me, most of it comes from using technical analysis to then become a better investor, to make the profits. If I wanted to go down to the lower time frames, I can, but it requires time, and sometimes you don't have that time. But it's all about being profitable. It's not about your win percentage. It's not about how many trades you take and how many you win in and whatnot. It's often how good is your risk management, which risk management, by the way, is probably going to be the most utilized element of this course, because that is where you can find an element of an edge between your strategy or not having a good strategy with it, essentially. Everyone gives up. Usually the case. So what tends to happen, what we tend to find in learning crypto is we get people really excited about learning, and it is one of those things, right? How do I word this? It's magical that you can learn something that is totally legitimate on a free market where you can read data and make a decision that could make you money for the rest of your life, no matter where your location is. Scary thought, right? But people do give up. It takes time. There's a reason why stockbrokers and cryptocurrency exchanges have a big, massive warning when you sign up saying 90% of people will lose capital, will lose money. It's a very different narrative. It's a very different game than just investing in index funds or into certain stocks and they don't lose the underlying pin value. When you're trading, you're utilizing leverage, you're utilizing certain elements in a shorter period of time, which could result in loss of capital. Those losses do add up. People go too heavy too quickly, the leverage is too high, and the misconception is, I'm going to make it, I'm going to be fine, I'm just going to copy someone. Copying people is the worst thing. This is one thing we do in this course, is we do not teach you a specific element of a method. We show you how to use it, what to do, and then you, yes, listening, are going to build your own little system that you can fit in your life. Because one of the biggest misconceptions is you copy someone, you see it in real time, and you're like, I don't understand this. This doesn't fit for me. It's too short. I'm missing out. You've got to build your own plan. And the final bit, bouncing from method to method. This happens a lot. It happens to me. When you're forward testing and looking at things, you'll find that something isn't quite right. You want to adapt it. It takes time to find your edge. It really does. It takes time to be profitable. It takes time to find your methodology and everything that goes alongside it, because you are playing with real data. Real data doesn't happen overnight. You can't really utilize backtesting data to get you results in the in the forward future markets, because it hasn't printed yet, right? Backtesting data is good, but it only goes so far. This is why certain things fail. Protocols in crypto fail because of backtesting data isn't rigid enough to kind of do anything that could pop up in real time. So make sure you are sticking to something. If you're going to adapt it slowly and small. Don't just go, I'm going to trade with this methodology, utilizing this structure, using this, that, and the other, to completely bin in it and doing something different. If you're going to adapt it slightly to make it better. And the last obvious thing, and it goes back to the start point, not everyone can be a trader. Your family life may well take up a lot of your time. For me, it's running a company, it's doing content, it's providing a service for you guys. Even though I do trade a little bit, I'm not a day trader. You know, the day trader is literally, you've got like a 6-hour block and you are at your computer screen, you've got multiple charts open and you're looking at all kinds of different metrics and data and whatnot, and you're doing a lot of open positions that are going to be shut by the time the market closes if you're in the stock market, or they're going to be closed by the time you go and log off your computer. Some people don't have that time. In this video we're going to go over TradingView. We're going to talk about the platform. The next video will be a TA walkthrough, but throughout, obviously, you're going to start picking up on some things. You've probably used it before. You've probably seen it on exchanges before. We will go over that as well in terms of what you can utilize on other places for free. However, I do recommend that you purchase this. Not financial advice, of course, not telling you what to do, but if you really want to get good at technical analysis, you need to have a place for your ideas, for your charts, for your watch lists, and this is what this video is going to cover. So all the products that is on here. So when you come onto TradingView, it will look like this. Now, there is obviously a lot of different memberships. It depends on how much you want to utilize it. So what I'm going to do, I'm going to log out. I'm going to show you the plan that you can get. So when logged out, this is what it'll look like. Obviously, it depends on when you're watching this video, but it's very, very straightforward. Now, if you want to get involved, go to get started, and this is kind of what you're looking at. Now, for me, I use premium. However, a lot of indicators, a lot of layouts per chart, a lot of alerts. You don't have to use that one, but there's a lot more data and stuff like that. However, if you are a beginner, I would highly recommend just starting off with Pro. Literally, you can try it for 30 days for free. 5 indicators is more than enough. Obviously, 2 layouts and stuff, all kinds of stuff, even 20 alerts, more than enough. You don't need to go 2 balls deep. Now, what I say with that is, with this course, you're not going to be going mental with the element of, you know, for obvious reasons. Guess what? Indicators. When we get to that point, you'll understand why. Now, the fundamentals of trading is all about price. It's about candles, and you get all of this here. Now, for obvious reasons, I would highly recommend just give it a go. You know, yes, you can get it for free. Obviously, yes, you can try for free, but you get very, very limited stuff. You get one chart. You get very, very limited utility of like daily, weekly, monthly time frames, and some data is pretty good, but ultimately 1 indicator per chart, you're probably going to struggle. However, I do recommend you give it a go. Anyways, I'm going to log back in so we can start looking at some more stuff. I am now back in. One top tip I can give you, if you are on a monthly plan, cancel the renewal, and then halfway through the month they tend to offer you like a really stupid discount to go annually. Like, I know this is like 2 months free, but sometimes you can get up to 4 months or even 6 months free. So just play around with it. They will offer you something. Anyways, let's go to the products that we've got. Now, we're going to look at the charts in the next video for obvious reasons. We're going to look at it. Now, you can see here on the products there's already a couple of things. There's screeners to see what pairs you can look at, or ultimately stocks and share, you know, everything, right? So you can obviously go in here, and all this is going to give you is all the information that you want, right? Now, this is crazy, in my opinion, crazy information. Not great for investing, but great for technical analysis. You can see here all the different types of indicators, the different type of variables telling you what is happening. Now, if I click on Google, for example, here, you're going to get a chart, a very, very simplistic chart. You can have it into candles as well if you so wish to, but this is why I say this is a great hub for finance and everything, not just technical analysis, because you get the news. Hello, what is happening with Google right now? What ideas have other people got? You may want to look at these ideas and see what they're doing. Financial information. All the stuff you can get for free anyways, essentially on the likes of Yahoo Finance, you can find out all on here as well. Dividends, all kinds of stuff. For obvious reasons, we know that Google don't pay dividends. But it's all here, right? All the information. If you're doing research, you want to find dividend stocks, guess what? You're going to go, oh, hello. Look at the, oh, hello. Not good. you get the picture, right? You can do a lot of analysis on here utilizing this, and obviously forecast in terms of price levels, what, analysts are expecting. There's a lot of weight to these analysts actually in terms of the future. Now, obviously, you can see here, why is that important? Well, you can look at the previous high, $149, whatever. Now it's at 88. Probably the reason why it's a strong buy, because it's buy the dip sort of situation, a potential forecast of where it could go back up to. Massive information all in one place. Now, obviously, Forex pairs, if you want to do it, obviously cryptocurrency coins, whatever. Heat maps, again, we often laugh at these. They're often on and appear. There you go. You know exactly what I'm talking about here. We see these quite a lot on Twitter and stuff like that. You can get it all on here. So if you want to have a random screen just to see the market and see what the technology sector's doing, hello, it looks pretty nice. And you can put it full screen as well, I think. Can you? Maybe? There we go. Look at that. Beautiful. It is a very, very nice, very, very simple product, right? It works very, very well. If you're one of those people that have got multiple screens and you want to kind of trade, guess what? You're probably going to utilize this for opportunities. It makes sense, right? Another one is the economic calendar. If you're in learning crypto, you would have seen this anyways in the premium. We have one kind of the same thing, just put into our platform, because we can actually, you can embed it, which is brilliant, right? You can embed these widgets. It's beautiful. They've got a lot of different widgets. So if you're into website building, guess what? You can crack on and do it. But very, very important we understand and utilize these. Now, obviously, it's Christmas time as I'm recording this, and there's not much happening. There's a few bits and pieces, but nothing major that we want to really kind of, obviously the GDP growth, obviously, forecast, actual numbers, you can come in hot or not. Sometimes you do not want to trade at certain points for obvious reasons. If the CPI data is out or something stupid is out, this will tell you. This will tell you as well. So there's so much information that you will need to know. The community element. Now there's live streams, there's trading ideas, there's educational ideas, there's scripts as well, which I will cover in more detail in another video. Huge amount of information. But if you wanted to watch live streams, and if you wanted to just watch them in one place, well, guess what? All on here. Super, super straightforward. Now, this is one thing I've never actually used for live streams before. I've always used, the likes of YouTube and stuff like that. But if you just wanted to sit and watch some live streams, guess what? They're all here. They probably will be on YouTube as well, to be fair, in all fairness. But ultimately, it's a great way for things to happen. Another one, as I said before, trading ideas, all kinds of, and also educational ideas. If you want to go educational ideas about risk management, people actually do little mini lessons on this, and you can actually learn quite a lot. There's actually some really good stuff here. Obviously, trading psychology, the traps, certain elements around it. There's literally everything here. You can pick up off so many different people's trading styles or risk management lessons, etc. There's so much out there. It's ridiculous. Markets. Mentioned it a little bit before at the start. All the markets are here. If you wanted to trade stocks, if you wanted to trade crypto, forex, indices, even bonds or futures, you can find a place for you. Indices is something that I'm looking to do more of in the new year. And if you wanted to trade the S&P or the NASDAQ, etc., cool. Or even the Dow Jones, if you wanted to, you can. Futures markets, obviously gold, silver, etc., etc. There's so much here. Foreign exchange. It's a beautiful layout, and I love it. Next one, and the most obvious one, news. What is happening? If you go to news flow, this is a really cool little screen. Look at that. Just neat and tidy. It's just neat, tidy, and it gets you everywhere. And it's fully updated. So if you just wanted an aggregator of news and you wanted to read up and see what's happening, so let's just pick a random one. Here we go. It's very, very simple. And what else you can do? You can literally press next and just, you can literally just use your keyboard, press the right button and just go left, right, whatever. News, BTC. They've got a load of aggregators on here as well as some of the tickers that I mentioned. It's just super straightforward. And if you wanted to have a toggling news bar on a certain commodity or futures, whatever, guess what? You can do it. Another element to this as well, if you wanted to, you can embed, which is actually relatively, starting to pick up now, a trading platform within your TradingView. So you can trade directly on TradingView via these exchanges. So sometimes when you go on exchanges, and at the end of this course, you're going to go through a load of different trading platforms and how you can set them up and what other capabilities are there. Sometimes you got to jump through hoops in terms of the brokers, in terms of the software downloaded to require to use it. But what will happen here is it's very, very easy. Now I've got a Pepperstone account. I've actually used it before. Really, really straightforward to use, right? Now, if I wanted to trade off this, I can. I basically, at the bottom, and I'll show you when we're going through the full walkthrough, it'll toggle up and you can basically go buy and sell, pick your size on TradingView, and it'll hook over to your account. Super, super straightforward. And the final bit is obviously more. Obviously there's a mobile app. There's also a desktop app as well, which is actually really good. I don't tend to use it because I want to zoom in for, like, obviously my screen's huge. I want to zoom in. So this is on 150% zoom, just so it looks really nice on a 4K screen. And it looks beautiful. But yeah, you can have it where it's like this. So the desktop app is not like what you can see at the top in terms of the ultimate element of like the tabs and stuff. But it is a good little app. If you wanted to use it, it makes your computer run a little bit better, more fresh. There is also, as I said before, a mobile app. I highly recommend you get it. But what I will say is don't get addicted to it. Do not get addicted trading on your phone. You're going to start finding yourself absolute chaos. I mean, yeah, it does look great, and yes, you can do certain things on iPads and stuff, but you're at a disadvantage, in my opinion, if you're only looking on a very, very small device. Again, business elements as well, if you wanted to utilize business side of it. But that is basically in terms of what you can do. In terms of a very quick walkthrough, this is the features. I am not on about the charts yet. Next video, we're going to look at how you can get the default chart and how it will all look to you as an individual. My personal belief is keep your chart simple. Gaz is echoing it as well. Keep it super simple. Too many people come into the world of crypto or come into the world of trade and technical analysis and want to have everything all at once. Think of it like your dinner. You can't eat everything at once. Your mouth will fall off, and that is not a good thing, right? Other things to mention as well, if you go to your account, you can refer people and get coins. These are they're not crypto coins. They're just like, they help your, your monthly bills go down a little bit. It's really, really handy. But you do have a profile as well. If you click onto your profile, you can be able to see everything. So if you wanted to put some of my old random ideas from absolutely donkeys ago, I don't tend to use it anymore. But at the end of the day, if you wanted to put your stuff on here, you can. You can also follow people. You can follow other people and all kinds of stuff. Because obviously, in the next video, we're going to go through this right-hand side here, which is going to give you some information. But products all done. There's a lot of information here. You're probably bamboozled already. But the main part is how you can do technical analysis. So now let's talk about the main thing, which is the charting side of it. Now, we're going to keep it simple. I'm going to make it so this chart becomes a default chart. So the first thing you'll have is probably a default layout, whether you want to be in light mode or in dark mode, which can be toggled via this. You can also remove the drawing panels as well if you so wish to. But yeah, entirely up to you in terms of what you want to do. You can obviously make it so it goes white around the outside by basically pressing no. So if you're going to go light, press no if you want to change the template or not. Sometimes I quite like having the light and the dark. It's quite weirdly cool. But the main thing you want to do, make a new layout. Okay, so if you go to add and then you go new layout, you're going to get just a default basic TradingView layout. This is what you are given straight away. Now I've got multiple different ones which are very, very similar to this. But yeah, I've done a few little tweaks which make mine look a little bit different. So all I've done with mine, for example, I don't have the volume on there because I think it's quite messy. Other things that I change is I make sure that this is a little bit bigger so you can read it. So what I'm going to do, I'm going to do a few little customizations just to make it better for chart content, right? So it makes more sense because as you go through, things get a bit messy and obviously you can't read the numbers, which kind of isn't ideal, right? So first thing you do, go to your settings, because again, you may not want to look like this. You may want to look a bit different. Everyone wants to have a different style. Some people are colorblind. Some people have different, ways of viewing data much better. But basically, I'm going to leave it as it is for that, for obvious reasons, because it's nice and neat. If you want to change elements to this, I recommend you make some obvious changes. Now, the ones that I do change, and some of the things that you will have, you may well have that certain elements like value, as you can see here, will toggle up and down. I personally have them values off. Now, it's up to you. You can have the volume if you so wish to, but personally, I don't. If you want to change the value percentage, you can, but there's no real kind of issue with being up there anyways. Now, this is where most of the changes can happen. In terms of this, you may want to have the symbol name on here so you don't get confused. Personally, I don't. I think it looks messy, so I like to have that off. Now, for me, the fundamentals of all of this is how much you want to be trading. Now, the one thing that I will say is sometimes on a default chart, it will add all of these on there. I toggle them all off. Why? because I'm not going to be trading on this platform. Plus buttons, if you want to have that on, you can do, it's up to you. But that's kind of how I have it. If you want to change the date format, you can have it whatever way you want. You can have it proper old school, you can have it like, you know, like the UK version if you want to. It's up to you. It really doesn't really matter. In terms of that, I like to keep it nice and simple. Appearance, the colour. You may well want to have different colours, you may want to have it solid or whatever. You may want to remove the vertical grid bots as well, the grids around it as well. I personally quite like them now, I never used to, but I think it kind of looks quite nice now, so you can see round numbers pretty well. If you want to change the crosshair, you can. Make that a solid line. I personally like to have it so it's visible, so you can put your mouse on it and you can go all the way to the left and see certain things. If you want to have a watermark, you can. Is there any real point? Probably not. It would be nice if it was a branded one. It'd be nice if you could put an image in there, like if you know, if you're doing content. It'd be pretty cool, but obviously you can't. Now this is what I changed. Now usually on default it's like 12. It's like really small, or 11, and it's tiny. Yeah, it looks neat and tidy, but when you're doing video content like me and you're on a mobile phone, you're never going to be able to read it, which is kind of a problem. And I also like to have a line. I think on the default version the lines are off, so it's like that, but I personally like to have a line. I like to see the obvious, and it kind of makes sense. If you want to change the margins, you can. If you want to like make it a little bit better or different percentages, you can. Just make it fill a bit more. Personally, I like to keep it on default. Again, trading, these are usually toggled on. I have them off, and if you want to have the events on, you can. This is usually the stuff like this, so you can kind of see the latest news toggled there. If you're in the stock market, you see the economic calendar, or same with like certain forex charts, you can have event breaks as well. It just makes everything easy. So you can change whatever the hell you want on here. Beautiful. Now, as I say, I don't like the volume, so I'm going to remove that. Personally, you can have it on, but I like to keep it like that. Super simple. Now let's go in a bit of a weird order. We're going to go from this corner, we're going to go around the screen like this, okay? Which probably sounds a bit daft, I know. We're going to avoid this bit because that's just a favourite bar, but these will come in handy. Just make it really obvious. So, first thing, left hand side, you have got the way you can toggle your thing. As I mentioned before, you can do this. Now I kind of like it like that. I think that looks pretty slick. But for the purpose of this course, I'm going to leave it all as dark mode. But maybe for my own personal charts moving into 2023, I may well have a contrast, which makes it look a bit more interesting. Now, the ticker. This is where you can search for everything, right? Literally, if you want to trade whatever, you can find it here. So, guess what you're going to do? Press the search button, hello. So I'm going to put an R in there for random, ROKU, only because I just saw it there. Roku, all right? Random asset, there you go, ticked. That's it, cool. If you want to trade Bitcoin, put in Bitcoin. Now, the reason why I said put in Bitcoin is because you are going to get confused. Put in BTC. You do have it down here for Tether and Binance. Now, the one thing that you can do here, go to crypto. The one thing as well, if you go on to BTC, easier. If you go all sources, you can pick the exchange you want. Top tip, before I forget to tell you, if you're trading and you're on an exchange, use the exchange you are trading on. So if you're on Bybit, which I will do a tutorial on, you need to use a Bybit chart. If you're on Binance, use a Binance chart. If you're on BitHub, whatever, right? Make sense? Good. So if you're going to go Binance, it's going to pick out all the Binance ones. Now you're probably going to be like, oh my god, Tether, Binance USD, Euro, Ruble, etc. It depends on what pair you're trading. Most common one is this, Binance USD. If you want to add a symbol, you can. Now this is where it gets interesting. If you want to learn how to make oscillators of other data, you can. Now, I like to use dominance. This is the dominance of USD. There's also different variations for that. Now, if you wanted to put on the dominance of USD, now one thing you need to do, go to your currency element here. If you go plus, you can obviously add a different element to it. If you wanted to basically look at what BTC and Ethereum are doing at the same time, it's a bit wild. It's basically added them together. Now, I am not suggesting you do that because you are not going to be trading anything good. That is obviously something random, but I'm only doing it for the demonstration of this. Now again, if I go back to where I was, if you go to the plus signal now, you're probably going to find something very, very random. All you need to do is copy what I just did in terms of, you know, putting the plus and copying the bar basically. So as I said before, you know, if you want to do this properly, if you do BTC.D and then Ethereum.D and press enter, this is the dominance of the biggest market cap coins out there, right? I'll go into this in more detail in other videos, but don't worry. When you do this, you then basically press the copy paste button, right? So you want to basically copy it, and then when you go to the plus sign, you can just do that, and then, you know, press enter, and guess what it does? It gives you that spread on a line. You want to remove that line though, because that isn't the right one you want to do. What you want to then do is add it as a pane on the bottom there. So if you wanted to trade the market in a certain way, now with dominance, now if I remove this, bear with me, let me just go to a random asset at the top, there we go. Often what you find when the dominance of these two assets are going up, or if it's a single one with BTC dominance, you find that the market will go down. All this is doing is giving you oscillated data, and you can add compare charts to your bottom area. Now I know this is pretty advanced for like a beginner, but that is what that plus symbol's for. It's to add different varieties on your chart in newer areas so you can make your chart neat and tidy. If you're trading Forex, you may want to put the dollar index on there. If you're trading S&P or NASDAQ stocks, whatever, you may want to put the NASDAQ down there when you're trading the top 500 stocks. If you're bullish and that's going up, guess what, boys and girls? You should probably be long that day. You get the picture? Good. Anyways, I know that's a bit confusing, but that kind of helps it. Now, timeframes. You can add, depending on what your level of subscription is, whatever chart you want. Now, most of them are default. Some of them I've made up and random because you can add them on the bottom if you're like a much better member. But these are the main ones I use. I use the 6 hour, the 8 hour, the 12 hour, and then obviously the 1, 2, 3 day and whatever. If you star them, they will remain here. Most of the default ones are like 1 hour or something random like that. I personally have them. I don't really look that far down. I just get confused by it. So I like to go higher up, but they're the timeframes. We will talk about timeframes in more detail later on. Candles. Hello. You can have different types of candles. Guess what? There's a video about candles later on. Gaz has done it. But if you wanted to toggle, that's how you do it. Line charts are very good for support and resistance, right? Gaz goes through it, but if you want a little bit of an edge on seeing where the candle closures of a candle is, you use line charts if you're a beginner, because you can see an exact areas of where to pinpoint. Makes it much easier. Anyways, other ones there as well. As you can see, there's baseline, there's high to low candles, there's Renko candles. They're all different formulas. They don't give you an edge. Some of them are lagging. So like a Renko, you'll probably look at this and go, oh wow, that's super easy, I just follow it. They are very, very different in formula, they're lagging. So as you can imagine, there's a bit of learning to do there. Now, indicators. If you click on here, you're going to have a favorite tab, which is all the random stuff on there. This is all this random stuff that I played with in the past. If you go to technicals, this is all of the stuff you can get for free on TradingView, made and approved by TradingView. So you got the relative strength index. We will talk about that in more detail. There's random stuff. If you want to add these, you just press on it. Boom. Each indicator is different. If you press this little hello sign, this little question mark, go to description. Now, I'm not going to teach you how to suck eggs here, but you need to know how each indicator works. Now, we will go over indicators in more detail in an actual section of top indicators that I've used in the past, I've got experience with, and I'll go through in much more concise detail. But if you fall down the rabbit hole, you may well find something that works for you, what you can see and what works nicely for your brain. Now, as you can see here, the mass index is a technical analysis indicator. Now, I have no idea what this is, but it kind of gives you a high and a low between the specific time of a stock. Quite a good little probably element, to be fair, and you could probably see this will probably work very well in terms of momentum. You could probably see that already in terms of the mass index, but I do believe that this will be probably very, very good on the stock market, but it is using EMA, so it probably will work on crypto too. Now, it is obviously a formula. Now, when we look at this in more detail and we're looking at the chart, you know, if I go into like the weekly time frame, you can see here how this is kind of like ballooned to a certain point. And obviously when it's come down, then it's obviously going up again. It's a bit weird, so probably wouldn't use that, but you get the idea. If you want to move these as well, you can go to the top, or you can collapse them, or you can make them huge as one big thing. Really, really easy. Love this system. Anyways, moving on. This here, is all your favorite stuff on that arrow. This is where you can save different layouts if you wanted to. I personally don't use that anymore. This was kind of me playing around ages ago, but you can basically save a template. So if you wanted to use certain indicators, you go save template, go to here, and then you can like find them. These are some pre-made ones. If I click on this, it will go mental. There we go, boom, random. So as you can imagine, it can go pretty nuts. Alerts, super straightforward to use. If you wanted to do a crossing of this time where we are right now in terms of current value, really straightforward. Personally, you probably don't want to do that one, it's a bit boring. But there's all kinds of different variations that you can do. So if you wanted to do like, right, tell me when it is 20 cents please, and it'll put a little line there, and that is an active alert. Super straightforward. If you've got indicators, you can right click on the indicator and create it on there. Super straightforward. Honestly, it is basically the exact same thing of what I've just done. All you would do, if you have an indicator on here, so let me just add a random indicator. Let's just go on to, let me have the RSI for example, which is one that we'll cover later on. This is what it looks like as default. If you wanted to go on to here, if you click on the actual purple line on the default and go add alert, boom, right? What it will do is when it gets to a certain point, so when it gets to a certain point of 30, I want you to tell me when it's doing it, when it's going over or crossing over that one. And obviously you can see only once per bar close, or once per minute. Once per bar close is usually the best one. Why? Because if you're on the daily time frame or whatever, you want it to go off as a candle closure because that's kind of already submitted, essentially, it's already done. If you're doing it every minute or every bar, and it's going to be pinging you every 10 seconds, your phone's going to, one, fall off the table, and two, you're going to get annoyed with it. So you just got to be mindful of that. If you press click alert, it'll give you a little alert at that line. Now this is basically an oversold sort of line, and an overbought sort of line, right? You can utilize alerts on there, so whenever the asset goes into a certain point, you can utilize it for certain things. But that is alerts, straightforward. If you want to remove it, remove. Easy. Anyways, I'll remove that. So that's that. It will become more familiar as things go on when we talk about indicators in terms of how to use them. I'm not covering indicators just yet, I'm just covering how to get them on, and then I'll go through it in more detail. If you want to go back in time, press the replay tool. That's really straightforward. Now, here, select a layout. Guess what? If you pay more, you get more. You will get very limited if you're on the free account or if you're on the very low end account, but guess what? You can literally have whatever the hell you want on here. It's great. Now, it's super straightforward. You need to make sure that these are all toggled for whatever you want. So if you wanted to put, say, I don't know, a couple of random charts here, right? If I then click on here and go symbol, I don't want that because all the symbols will be the same. I want to change each symbol, but I want to keep the interval and I want to keep the crosshair and the time pretty much all in one. The crosshair gets a little bit confusing for most, right? So for example here, if I click on here and go daily, they all change. You do not want to have the time on there. I've just remembered. Oh no, the interval, sorry. I think it's the interval, bear with me. Yes. So if you are trading like this is going to be crazy for some people. If you may want to have the 1 hour, you may want to have the daily, and you may also want to have something like the 4 hour or the 6 hour down here. Now what's scary here is you can draw something and it will appear on all your charts at the same time. You may want to do your technical analysis on here and everything else working on these ones so you can see it in more detail. It's pretty chaotic, but that's kind of the best setup you can have. Obviously you can have different symbols as well, so you can make it so it's all different symbols, you're looking at different things. But if you're having it all like that, it'd be pretty crazy. If you go date range, it'll also move it so it's in terms of the date range of this, so you can all just move and you can zoom in terms of certain points. Pretty crazy, but again, have a little tweak and have a little play around with it. Personally, I think it's chaotic when that happens, but you know, some people like it. If you've got big screens, you can do a lot of things on these. Right, moving on to the obvious, the unnamed. This is the layout, all my different layouts that I've got. If you want to make a copy of it, cool, you can. If you want to share it, you can. You cannot share it and embed it. So for example, if people are like, oh, can you give me your layout? I cannot give you it, unfortunately. It just doesn't work in that way. What I want to do here, I'm going to go TA course. Super straightforward. So you know, it's all the same. I want to keep these courses all the same in terms of look, so it's kind of obvious. Now, magnifying glass, do I really need to show you what this means? It's searching. Settings, exact same bit as what I went at the start, and again, maximize if you wanted to. Now, this is the thing that really is an ick for me. When people are in Discord and they're taking photos of the screen with the phone, please don't do that. Please press this button, copy the chat link, or save it and then upload it, or even tweet the chat if you so wish to. You can put tweets on these chats as well. If you go onto Twitter and you right click onto copy, then paste it, it'll go to the date when someone says something silly. So if any influencer says something really stupid, you can copy it and go, oh, he said it here. And then you probably find it like melted from a certain point. You could probably see why. So that's a good thing. Publish. Guess what? You can publish an idea. So we talked about the ideas in the previous videos. Guess what? If you've got a technical analysis idea, you can publish it on the platform, i.e. TradingView. It's pretty cool, right? Now, watch lists. Hello. So, bottom to the top, it gets a bit messy. So we're going to go from the top down to make it simple. You can make whatever watch list you want. This is my main watch list. I have random ones all over the place, obviously for obvious reasons. Now you could just add to these very, very straightforward. Now if I just go right click and go, make a new list. Hold on, where, oh, sorry. There we go, create a new list. LC course, right? So here we are, simple. If you want to share this list, you can. You can share this to people so they can basically embed it into their own TradingView, which is pretty cool. Make a copy, rename it or whatever. You can add a section. So I may want to go altcoins, and I may want to be like, right, on my altcoins, I want to have the likes of Ethereum, I want to have BNB, Dogecoin. Boom, they're in there. And then I could basically go onto here again and go add a new section, and I may want to go FX. And guess what? If I go on here, if I just go, I don't know, Great British Pound, which is not doing very well right now. If I go Forex, boom, I can just pick whatever. Pick two new ones, happy days, they're in there. And as well, guess what? If I wanted to go stocks, you see the picture here. You can build a really nice looking, pretty watch list that is really, really straightforward. Go to stocks, and if I want to put like, I don't know, Tesla in there, Apple in there, whatever, right? Oopsie. Cool. One thing you can do, if you press on symbol, it'll alphabetical them. If you're a bit OCD like me, you can also move them around if you wanted to. So if you're adding them, they will all appear at the bottom. Then you can just drag and drop them into wherever you want them to go. Super simple. And guess what? That's your watch list now. You can use that. You can see that everywhere. If you want to toggle between your other ones, you can just toggle. Really, really straightforward. I've obviously got a lot in here, a lot of random stuff in here. It's entirely up to you how you want to use it. Next one, all your alerts. All your alerts that you've set, all in one place. Headlines for the asset that you are on. Most of these are for Cardano because we are on Cardano at the moment. And if I wanted to change into another coin, so let's just go into Ethereum. If I click on there, the news will change to Ethereum. Most of it is kind of a bit of everything, but most of them will be very, very similar in that way. This one is just basic information. On crypto, it's not very good, right? If I go on to say Microsoft, for example, or whoever, if I click on it now, you're going to get more information on a lot of these because they're all for financial markets. Now for this is just the data of what is happening right now on this hourly kind of candle. If I go next, you get a lot more data and random things for other assets if you're in the stock market. Now with the stock market, you can obviously, you can change this. You can change it to whatever the hell you want. These are pre-made watch lists, or you can ultimately go down to like these sort of randomness in terms of this, but they're not really much for crypto. Ideally, it's just for like top stocks in those countries, right? So it just kind of gives you an idea. But I mentioned it before in the previous video. If you want the economic calendar on here, you can. And the idea section, which makes much more sense. This is my ideas, and obviously you can get all the other stuff for other people's sort of minds for this random stuff. Messages, random stuff, kind of ish, and then obviously private chats, idea stream, live streams currently right now. Some of them were like 21 minutes ago. Some of them are already live as well, which is pretty cool. I think that's one that is live currently, and then notifications of who people's doing what and where and how, and that's it, pretty much it. You can order this panel as well. You can change this the order panel is for when you've got a broker, which makes more sense. And then this last one here is obviously, all your order book kind of stuff, random stuff which you don't really need to use, to be fair. Personally, I leave mine always on the watch list. I think most people do as a default, but yeah, most of the information you're going to get is better for stocks, because if you go like this, and zip it right the way up, you've got a random bar here. This gives you all the stock information. Now for a lot of the crypto stuff, you get very, very limited. You basically get the price, you get the element of like, oh, this, sorry, down here, but all the dividend stuff, all the income statement, that's all nowhere near. So it's massively different. If you wanted to customize these widgets, you can, and it is a very, very cool little tool. Now again, if you want to put it halfway up, if you wanted to, you can, and then obviously your watch list can toggle like that. It's pretty straightforward. I like it. I personally like to have mine right at the floor like that. I don't like to really look at it because I trade mainly crypto, and crypto doesn't have that much information, which kind of makes sense in that sense. Now, all the way at the bottom here, full screen, and you got a show panel. You can build this panel up and do whatever. This is a random indicator on. I don't know why I've done that, but hey, it's been a while since I've used that. Yeah, whatever. So yeah, basically what you can do is you can actually change and build all kinds of stuff in terms of scripts, which I will come on to in a second. Now, this is a bit here. Now, obviously, I'll remove my favorites bar. This is where you can connect to a load of exchanges. Obviously, there's a few crypto ones on here now, Bitstamp, etc. But most of them are Forex. Really, really good bit of kit. This very, very good to see this getting even better. Strategy tester. If you wanted to build a strategy tester, you can. They're totally random. Pine editor, which is kind of the thing that I was on before. This is obviously some code. And obviously the cryptocurrency pair list, the watch list, the screener, which is pretty awesome. So if you wanted to trade certain things based off certain oscillating data and certain information, you can obviously toggle this, do whatever the hell you want with it, and find a load of pairs if you so wish to. Now, obviously the bin button, relatively straightforward. You can remove all your indicators, remove all your stuff. If you wanted to hide all your indicators as well, press the I button. If you wanted to lock your chart, you can. All of these are mainly like tools and obviously drawing tools, right? So if we go into the likes of the love heart section, this is a load of it's a load of graphics basically. So you can draw pointy arrows, you can do flags, you can do hammers, whatever. Tools. Now, long position, short position for forecasting, for data ranges, price range. Now, if you wanted to go short, for example, random amount, you can monitor your stop loss. We'll talk about this in more detail later on, but this is how you get these tools. You can obviously customize this tool to look however you want it. Again, long position, the opposite way around. Price range. How much did this drop? Oh, hello. It's a big drop. You can customize these to whatever colors you want, by the way. I have mine like this, so it kind of pops and looks neat. If I wanted to make it even bigger and go bang, it's entirely up to you. But for me, personally, I think that looks pretty neat and tidy. You can see it and it's very, very obvious. It's up to you. As I say, fully customizable. If you wanted to make ghost feeds, you can. If you want to make bars, whatever, or if you wanted to add price ranges in terms of dates as well. So if you wanted to look at how far this pump, it went up by 7.52%, and it lasted for 28 days, which was actually 28 bars, which was 4 days, because 1 hour divided into that in terms of open stock market hours, it's very different. If I go onto the 8-hour time frame, you can probably see the exact same element, but guess what? 4 bars this time, and it equals 4 days. Simple, right? Cool. So quick maths. Now, going up again, tools. If you do Elliott Wave, if you do all kinds of ABC patterns or certain elements around patterns, this is what you'll use. Personally, I don't really use those. This one, text, tweets, signposts, anchors, arrows, comment bars, images, which is also very, very random. This is a very, very new tool, by the way, really random. If I don't know, what is this? A random YouTube thing. So if I wanted to put that in there, I can. Cool. New feature. But yeah, that is one of the new features. But yeah, you can do a lot of things. Personally, I just use a text. So obviously you put something like don't sell here, sort of thing. Oh God, don't sell here. And guess what? You can literally customize this to do whatever the hell you want. And it actually looks relatively straightforward. Boom. So you get the picture in terms of analysis of what you can do. Now, I mentioned it before in one of the previous sides of it. All the information that you get here on the bottom for the stock market, earning season, dividends, all this information is all there for you, right? It's all there for you to tell you, even the estimates and also the dividends and what you're expecting to get. Obviously the news every single day, that will be there. Now, moving up again, we've got more information. Brush tools, rectangle box is the one that I use a lot of. The eclipse tool I use quite a little bit, but not as much as I used to. But yeah, I like to use a rectangle tool. I like to just plonk things like that, because it's very, very obvious and very, very clear. And it's up to you if you want to use that. Now, the most popular elements that I use is obviously the Fibonacci. There'll be a video on that. But again, there's more and more tools on. So these are basically tools like channels, pitchforks, rays, gamma rays. I personally don't use any of them apart from this one. That's basically it. Obviously, as I said before, if you click on them, you start learning about them, you press Google, you go through YouTube, you will find out how to use a lot of these tools in a certain way. I personally don't. So you will not be learning much about how to use all the different tools because you'll be here all week. But if you find something that you like the look of, that's how you do it. The lines. Hello. Vertical lines, horizontal rays, trend lines, etc. These are where you find them. Now, if you want to annotate your chart, if you want to do a horizontal ray, for example, it'll just be like that. Boom. Click, click, off you go, right? Again, there's shortcuts on these as well. You can probably see that there's little shortcuts for certain things. Horizontal line as well goes all the way across. So this is the one that goes all the way across. You can customize these to whatever color. I've got mine red on this one for the horizontal ray. I think horizontal rays are much neater and tidier because I can go from where I want and it's not over here somewhere. I like to look at it forward thinking. I don't like to look back all the time. For obvious reasons, it's good to look back for support levels and resistance, but you don't want to have a line going all the way through your chart for the next decade. It's like, oh my god, it really gets on my nerves a little bit. But I like to keep it super simple, right? One thing that I will say as well, if you are looking at making your chart neat and tidy, you can remove the price line here. If it's up to you. Personally, I quite like to keep it on there. It's quite a good bearing. But again, if you go to the line section, stuff like trend lines is just a line that you can move around. So if you wanted to obviously just draw a random trend line, you can just do that, for example, and there you go, there's your trend line. That's a really bad example, I know, but actually it is kind of valid, to be fair. Are we going to bounce up and hit this level? Maybe. Are we going to? Who knows? Or has it already kind of flopped it and failed? But you can kind of see where I'm going with this. It's up to you how you want to customize it and do whatever. If you want to favorite them, guess what? Press a little star button and they will appear in your little favorite tool. I like the look of this arrow. I think the arrow is pretty cool and nice and tasty. You can annotate a lot of things with this. It's a really simple system. So that's the basics of how to use TradingView. Really, really straightforward. There's nothing else that I want to go into in terms of just the depth of it just yet. There's other variations and other things you can do in terms of turning the chart upside down and all kinds of random stuff, but I don't want to confuse you just yet. I am going to press save here just so I can get a chart saved. But yeah, that is the basics of how to utilize it. It takes practice. It is very, very overbearing sometimes and a bit daunting. But once you know what tools to do what and how to build stuff, it's not. So when we talk about TradingView, we have it on a lot of things that you're probably aware of anyways. Now, as I say, it's better off you having TradingView than using obviously the likes of Binance, Bybit, etc. Now, when you go onto, let's be honest here, let's just go onto this. Now, I'm not logged in, but you can still see this is TradingView, right? So very, very similar, but it isn't the true TradingView. You probably noticed, you probably think it is, but it's very, very similar. This is the Binance version of it, right? All you need to do, click this little tab here, and it is exactly the same as what you're used to. The same icons, the same drawing tools. However, when I go full screen, yeah, it looks great. Like, yes, you can use this for free. However, you can't, because as soon as your browser resets or certain things happen with your browser or the caching goes off, you're going to lose all your data. And that's a pain in the bum. And also you can't really do much customization in real good speed or time. It's a little bit of a pain. Yeah, it's one of those. It's kind of annoying. But if you want to use it to utilize certain things, you can, for obvious reasons. But it is in a certain point. It's okay, it works, it's not bad. But that's just Binance. You can do it on most exchanges, but I do echo that you should realistically be using Binance for obviously your orders, but maybe your TA should be done elsewhere, unless you really want to use and do your charting exactly as you see it. But you can customize it. But as I say, as soon as you log out and log back in, or you're on a different device or a different machine, it will reset, and then guess what? You're back to square one. Another thing as well is also on TradingView. Not TradingView, sorry. CoinMarketCap. If you go onto any asset and you start looking at certain things, you can start to notice that you got a lot of structure here, which is also TradingView. Candle paths, chart patterns, and you can do chart analysis on here now. Back in the day, you never used to. This is relatively new. So you're going to start to notice that this API of TradingView is pretty much everywhere, which is pretty handy. So familiarization of this will help you massively in terms of understanding the entire market. It's entirely up to you how you want to use it. But this gives you so much you can play with. You can see how boring the market is right now. It's not very good, is it? But there you go. Very, very short video, but just remember that this is all TradingView. You cannot sync it to your own account for obvious reasons, but yes, familiarity is good. If you want to do quick analysis and you're just on this website, you can do certain things much quicker. A really cool thing that you can do on here is get on-chain data. It's a relatively new feature that is also included in a lot of the payment subscriptions. If you go onto your symbol and go to crypto, then put in Glassnode, you get a lot of information off the Glassnode website. If you've never heard of it, I will just quickly put it in here so you can see it. Bear with me, Glassnode. It's essentially a big market for on-chain data. It's a really, really good website. You can start up for free, I think, I believe. Yeah, there's a free version with 24-hour matches, but obviously you can pay for a lot more. The data that you get on TradingView is a bit lagging, but it's also useful, right? So go into here, Glassnode, and you can start to see some of the information. Now, if I remove BTC out of here, you're going to get a lot more. There's about 46 different ones. So if you want to see the Ethereum supply, for example, the USDT supply, the BTC supply, all the kind of stuff of the visualization of the market cap of certain things. So you can kind of see how it works. And this is kind of the market cap of BUSD in terms of the market capitalization of this. And it utilizes it in line chart. So it's a very, very different sort of metric, but it's also a very, very handy metric at the same time, right? So you can see the hash rate of BTC. If you wanted to look at this, this is essentially, as I mentioned in previous courses, the hash rate of the security protocol within the BTC network, which is pretty handy. So yeah, you can get a lot of this for free if you wanted to just have a little look. I'm not sure how you can add them to your chart, or if you can add them to your chart as well if you wanted to look at certain things, so such as market caps or whatever. But there's a lot of stuff here. Obviously, new addresses, active addresses, BTC difficulty, absolutely everything. Literally low. There's way more than 40 odd markets. I do lie. But yeah, you can see there's quite a lot of data here. Random stuff. And yeah, you can find out a lot of stuff. So total Ethereum, what's this? Total Ethereum TPS or something? I don't know what it is. But there's loads. There's absolutely loads of stuff. Total transfers per second, which that one is that. So yeah, have a little play around. You can have a little look. Obviously the total fees and stuff. Crazy numbers. But there you go. It's a relatively new feature. There's a lot more coming out. I believe there was going to be, I think it started off with 12 and now it's like bled into loads now. You can kind of see all the different coins coming onto it. But yeah, makes sense to have this. But in terms of information, you wanted to see certain things, this helps you massively. If you did want to add it on as a pane, I believe you probably can, to be fair. You probably just have to put in, copy and paste the symbol and then put it in if you wanted to look at certain things in more detail, or create a lot of panes and build your own on-chain data map, which would be pretty cool.
Keeping your charts tidy. So a few of you who are watching this probably know that I am quite a minimalist when it comes to charting, and this is nothing like what my charts and TA usually look like. However, back in 2018, 2019, when I was just starting out trying to learn how to trade, this is pretty much what it used to look like. I had every indicator under the sun on here. As you can see, up the top I've got the MACD, at the bottom I've got the RSI. On the chart itself I've got a couple of moving averages, some thick support and resistance boxes, a fib, and then we've also got some divergence action here. And the problem I found with having all these indicators on, it was a case of, if all the stars align, if all the indicators are saying the same thing, then obviously it's going to be a good trade. But the problem I found was that by the time all of them would line up, either the trade was already gone, or the fact that I'd be waiting for one or two of the indicators to follow suit with the others, and the trade just wouldn't work out. Either I'd miss it, or the indicators would be too contradicting and they'd put me off entering the trade, and then it would actually go the way I thought. So it just became way too noisy, way too confusing, and so I slimmed it right down. And so basically I'm now at the point where, as I say, many of you will know, I'm very minimalistic in terms of I don't use any of these indicators anymore. Obviously support and resistance, which we'll go into in future videos, but just don't use any of it. But that isn't to say, so throughout this course we're obviously talking about a lot of different aspects of trading and technical analysis. Just because I don't use something, or maybe Ash doesn't use something, or someone else in the community doesn't use something, it doesn't mean that it's not useful to other people. So for example, those indicators that I've shown there, there are ways to use them. I just personally don't like to use them because I personally don't get on with them, but doesn't mean they're not effective in the hands of other people. So don't take things that myself and Ash say to sort of be, this is the only way to do it. This is like a guide to show you all of the tools available, but it's down to you to then essentially build your tool belt with the tools that we're offering, and what works for you, what doesn't, and basically take the aspects you like from mine, Ash's, and any other member of the Learning Crypto community. Taking the aspects you like of those strategies and using it to build your own. So as I say, just because I don't use something doesn't necessarily mean that it's not to be used, or that it can't be used, or that it's ineffective. It's just the way I personally like to do things. So as it comes down to keeping your charts neat and tidy, as I say, I like to keep it very simple, very minimalistic, and you'll see that as we go through the course, that the tools that I use, and even down to the fact that, so this now I've reduced it down to what you would essentially find as a default chart on TradingView, apart from the fact that it's obviously in dark mode as opposed to light mode. And one further step I would actually go to is I'm actually going to go into settings and get rid of these grid lines in the background. So go into settings, right click into settings, into appearance, and I'm just going to change the opacity there down to 0% for both the horizontal and vertical grid lines. Get rid of them, so nice plain background. Some people, again, going back to what I said before, some people like to use them. They can sometimes help you see certain lines of support and resistance, but for me personally, I like to have like what you might call a blank canvas, and the only few tools I use, so we've got some shortcuts here. So I'll use thin lines of support and resistance using a horizontal ray. For example, I like to use the magnet tool as well, which means I can snap it onto the top or bottom of a candle. Or if I'm marking out some thicker lines of support and resistance, like if I'm going to average into a trade entry, which again something we'll come on to later, I will use a small box like that. So that's really all I use. There's also some trend lines that I potentially use as well, so using this ray tool here. So for example, get the magnet tool back on so we can slap it onto the candles like so, and I will use those trend lines as well. But yeah, keeping it real simple, less confusion, less noise. I would certainly advise starting out very minimalistic, just using support and resistance, as I'm going to show you later on in the course, and then you can start to play with the other tools that are available to you once you understand the basic concepts, and then you go on to some more bull markets, bear markets, what they are, and why is it so difficult to do the simple thing, which is just buy low and sell high. Why do people struggle? I'll tell you why. It's the psychological factors that come into play. So quickly defining what a bull market and a bear market is, if you don't already know. Bull market is simply where prices are going up, and a bear market is where prices are consistently going down. Pretty easy illustration here from the 2017 bull market going into the 2018 bear market. As you can see, all through, well, even back in 2016, but all through 2017, prices were constantly going up with a few pullbacks, and then the following year is the exact reverse. Price is constantly going down with a few pullbacks towards the upside, but as you can see, eventually trickling from around $20,000 all the way down to about 3,200. So why is it that people don't buy at the best possible opportunity, which is down here, and then sell at the top? Two simple words: greed and fear. Fear and greed, whichever way around you want to put it. So the reason I've got these words just here is this is exactly where they both kick in. They're the two most powerful human emotions, and they play such a pivotal role in not only trading but investing as well. So this video might seem a little bit more on the investing side, but the psychology is exactly the same. Even if you go down to the smallest time frames and you trade in the 1 minute time frames, it's still the same exact psychology. Why don't we buy at the opportune moment and sell at the opportune moment? And as I said at the beginning, it's all down to the psychology. So why are people not buying back here in 2018 at 3k or down here in the middle of 2021 down at 30k, or even here at the COVID crash when we were around 4k in March 2020. The reason is because the narrative completely changes. Down here, it's all Bitcoin's going to zero, it's never going to recover, it's done this, it's done that, there's new regulation coming. Any news is bad news in a bear market, because no matter what comes out, it's going to put you off buying, and you think even though your risk reward is so much better here, you are scared to buy. Down here at $3,000 2018, you've looked at where it was before and you think, I don't want that. It's already dropped from 20,000 down to 3,000. I don't want to see it go to zero. And that's the mentality that the herd has. People in general, that's the way they'll look at it. They'll see it dropped from 20,000 down to 3 and they'll think it's going to go to zero next. And as we know, that isn't the case. And likewise, why aren't people taking profits at the top? How many, it may have even happened to yourself listening to this video, but why aren't we taking profits? Obviously you're not going to nail the absolute top, but near the top. Why aren't people taking profits near the top? And it's because of greed. Again, just as powerful an emotion as fear, but greed, it's that thought of, this is going to go up to 100k, 200k, 300k. I'm not selling now. This bull market's only just started. It's going to go on forever. And as I talked about in my investing journey on the first course, I was exactly the same. I was here in 2017. I was riding this wave. I got in August. So back here, not the best entry when you look at what came previously. However, still loads and loads of upside. And why wasn't I taking profit here? I'll tell you exactly why. As I've just mentioned, I thought we were going to keep going up forever. It was inconceivable to me that we would get back below $10,000. Never thought it would happen. And all through this 2018 period, I was just waiting for the bulls to return, for us to continue. And every time we had this little bounce up, I thought, here we go, we're going back again. And every time it just kept getting slammed down. Pretty similar to what's happened this year in 2022. So you're fearful to buy at the bottom and you're too greedy to take profit at the top. And as I say, that also counts for trading as well. You're too scared to buy when it's the most buying opportunity, and you're too scared to miss out on profits at the top. And these fear and greed emotions can also work in reverse, just to make things even more complicated for you and even more difficult. So greed can also take place at the bottom, and fear can also take place at the top. So we can actually just switch this around and talk you through the narratives of why fear and greed can get switched at the other extreme. So down here, again, I experienced it myself. I was waiting for prices to go lower here at 30k. It was greedy. Waiting for lower prices so you could buy more, not because you were scared of it going low, but because you wanted it to go lower. And again, that's what sometimes causes you to miss out on the opportune, on the most extreme opportunities. And likewise, fear can also occur at the top. Another reason why you might be selling is because you don't want to miss out on future profits. So you think, well, if it's going to go to 100k here, I don't want to sell here at 65, 69k. I'll miss out on so much. So it's not just the thought of, oh, how much more can I make? It's also that fear of missing out on what you make. And speaking of fear of missing out, that's also what causes these huge run-up in bull markets. It's people feeling like they're missing out on making money. And that's why the very extremes and the quote-unquote blow-off tops are so painful, because the people that get in right at this last minute are the people that have ignored it, and it finally gets to a point where they just can't ignore it any longer. And again, you can then switch it back to the original fear and greed, and it gets to this point here, and they're like, I can't ignore this crypto, this Bitcoin any longer. Everyone I know is getting rich, making money. I should have got in earlier, but this is the only time I can get in. I've just got to get in now. And then boom, that's when the bubble pops, and it just keeps coming down, and people will just hold on. Very similar. I've been very open about my experience 2018. That's exactly what I did in 2018. I just held on, and we came all the way down to the bottom. So be aware of those two emotions, that are fear and greed. As I say, it's not just in investing, it's also in trading as well. But that is a quick summary of what a bull market and a bear market is. and why people find it so difficult to do the simple thing, which is buy low and sell high, and the two key emotions you need to be aware of both in trading and investing. So in this video, we're going to go through some basic candle theory and basically how to read a chart. So it's kind of like reading music, in my opinion. So, you know, people can look at a chart and sort of go, oh, well, yeah, price is going up, price is going down. But to actually understand what a chart is telling you, it's almost like a language. And as I say, kind of like reading music. The more you understand and know, the more you're going to get out of it. So the first thing we're going to go through is basically how to read chart candles or candlesticks. So we are currently on default chart, as you know from previous videos. We are on what's known as the weekly time frame. So what that means is each one of these candles represents the price action within a week. So if you just highlight, say, this candle right here, as you can see at the bottom, I just moved it, that is Monday the 28th of November 2022. So that is all the price action that happened the week beginning Monday the 28th of November. You can change your time frames up here: 1 hour, 4 hour, 12 hour, daily, weekly, monthly, etc. You can choose what time frames are applicable to you, what ones you want to use, etc. But basically that means that each one of these candles represents what that time frame you have selected. So if you go down to the 1 hour, each candle will represent 1 hour's worth of price action, etc., etc. So what we're going to do is we're going to zoom in and talk about how to read the price action. So if we take this small cluster of weekly candles here, so what we're going to go through, if we just highlight this candle here, again, Monday 28th November. Now, if you look at the top of the screen, sort of left to center, or left of center, you can see some letters and numbers at the top there. So it'll obviously tell you the trading pair, which is Bitcoin US dollar on Bitfinex, and then it has a couple of letters and numbers. So it has the letter O followed by 16,436. That is the opening price. So the price at the start of the week, or the opening price, was 16,436. H represents the highest the price went in that week, which was 17,335. L represents the lowest price of the week, which was 16,002. And C represents what the price was when the weekly candle or the candle highlighted closed, which was 17,127. Now again, if you go down to other time frames, they will show you what the opening price was on that time frame, the highest, lowest, and the close, etc. So what we can see is we know this is a quote-unquote bullish candle, i.e. price closed higher than it started at the beginning of the week. One, because it's green. Obviously you can change your chart colors as you wish, but this is default. So it's green, which means, as I say, price closed the week higher than it started. And what you can use a candle to do, as I say, the opening price here was 16,000. What did we say? It was 16,436. So this was the start of the candle. This is where the candle opened. This was where the candle closed, and we refer to this as the candle body. So the filled in part of the candle, that's the candle body. And as I say, that shows you the open and the close. And then these, what we call candle wicks, the little thin bits that are sort of below and above the candle body, they are the extremes. So the lowest and highest that the price went that week. So as we say, on the 28th of November week, the lowest price went was 16,002, which was represented by this bottom wick here, and the highest price went was 17,335, which is represented by this wick here. Now, the difference between a bullish and a bearish candle, as we can see if we highlight two candles over, which is the 12th of December 2022, it is red, and the reason it's red is because price closed closed the candle or ended the week lower than it started. So if we highlight this candle, as I say, 12th of December, you can see it opened at 17,101. The highest it went was 18,391, represented by this big wick here. And then the lowest it went was 16,550, again represented by the wick down at the bottom. And then finally the candle closed at 16,755, represented by this bottom of the candle body there. So that's the difference between bullish and bearish candles in terms of your traditional candles, and that's how you can read the price action of a candle. So the thin wicks are the highest and lowest, and the bodies are the opens and the closes. And as I say, if you scale through the time frame, so if we go down to a daily, for example, you should then be able to read what happened in that day. And also, if we just grab a weekly candle and just sort of grab a box. Now, you can't do it super clean because it goes into the middle of each candle. But if we just put a box around this weekly candle, the 12th of December, and then go down to the daily, you can see that it highlights the days in that week, and obviously half of the week before and week after, because as I say, it doesn't do it cleanly. Unfortunately, it goes halfway between each. But as I say, it just represents that week is made up by those, and then if you highlight the day and then go down into the smaller time frames, etc., etc. So a bit like Inception, really, if you've seen that film. But the next thing I want to go through is there are different types of candles. There are different ways of looking at price action. So the three most common, as I've just gone through, is the traditional candles, and the other two. So first of all, you've got Fibonacci. So there are strategies of utilizing this, and as I said at the beginning of the course, just because myself or Ash doesn't use it doesn't mean it can't be used, or there isn't ways of making money using it. But Fibonacci basically works off of momentum. So as you can see, what generally happens is you get these trends of red and green, which are as opposed to the traditional candles, which sort of seem quite random. It can sort of go red, green, red, green, red, green. Whereas the Fibonacci, as I say, you get these sort of long runs of momentum. So it's quite a common misconception that people will discover Fibonacci candles, go, oh my god, this is so easy. You just have to wait for a green candle and go long, wait for a red candle and go short. But it's not actually that easy, and the candles can actually be quite deceptive. It's not the same as traditional candles, i.e. the candle bodies and candle wicks don't actually represent the same prices that the traditional candles do. So what you'll find is that if you were actually to try and get in on the first green candle, you wouldn't actually get like the bottom of the candle as such. You would actually end up somewhere near the top, and things would drop off quite quickly. So the way you read Fibonacci candles, as I say, they don't follow on from each other like traditional candles do. So as you can see, where the previous candle closes isn't really where the next candle opens. So it's quite an obvious one here on Thursday, the 28th, July 22. You can see that the candle closed at 23411, or it's at 23393. And then it opens all the way down here at 22662. So whereas if you quickly switch back to traditional candles, you can see that where the previous candle closes is exactly where the next candle opens. So as I say, it can be quite deceiving when you go onto Fibonacci, but there are methods to use. It is a good momentum indicator. However, not something I use too often. And the third one, which is quite useful, especially for beginners, is line. So this doesn't have any candles whatsoever. It's probably the easiest to read, but doesn't give you that much information. But it can be useful for spotting some really obvious trends or some areas of support and resistance, and potentially to be used along with an RSI as well, which we'll cover in another video. But as you can see, this basically just simplifies it down to price into a line, and you can just follow that. And as I say, it's really good for being able to identify levels of support and resistance as well, or higher highs, higher lows, lower highs and lower lows, which again, something we'll come on to in future videos. But nice simple way of just being able to see what the general direction of price is, and what's happened previously, but doesn't give you as much information as the traditional candles, which is what we like to use when we're trading and investing. But just a little insight into the three different ways of reading a chart, and the information you can get out of the traditional candles. So before we get into some technical analysis and getting our hands on some indicators, I thought it'd be a good idea to quickly go over some common abbreviations that you're going to see either throughout this course or you might see on social media, other people's analysis, stuff like that. So first of all, you got the chart structures. So 15 min refers to the pretty self-explanatory, the 15-minute time frame. You can, 1 min, 5 min, 30 min, it all refers to that minute time frame. And of course, following on from the last video, you should know what those time frames refer to. H1 or 1HR is 1 hour time frame, same with H4, 4HR, 4 hour time frame, and again it's the same with its 2, 4, 6, 8, 10, 12, etc. Daily time frame can either just be a D or the word daily, W or weekly for the weekly time frame, M or monthly for the monthly time frame. Levels of support and resistance, which we'll come on to next, can be highlighted with just the letter S or the word support, or letter R or the word resistance for resistance. HTF refers to higher time frame and LTF refers to lower time frame. So based on the individual, but generally it's thought that the higher time frame refers to weekly, monthly, and if you're looking at traditional markets like yearly and stuff like that. Lower time frame is generally intraday, so anything lower than the daily time frame, and the daily is sort of like that sort of grey area, somewhere in between the lower and the higher time frame, depending on the individual. R&R refers to your risk reward ratio, which is often used when looking at a trading setup. SL is your stop loss, very important mechanism, which we'll come on to later. BE is break even, so you would potentially move your stop loss to break even. Basically means that if the trade goes against you, you can't lose any money. PA is price action, which again pretty self-explanatory, what's price doing. HH is a higher high, HL is a higher low, and LH is a lower high, LL is a lower low, and they will come into the picture when we go on to market structure. And then finally, indicators. So MA or EMA are moving averages. The E is for exponential. It's basically just a subtle difference. But when you see MA and you're talking about indicators or line on the chart, it's going to be a moving average. RSI is your relative strength index. Fib will stand for a Fibonacci retracement tool. VOL is volume. Your MACD is your moving average, convergence, divergence, and BB will refer to Bollinger Bands. So if you see any of those abbreviations when you're perhaps reading about trading or seeing it on social media, this guide should help you figure out what they mean. Levels of support and resistance. So for me, support and resistance is the most important fundamental of learning charting and technical analysis. For me, it's what everything is built on, and it's the most important thing to learn, definitely for a newcomer as well. If you're going to learn anything in terms of investing or trading, the first thing to learn, in my opinion, is support and resistance, because everything else is built on top of that. It is literally the foundations on which technical analysis is built. A lot of people can come into the space or even traditional trading and investing and get blinded by indicators, thinking that they're going to do all the work for them. But in reality, all indicators and market structure, it's all built on support and resistance. So if you can understand the concept of support and resistance and be able to identify levels of support and resistance, it is, I believe, the most powerful tool in your tool belt. So what are levels of support and resistance? So if you imagine a house, standard 2-story house, you got floor, second floor, and then the roof. Your support will be the floor, and resistance is basically the ceiling or the roof. So much like in a house, you go in on the ground floor, you've got the actual floor itself would be support, and then the ceiling would be resistance. And then if you were to go up the stairs, suddenly what was previously resistance, which was the ceiling, is now support, because that's now the first floor. And then your resistance is then the roof. And that's pretty similar to how price action goes. What you'll find is that previous resistance can become support, and vice versa. So why is that? It's because support and resistance is the area where there is a lot of price interest. So again, as I say, what you'll find is previous resistance becomes support. It is where price is going back to a previous level of interest where there is a lot of buying interest. So support is where the buyers outweigh the sellers, and resistance is where the sellers outweigh the buyers. And the most obvious examples of this are the tops and the bottom of charts. So if we go to this COVID bottom here in March 2020, the reason we bounced here is because there was more buyers than sellers, obviously. And actually, if we look across the chart, you can see a pretty easy level of support that was previously resistance, which is why we've bounced. So what we're going to do is go through some pretty simple examples. So we're on the Bitcoin weekly time frame. So if we just look across, we can see that this is a clear level of previous support and resistance. And what I mean by that is the way you can easily identify it's where price has basically stopped and turned around. So as you can see, we had this run up here from 1,905. We stopped here at about $4,600, and we turned around. We then come up, we broke that, and as you can see, this little candle wick came back, retested as support. We then came back down, we broke through it initially, then we come back up, break through, and then hold it as support, and then we hold it as support again back here in the COVID crash. So the easiest way I find to identify levels of support and resistance from like a blank chart is looking for where trends start, either bullish or bearish trends. So basically for me, 2 or more candles of the same color in a row, and that for me marks out a trend. So for example, we've got these 2 red candles here. So from the 8th of Jan 2018, and then the following week is also a red candle. I would say that is the beginning of a bearish trend. So I would plot a small line or box all the way across, and what you can see is all the way to current day, that is a significant level of support. So again, as I say, we came down, we come up, this is where price stopped and turned around, because obviously, I mean, we dropped all the way down to about 10k here, rallied up to about 16.5, price stopped and turned around, and as I say, we started that bearish trend. Now if we look across, this level came into play again as we rallied in 2020. As you can see, we rejected off it initially at the beginning of November. We then broke through and then came back, retested as support. So previous resistance broke, became support, and as you can see, price has come all the way back down, back to this level of around 16k from 69k. So huge decline, but as you can see, this level being respected despite how old and how previously tested it was. Another example, we can look at this level here. So the start of this decline in January 2018, again 2 candles in a row marks out a trend. So we can just get the top of that candle there, make a small box, drag it across, just there, basically to the start of this trend here, which is almost the same level in March 2018. As you can see, again, 2 red candles in a row starts a trend, and look across that line, look at all the rejections of this level of resistance here, all the way through June, July 2019, multiple attempts to break through, and it didn't. And this is, again, going back to candle body structure that we talked about before. You can see the importance of the candle body closes here. So yes, we got wicks that went through it, but we didn't get any candle body closures above the resistance. So that is an important thing to note. And again, all the way through here in 2020 as well, you can see we tried to break through, we got a little wick through, not enough, and eventually rejected until we finally come up and broke through back in October 2020. So the question is, will we see this level come back and be tested as support? Certainly, in my personal opinion, that is where price will go if we lose this current level of support at 16k. One final example, so we can see the start of this bullish trend here back in July 2017. Oh, sorry, not that one. This one here at the 25th September 2017. And if we make a small little box here, drag it across, you can see that that is the level that held up back in 2018. As you can see, that was the bottom of the bear market there. So as you see, these levels very well respected, quite easy to identify. Now, as I've said in previous videos, just because this is the way I do it doesn't necessarily mean it's the only or the best way, but it's just the method that has worked for me. In the next couple of lessons, we're going to go through how to use timeframes and the significance of finding these levels of support and resistance on the timeframes you find them, and how to use them for trading and investing decisions. Using timeframes and why it's an important factor when identifying levels of support and resistance. So if we go back to our previous lesson on candlesticks, you'll see that we're on the Bitcoin USD chart and we're on the monthly time frame. So quickly recapping that lesson, we know that each one of these candlesticks represents the price action of this asset in 1 month. So each of one of these candlesticks will be made up of about 4 weekly candles, around 30 daily candles, and about, let's say, 180 4-hour candles on average. So as you can imagine, a lot of time goes into making each one of these candles. And then if we're using the method that I mentioned in the previous lesson on how to identify levels of support and resistance, and we're looking for those bullish and bearish trends, the start of those bullish and bearish trends, which is 2 candles of the same color in a row. Each trend has taken, as I say, about 2 months, 60 days, etc. to form, and it's that aspect of time which gives it so much strength. So what that means is that the higher the time frame they go, the higher the time frame you go, the stronger the level will be, and therefore the more likely it is to be respected and either hold as support or resistance, whichever way around it is. So when we break down a chart and identify levels of support and resistance, we want to start on the highest time frame possible and then work our way down, A, because of the strength factor, but B, what you'll see later on in this video is it's also comes back to that factor of keeping our charts tidy as well. So what we're going to do, we're going to mark out a few monthly levels on this Bitcoin USD chart. I'm just going to stick to this 2017 to about 2020 cycle, just do a few levels here just so you get the point. We'll break it down, go weekly, daily, etc. So what I'm going to do is I'm just going to use the line tool as opposed to the box to make it a little bit quicker. And what we do is we start, as I say, on the highest time frame possible, and then we work our charts from left to right and go from there. So the first level we're going to mark out this one here, 1070. I'm just going to go template, make it a monthly, and turn the text on so you can see other stuff. And then, so as I say, start of this trend here, April 2017. Next one we've got is the start of this trend here on the October 2017, because we got this little break here during September. So start of a new trend here. So I'll quickly mark that out. And as you can see, this is a really, really key level. If we just take a quick look at this one. So marked out the level here, we go along. It tried to hold on the November 2018 on this huge down candle here. Lost it, and it then held as resistance after 1, 2, 3 months of trying between December 18 and Feb 19, and then again on March 19, didn't quite close over, and then finally broke over the following month on April. Huge rally, and then as you can see, it marked the bottom of the COVID crash as well back in March 2020. So really, really strong level there. Next level we're going to mark out is going to be this one here. So as you can see, we didn't get 2 candles of the same color in a row until we got down to this candle here in May 2018, and again a pretty strong level. As you can see, didn't hold resistance on the first time, broke over the top, held as support, then lost it, and then acted as resistance from September 2019 all the way up until June 2020. So really, really strong level there. And then once it broke over the top, came back down, held as support, and then went again and again. It's pretty much 10k, very strong round number psychological level as well. And then from there, the only other level I would probably mark out is this one here at about 6k, which is the start of this trend here. So what you'll notice is, yes, there are other levels that you could potentially mark out, but what you don't want, we're not marking out every single time there's 2 candlesticks in a row. So for example, this level here, what's that, 3,400. I wouldn't mark that out because it's too close to this 4,100 level, and what you're going to end up doing is making your chart really messy, and it's just going to get quite confusing. So it is obviously subjective which one you choose, but what I would advise is just look left and right at the chart, which level has been more respected. And as I say, if we quickly just put that level back on, as you can see, this hasn't really been interacted with at all, whereas this level here at 4,100, as we've been support and resistance throughout. So I would choose the one that has been respected the most. And also, if you were to just go and mark out every single time there's two candles in a row, it'd obviously be quite chaotic. So it's all about being selective of what support and resistance levels you use. And similar again to this level here at 10,400, you see, yes, that is the start of a trend. However, it's very, very close to this level of 9,990, which has been respected throughout. So just a little tip there on identifying those higher time frame levels. And now going back to our point about keeping things tidy, if we now break this down to the weekly time frame, you can see we've already got some levels in place. And you can imagine if we started with a blank chart and we started, say, on the daily time frame, go back to the 2017 cycle, you can imagine how many, I mean, just hundreds, if not thousands of two candles in a row trends to mark out, and you would just be like, where on earth do I start? Well, that's why we start on the highest time frame possible, on that monthly time frame, or if you're using trading forex, etc., you could probably use the yearly. But it just means that a lot of the work is done for us. So if we then go down to the weekly, we can then start having a look, right, what weekly levels make sense to us. So again, we're going to start on the left hand side and work our way across. So first one I would see is the start of this bearish trend here. Quickly make that a weekly. As you can see, resistance, held as resistance, broke over the top, then held as support, and off we went. Didn't quite make it down there in the December 18 drop. The next one, which looks really obvious, is this one here, which is the start of this trend, November 2017. As you can see, that is a huge level, but just under 6k. Support, broke through resistance, and then it didn't quite get respected back here, but it was a pretty big level back here. And to be honest, what I'd actually do is I wouldn't have this level on my chart anymore. It was obviously very well respected back here, but more recently it hasn't been, and we've now got this monthly level here at 6180. So again, that's an example of keeping your charts nice and tidy, keeping them updated. What's the most recent and most respected level? And for me, that level is no longer relevant, but you can see how relevant it was in the past. Again, if we sort of make our way up this huge trend here, because that was the start of the trend, we've got nothing else. First one would be this one here at 16.3, because it's the start of this bearish trend. Oh, nearly missed that. And again, if you look across right, you see how it was respected here in November 2020, broke over the top, came down, perfect retest of support, and off it went. Next one would be the start of this bearish trend just here at 11,975, and again you can see how well respected this level is. If you look across, resistance all the way from June 2019 to August 2019, and then again July 2020, August 2020, until we finally broke over the top. Didn't actually get a bullish retest of that, which is fairly surprising, but maybe we get that retest in 2022. As you can see, we are just about hanging on to this 16. In fact, I didn't show you that just a minute ago. That level we marked out just a second ago, that is the level we're currently sat on current day in December 2022. So you can see how well respected these levels are, even a year or two or three later. So yeah, that's just a quick example, guys, of how we break down our charts. And then if we were to go into present day and look at the daily time frame, again, a lot of the work is done for us. In fact, no, not go present day. Let's go to where our levels are marked out. So if we were to be here in sort of July 2020, October, September, etc., you can see that a lot of the work is already done for us by the time we get down to the daily time frame. So we're not sort of thinking, oh, where do we start? What do we need to mark out? It's already done for us with these higher time frame levels. And as you can see, I like to color code mine. So monthly is white, blue is weekly, and then I use red for daily, etc., and work my way down. The other thing I do, as you can see, I've got templates. So I've got a template for each one. So my monthly levels are visible on all timeframes. You can check that by going on visibility. If I then change to a weekly visibility, you won't see my weekly charts on a monthly time frame, and I'll just show you that in a minute. So levels like 11,975 and 990, if we go to the monthly time frame, you will see that they are not visible. And again, it just comes back to that point of keeping our charts nice and tidy. But then if we go down to the daily, and let's just mark out some daily levels. Let's go in here where we've got a lot of the work done for us, as I say, with the weekly and monthly levels. So again, we'll look at where some trends have started and some support has flipped to resistance. So you can see this little trend here starting on the 12th of August 2020. You would mark that out, and as you can see, support, lost, come back as resistance, tested again, broke over the top, again tested support, and off it went. And again, I would mark that out as a daily, and then we can go on to text, and then, as I say, visibility. It's not visible on the weekly or monthlies, because you could imagine if you mark out quite a few daily levels, as you probably would, then you go on to the monthly time frame, you've got all your monthlies, all your weeklies, all your dailies, and it would just be a complete mess. So that's why we like to keep it simple and keep it nice and clean. So little lesson there on how we break down our charts and our levels of support and resistance from a monthly down to a daily time frame, and you'll see more examples of that as we go through the course. So now we know how to identify levels of support and resistance, we're going to use them to start going into a bit more deeper detail into identifying market structure. So the first piece of market structure we want to look at is, are we in an uptrend or are we in a downtrend? Similar to our previous lesson where we're looking at bull and bear markets, we're now looking at it in a much smaller scale. So is current price action in an uptrend or a downtrend? Back in the previous video, we were obviously looking at weeks and months at a time, bull market and bear market. Now we're looking at sort of intraday trends and where the price is in the moment. So we're on the daily time frame on Ethereum for this one. Price action back in between 21 and 2022. And what we're going to do is we're going to use our levels of support and resistance to identify whether price is in an uptrend or a downtrend. And the way we identify that is seeing whether price is making higher highs, higher lows, lower highs, lower lows. So in an uptrend, similar to how we identified a bull market on the high time frames, if we're in an uptrend, as you can see here, perfect example, price is making higher highs and higher lows. If we're in a downtrend like this leg of the move here, price is making lower highs and lower lows. So how do we know, or how do we identify what's a higher high, a higher low, a lower high and a lower low? So we're going to be using the exact same method that we use to identify levels of support and resistance, because that's exactly how we identify it. We use levels of support and resistance. So what I'm actually going to do is I'm going to use what's called the replay tool on TradingView, which is a really cool tool because it means you can go back in time and play things as if it's happening in the here and now, so doing it in real time. So what I'm going to do, I'm going to start it just here. All right, now obviously it's a little bit in hindsight because we sort of know what happens, but I'm going to talk you through how we would look at price action and identify whether an uptrend or a downtrend sort of in real time. So we've not done any of the higher time frame levels for this one, just because I want you to concentrate just on what's happening on the daily time frame, and again identifying these higher highs, higher lows, lower highs, lower lows, and identifying these trends in price action. So first thing I would do here is I would say, right, where is my support? So going back to that house analogy, where's the floor, where's the ceiling, and where do we need to break over to access the next floor, should we say? So first of all, the floor, I'm looking at this start of the leg of the move here. So again, 2 candles in a row, this is the bottom, and actually if you look left, it's a pretty solid level of support. So I would mark this out here, obviously set it to daily in red, and I'd say, right, this is the level price needs to hold if we want to stop this downtrend and start becoming an uptrend. So what's the resistance we need to break? So the high that we need to break would be this one here and this one here. So they're pretty close together. So I would personally just go for this level just here, just because it's slightly higher and more significant. And actually what you can actually see is if you look left, that is actually that level there, that previous level of support which has come across there. So that's nice clean levels there, pretty clear and obvious. This is our support. We need to hold this if we want to go up. And if we are going to bounce from here, we need to break this level to make a new higher high. So here's the sort of inflection point. At the moment, this is our low and this is our high. If price is going to break this level and make a lower low, then the downtrend continues. If price is going to break above this level resistance and make a higher high, then we're going to potentially start forming an uptrend. But what has to come after the higher high is the higher low. So let's just play this out and see how we go. So we're going to go one candle at a time. And here we go. So price has bounced up off this support and we've now broken this high and we're looking to make a higher high. And the way I identify that is once a candle has closed above and held it as support, potentially, sometimes you get a retest of support, sometimes it just goes. But for me, once a candle has closed above, that is a broken level. So we've now made this higher high. Now can we make a higher low? Let's have a look. Up it goes, up it goes. Okay, I'm going to stop it there. So this level is clearly broken and it looks like we're about to form a high low here. In fact, let's just go one more bar. There we go, perfect. So that's now created a new higher low and we're also looking to break this next high. So once we've broken this, we can get rid of that and move it to where's the next high. So it would have been there, and as you can see, broke above, and there we got the retest, held as support actually twice. Happy days. So where's the next high? Our next high is just here, and now we've made a new higher low. So I would move this level of support up to here. As you can see, 2 candles in a row. Lovely. So we've made several higher highs because these levels of resistance we marked out, and we've now made our first higher low. So price is in a pretty nice uptrend here. So again, where's the next level? If this breaks, the next level I would be looking at for a high is, if we look left, it would be this level here, as you can see, previously tested as resistance, and then we'd be looking for it to form another higher low. So let's have a look, see what happens. Tested resistance, rejected, and boom, now we've made another higher low, as you can see. So I would be getting rid of this level here, and I would just keep this level here, even though that's made a new higher low there. I'd rather just keep this level. Again, it goes back to being subjective, but this level was previously tested, both a resistance and a support there, but we can see visually that that is a new higher low there, and we are making higher highs again. So where's our next level of resistance for a higher high? So we've done that one. It will be this one just here, or you could even go just here. There we go. So you've actually got a start of a trend there, and here as well. So I would just go for this one. Again, subjective, but you can see this was previously tested as resistance and it's slightly higher than these two. So again, I would just see that as being more significant. And also, if we look right across from left to right, that looks like a clear level of resistance. It's the highest body closure as well. So for me, that's my new high. But as you can see, we're still making higher highs and higher lows. Let's see what happens next. Breaking above, held as support, No new level yet. No new higher low coming down again. And there we go. We've made another higher low, as you can see. If we just move that to there, you can see that's our new higher low. But again, I'd be leaving this level of support there, because again, look how cleanly we retested that. So nice level there. We can get rid of these now. And we are looking to break. So now our new high, if we look left, there's not really anything here. This is just one solitary candle, so I wouldn't count that. But we've got this trend here, these 2 candles in a row. So again, this is our new high, and as you can see, we've got like 4 candles here, so it's a pretty clear high. So if we want to continue this uptrend, we've made a higher low. Can we go ahead and make another higher high? Let's have a look. And you can see as I'm going along, guys, I'm keeping my chart clean and tidy. Only the levels that are necessary. And here we go, test, boom, and away we go. So as you can see, we made a tiny little trend here, but for me, that wasn't it wasn't enough to sort of define that as a new lower high. We'll get into that in a minute when we start getting on downtrends. But as we can see, we made another higher low. So from this level here, we made this higher low, and then we've made this higher low more recently. And as I say, we've now made another higher high. So where's the next high? Ooh. Our next high to aim for to be making higher highs is up here, the start of this trend. So let's see where price goes from here. Up it goes, nearly there. Wow, okay, big drop. And as you can see, price came down and hit this level of previous resistance, which has now flipped to support, as you can see, twice in a row. And you can see, even though we sort of know what's going on, it's when you go back and play on the replay tool, things can still sort of take you by surprise. So it is quite a good tool for trying to go back and trade in real time. As you can see, both these levels of support hit, and this is where candle closure is important. And again, going back to our previous lesson on timeframes, what you'll find is, so if we so this is obviously on the daily time frame. If we go down to say a 4-hour time frame, you can see we've got one candle closure here below the daily level. But this is where timeframes are important, because the level can only be broken on the time frame that it's formed on. So it doesn't matter what time frames or what candles on lower time frames close below these levels. What's important is the candles on the time frame you find it on. So a monthly level can only be broken on a monthly time frame, a weekly level can only be broken on a weekly time frame, daily level can only be broken on a daily time frame, etc., etc. So that's another thing to keep in mind when you're going through your time frames. And again, that's why I color code my levels, so I'm aware of which time frame each level is found upon, and therefore what candles are important to pay attention to. So that's a nice little demonstration there of coming back and testing previous resistance, which now flipped to support. Now our new high is still the same up here, but we've got another one slightly closer. So I'm actually going to mark that out just here. Now potentially we've made a lower high here, depending on how price goes. Okay, so this is our first example of a potential lower high here. But let's see what happens, see if this level continues to hold, and we see if we go up and retest this high. Okay, so now we've broken that level, come up and tested a resistance again. Okay, right, let's stop here. So getting a little bit messy, as you can see, we broke this level of support 3340. We come up, test a resistance, broke it again, come back down. But as you can see, it started to knock. It stopped being respected as a level. However, this level very cleanly respected at 3142. So I would be, once I sort of see this 2 candle bodies crossing a level, I start to think, that's not really getting respected anymore. Again, depending on the time frame that it happens. So I'd be getting rid of that, and I'd purely just be focusing on this level. So again, if we look left, this is quite an important level in terms of structure, market structure, because if you start breaking this level, that's when you're going to start making lower lows. Okay, so as you can see, all the way up here, we've been making higher lows, higher highs, higher lows, higher highs. And this level here, as we come down, this level stopped us from making any lower lows. We're still holding this level, and as you can see, we're actually still making higher lows from here as well. So we just move that up to there and to there. Okay, but we're going to keep that level just there for now because, as I say, subjective, this is clearly an important level both for structure, and it's been tested 3 times, held up really well. In terms of our new highs, so as you can see, we've got another high here which could potentially be, and well, it's another lower high. So what you've got here is price is starting to, the price needs to make a decision. Is market structure going to break to the upside or the downside, or potentially we could just see it range sideways? That's for another lesson. But what we've got here in the moment, we've got this original high here, this leg of the move. We've got a lower high here, so potentially a downtrend, but we're not making any lower lows yet. We're still making higher lows. So we've mentioned this level, we're still making higher lows here, and we're breaking this local high here. Okay, so we could still be we are still in an uptrend. So let's see what happens. Okay, we're back below that level, coming back down. Okay, so now this is important. So yes, we broke over the top, held it at support, but then we lost it. Okay, so that is now our new lower high. So now we've got 3 lower highs, or we've got an original high and then 2 lower highs. And as I say, this level now, very important through 142. Now it's looking like we're breaking this and making lower lows. So this is very important. Where can we not let price break next? If we want this uptrend to continue, it'd be this leg of the move here. And again, plenty of support to the left of it and to the right, in fact. We've got a pretty good level just below it there as well. But we'll keep it local, and this is the level we need to make sure we don't hit. So if we get another candle close beyond this level, then that will be done. Right, okay, so this level is no longer support. We can get rid of that. This level, as you can see, it held for the first test and then broke on the second. So now, what's the next level we can't afford to lose? Or, well, not afford to lose. What's the next level that would carry on the downtrend? So this would be the next level of support. If we break that, we're making lower lows again. So as I say, lower, so we've got high here, lower high, and now we're making lower lows. First of all, this level, and then the next level. So let's see where we go from here. Okay, looks like a reclaim. We've put in another low. Okay, so now I would say, right, this is now the low we need to focus on. So we didn't get down to this 2455, so let's move that to there. And again, this is now the important level. This level 2955 is still resistance. And in terms of a high that we need to break, it's actually going to be, in fact, I would move this now. So we've got this level here, but actually if we look left, that's exactly where previous support was. So we're back to this level 3142. Crazy how some levels just remain respected. But you can see that was our key level before, support. Now we've come up, bang, tested it as resistance, and it's the start of this leg of the move. So again, this is now our high we need to break. If we want to start forming an uptrend again, we need to hold this low and break this high. So let's see what happens. Okay, held as support again, resistance, consolidating, break over the top, and bang, there we go. So actually we've got another small high here that we forgot to highlight. So we need to be breaking this level to then go onto that level, to then go onto that level, to then go onto that level. So nice break of resistance there. So now again, you can see we put in another high low as well from this level here. So higher low, and now we're making higher highs as well. So it looks like the uptrend is back on, but we now need to take out these lower highs to continue the uptrend, which have now become resistance. So let's see what happens. Test the resistance, breaking above, boom, and held as support as well. So there we go. So we can now tidy our charts up a little bit. We can get rid of this, because now this is the level we want to make sure we hold. And as you can see, we put in another higher low just here, start of this trend. So let's see where we go from here. Can we break resistance and carry on? Test it again. Oh, testing support, holding for now, and broken resistance. Okay, happy days. So again, we've put in another higher low here. So where was our previous higher low? Our previous higher low was here, and then we've just made another one here. So happy days. We've broken our higher high. This will now become support, and now we're targeting this next higher high here. So you can see how we switched from downtrend to uptrend. just by putting in these higher lows and then breaking the previous lower highs to create higher highs. So let's have a look what comes next. Test resistance, held a support, boom, breaking through. Wow, that's a good move. So we can now get rid of all of this down here. That's no longer of interest to us. We've broken this level of resistance, and we've actually tested this high here, which was our original high. And so now we'll see, can we go ahead and make new highs? In fact, at this point in time, well, I think we're at the top of the 21 cycle. So let's see what happens. So held support, breaking, hold it above, and breaking below. Let's go one more. Okay, it's getting a little bit messy. All right, let's pause it there. So what happened? We were flirting with this level of resistance. In fact, we can actually knock that one up. When we broke above here, we held it support. So then our next high would have been the absolute all-time high, which was just here. As you can see, we're testing that. We held this level of support. Actually, we got a close below, but then we immediately come back up. That can be referred to as a deviation, so that's why I usually wait for a second candle to confirm whether it's been lost, or basically if it comes up and we see if it holds as resistance and rejects. Sometimes you can get these little moments here, but yeah, we then came up and tested this high here, and as you can see, a perfect test of the high just here back on the 21st of October. So let's see what happens. Are we going to make a higher high? No, rejected. Oh, there we go, and there's the higher high. Is it going to come down, hold support? It is. That's another higher low, and away price goes. So I think you get the picture now. I think we'll leave it there. As you can see, uptrend pretty clear to see and mark out. You just look for these two candles in a row. So for an uptrend, you're looking for two green candles in a row successively for marking out the higher lows. For bearish trends, you're looking for two red candles in a row to mark out your lower highs, and then your lower lows occur when you break these legs of the move, these start of the uptrend, and lower highs occur when you start making new bearish trends. So and higher highs, sorry, is the one I missed out. Higher highs is obviously when you break these previous levels of resistance, these previous highs, which were lower highs, and then they become the higher highs. So hope you understood that. Hope you took it all in, and we'll obviously be using this in future lessons. So in our last lesson, when we were looking at market structure, we were looking at some quite aggressive trends. As you can see, we're back on BTC. So aggressive trends, really fast moves up, really fast moves down. Now, obviously, price action isn't always that clear or that action-packed, shall we say. Sometimes there are boring time periods in trading, not just in crypto, obviously in traditional markets as well. And sometimes you'll find that price ends up being in a consolidation range, where pretty similar to this example here of Bitcoin back in the bottom of the bear market in 2018 going into 2019. Very, very flat, as you can see, comparing it to this mania that sort of happened in the 2017 run up and then the 2018 bear market. Towards the end of the year and start of 2019, as I say, things got a little bit boring, and it's not a coincidence that this happens just before things flip bullish again. This is where a lot of money is actually swapping hands. So people get bored, people capitulate, and people hand over their assets to, let's quote unquote, strong hands or smart money, etc. So there is obviously a different way of trading this environment as opposed to aggressive trends, and that's when you start looking at ranges. So if we just zoom in to the bottom here and show you how we look at ranges. So again, similar to in our last lesson, we're going to mark out where's our lowest level, i.e. our low, and where's our high. So our absolute low is the start of this trend here. Again, we're on the daily time frame, so using red for our levels. So this is our low here. Okay, we don't know whether this is going to break or not, but so far this is the lowest point. If we start breaking that again, back to our previous lesson, we start making lower lows, etc. But at the moment, this is our low. And then we look up, where's our high? So the high is starting trend again. So you've got one here, and then we come down, not a trend. So here, this is the start, and this is the start of this leg that actually brought us down to the bottom as well. So we would mark out this level here. There we go. And as I say, we've got this sort of area here where there's a lot of resistance. So I would say this is the top, and that is obviously confirmed as well by this little test and rejection here. So we've got the bottom of the range and we've got top of a range. Now we need to mark out the mid-range. So there's two tools you can use. You can either use the Fibonacci tool, like so. So you go from low to high, and then what you can do to tidy it up, I'm actually going to get rid of all these numbers apart from the 0.5. Obviously going to keep the top and the bottom, which is 0 and 1, and I'm going to get rid of those and just have the 0.5, because that, as you can imagine, is the middle. Or another tool you can use is the date and price range. Again, you just go from bottom to top, and as you can see, it's got a built-in basically middle of the range there. So either one of those will do the job. We've got the fib on here, so as I say, this marks out our mid-range. And going back to that house analogy we used right at the beginning, this is our floor, this is our ceiling, this is what would be, you know, the ground floor ceiling or the first floor. So again, going back to that analogy, what we would be doing is you want to be long in the bottoms, short in the tops, and then this level here, this mid-range, as I say, you could either try and short it when it comes up as resistance. Once it flips to support, then you can go long, and again, once it comes down, you can try to long it as support, or once it breaks down like we have here, then it becomes resistance, and then you can short. That's how you would play that. And actually, if you look, you can see that one of our levels is actually the perfect mid-range, which is just this level right here. So you can see it a bit more clearly when we move the fib, but this is our low. That is actually our next higher low, because as you can see, there's no next trend there. There's no two green candles in a row until this point. So this would actually, if we were just doing trend work, this would have actually been our level anyway. And if we get rid of the fib, you can see that this is a perfect level of support and resistance. So not only is it a level that we would have identified anyway, as I say, it would have been our higher low, and then as I say, we break it, it becomes resistance, so it would remain on our charts. It actually becomes this high here as well, and this leg of the move, etc. But not only is it a level there, but it's got that confluence of being the mid-range of this range as well. So again, as I said a little bit earlier, you would be looking to long the bottom, short the top until we break out, and then it's obviously broken out of the range. Let's get rid of those and go to another example, which is present day Bitcoin. Let's reset the chart. There we go. So this is present day. As you can see, we're in a phase now where it's a little bit boring, a little bit rangy, pretty much sideways, no aggressive trend in either direction. So again, we're going to mark out our top, mark out our bottom. So our bottom is clearly defined by this point here, and our top, now what we could say is that it's here. However, if we look left, you can see that there's a start of this trend here, which actually has a little bit more confluence in terms of being a resistance as well, because we've not got a close over. We've got that rejection there and fallen back into the range. So that would actually be my range high. And then again, we've got to find the mid-range. So we'll get our fib tool back out again, and just go here. And again, look at that, perfect. There's a level that we would have identified ourselves, with it being a high here and a high here. So we can mark that out, perfect mid-range, and there we go. So again, you'd have had this as the range low, this is the range high. we've come here, we can't break this low, we come up, we reject, you could have shorted the mid-range, you come up, once we've broken back above, you can then think, right, okay, if this holds as support, we can long this back to the range high. Boom, that's what happens. You could have, again, it's all very easy in hindsight, but just showing the how a range works. You then look at shorting the range high. You probably wait for this to confirm. Again, going back to the lesson on when levels are broken, we didn't get a daily candle close above this daily level, so it remained resistance, and on that rejection you could gone short down to the mid-range level as your TP1, and there you can see that. You see we're battling it at the moment. It looked like it was lost, reclaimed, and again there's that deviation, and the same thing happened here. Deviation is basically where initially the level looks to be broken, but the very next candle comes up and reclaims it, so it doesn't actually count as a fully broken level. And again, you can see we've deviated it again here, and now we're holding it as a support still. So obviously it's current day, I don't know what's going to happen here. We'll just have to wait and see. But at the moment, a play could be simple range play. You say, right, well, I'm going to long here and I'm going to look for the range high. You could obviously take TPs along the way, just look left for previous resistance, and for me that previous resistance would be just there. As you can see, resistance, broke above, held as support, then lost. So that would be sort of TP1, and then you can have TP2 at the range high. Likewise, if we break below, you'd obviously jump out of your long if you got into a long, and then you could look to try and short down to the range lows. So a little less there on ranges, consolidation ranges. As I say, its price isn't always up and down like a yo-yo, fast-paced action. Sometimes you get these long, boring sideways consolidations, and this is how you trade them. You just look to long the bottoms, short the tops, and obviously be aware of the mid-range, where it is, and how to utilize it. One very good phrase to remember is don't diddle in the middle, which is quite a good one. It basically means unless you're getting in on one of these entry points, whether it being the bottom of the range, top of the range, or the mid-range, don't make an entry unless it's on one of those. Like, don't try and get in here because you'll just get chopped to pieces. Try and identify those ideal entries, which, as I say, will be the top or bottom of the range, or if there's a reaction at the mid-range. So, as I say, remember, don't diddle in the middle. Working with trend lines. So trend line is simply, as the name would suggest, a line which shows you whether price is in a bullish or bearish trend. They usually can be used to identify or, quote unquote, predict where the next lower high or higher low might occur in that trend. But there's a lot of common misconceptions when it comes to people using trend lines. For example, the biggest one is that people expect that once a trend line has been broken, that you're then going to see like a huge move to the upside or the downside, obviously depending on which trend line has been broken. In my experience, that's more often than not the case. So it's much like with the breaking of regular horizontal support and resistance levels. Yes, sometimes you are going to get like a huge move once a level was broken, but that's not simply because it's, price has broken out of a diagonal line. There'll be other factors as to why that's happened, and you'll see as we go through the video that just because a trend line's been broken, that doesn't mean you're going to get a huge move, because otherwise things would be highly predictable. As well, when it comes to marking out and identifying your trend lines, much like with our lesson on identifying levels of support and resistance, I have certain rules that I use to identify trend lines. Otherwise, if you didn't have rules, as we said before in that previous lesson, you could literally plaster your chart with hundreds of different levels and trend lines and geometric shapes, but it doesn't necessarily mean it's going to be accurate. It doesn't help you then mark them out in the future, because if you don't have your rules and you're just putting random lines on there, that doesn't really mean anything. So my lines are as follows. Again, I will do things differently to other people. Everyone's going to have their own subjective way of doing things. There's no perfect way to do it, otherwise everyone would do it the same way and the markets would literally cease to exist. So my rules, as you can see on the screen, I go wick to wick, and I do the most recent. This will all become clear when I start marking them out. So a bearish trend line, as you can imagine, is swing high to swing high, and a bullish trend line is swing low to swing low. I tend to check the accuracy on the lower time frames. So when you're marking out trend lines on the higher time frames, you're going to want to go to the lower time frames and just make sure that you're actually connected to a candle, because sometimes where you go from wick to wick, you can go down to the lower time frames and it'll not be connected. So the reason I like to go wick to wick is because it contains, much like with my levels of support and resistance, it contains all the information in that candle. Some people like to go body to body. If you are going to mark out your trend lines body to body, make sure you do it body to body or wick to wick. Don't do it wick to body or body to wick, because it doesn't work basically. Check accuracy on the lower time frames, and again, you want to be careful, as we spoke about when it came to support and resistance, using those time frames. So if you identify a trend line on a higher time frame, make sure you're aware of that. So when you go into the lower time frames, you think, oh, this price is breaking out this trend line, you need to obviously make sure that it's actually breaking out on the trend line on the time frame you've identified it on, much in the same way you do with your horizontal support and resistances. Don't expect monster moves on the breaking of a trend line, as we mentioned before. I identify my trend lines last because I believe, and it's quite a common belief, that these are the weakest form of support and resistance. So your horizontal support and resistances are definitely stronger and more well respected. And as we've spoken about before, the trend lines being broken doesn't always mean a huge deal. So I tend to use them last, and I tend to use them in confluence with other support and resistances. Again, if you use any other indicators like maybe moving averages, RSI, all that sort of stuff, again, I would use trend lines last, as I believe they're sort of they're the last piece of the puzzle. They're sort of the weakest form of support and resistance. Just use them as confluence rather than just trading purely off of them. So what we're going to do, we're on the Ethereum ETHUSD chart. This is the 2017-2018 cycle. What I'm going to do is I'm going to use the replay tool. We're going to walk through the 2017-2018 cycle, starting from back in April. I'm going to mark out the trend lines following the rule set as I've shown, and you can see sort of how that works out. So let's go to replay. So from that low, and then we form this low here. So I'm going to start it just here. Let's get the rules back in there. So we can go nice and fast on 10x. So the way I mark out my trend lines, I use this ray tool, which you can see just there, with the magnet tool, and it allows me to just snap it from point to point. So as you can see, bullish trend line, so I'm going from swing low to swing low. What I'm going to do is I'm just going to knock it down to the daily and make sure that we are actually connected to the appropriate points. So that's the start of that trend there, and so you can see we're not actually touching a candle here, so I'm just going to adjust that to that swing low there. Perfect. Back to the weekly, zoom out, and I want to get my ruled checklist. There we go. Right, happy days. So let's play, see what happens. I mean, we sort of already know what happens, but just to obviously show you the trend line. So as you can see, we've come down, nice little test. So as I say, wick to wick most recent. So I will now adjust that trend line to the most recent bottom wick. Again, quickly have a look on the daily to make sure we are actually, so again, look, see, we're not connected. Let's go there, because that subtle change can make all the difference on the angle. So happy days, we're all up to date. Let's go again. Coming down, another tap. Happy days. So won't need much adjustment because it's, as I say, a pretty clean tap. Let's go back to the daily, make sure we're at the bottom of that candle. Happy days, back to the weekly. Press play. So it might be a little while till we, in fact, I don't think we come back and test the trend line again now until ETH tops out. Oh, here we go. We're coming down. There we go. Test. Right. Let's stop it there. So as you can see, technically we got a weekly close below the trend line. Okay. Now, this is what I mean about people then expecting a huge move to the downside because we've broken this trend line. And again, the lesson about this being the weakest form of support and resistance. Now, yes, we have got a nice clean trend line, 3 taps, happy days, and we've broken below it. You would think, going by what people generally believe about trend lines, that you're now going to see a huge move down. But actually, if we just look left, we've got a really obvious and strong level of support. We're just above. Obviously, if you marked out a little box, that would be quite comfortably in there, but missed it by a few dollars. But as you can see, really strong level of previous resistance, which has now flipped to support. And this is the first time, I mean, technically it got a little test of support there, but this is the first time it's had a proper test as support. So you would expect it to hold, and we've already seen a lot of downside already. So that's a really key sort of example of why you don't just trade purely off of trend lines. So let's now we update the trend line. So we'll go from the bottom of that there, quickly go to the daily, grab the bottom, happy days, and carry on. So coming down, test, hold. Right, so we held it there and held it there, so we'll update it now to the latest one. So we would go there, held it again, then we would adjust the trend line to there, and it was this spot here. And then as you can see, we're already testing it and holding as support again. So again, I would update that to the nearest or the most recent point, go down to the daily. Again, just make sure it's actually attached to a candle like that. Happy days. Starting to break, right, and now it's breaking down. So as you can see, this time we did get that did get that break, and then we started breaking down. This level held last time, didn't hold this time, and is now breaking down. So let's see where we finally bottom out. If we stop it there, if we look left, we stop just here, which is, as you can see, well, technically we had a first little bounce off of this level here at 285, and then we finally had another little bounce off the next level here, which again started the leg of the move. So going back to our levels of support and resistance. So then what we could have done, if we could have marked out that as the new low, held for a little bit, then broke again. And as you can see, if we just play it a little bit longer, where did we bottom out? If we look left, that next level of support of support just there, start of this leg. So again, you're seeing the points I'm making here about, yes, you do get a move generally when you break the trend line, but you have to be aware of your support and resistance levels as well, because all it really does, as I say, is it just goes down to the next level. And as we spoke about just back here as well, just because it broke a trend line doesn't mean it's then going to fall through the floor. So that's an example of how I would use my bullish trend lines. And again, we could, let's just see what happens here. Do we get another test? So it's holding that support. Okay, breaking through. So again, let's see where we bottom out. So formed a bottom there, and where are we? Look left, the start of this trend. Start of this trend there, as I say, start of that leg of the move, and up we go. And then you would adjust it to there, and so on and so forth. Okay, so let's do the same thing again, but this time we're going to look at bearish trend lines. So obviously with bearish trend lines, we're going from swing high to swing high. So let's start from the top of the move and go from here. Let's get the replay tool. So we need to start again. Replay tool. Let's chop it to there. So to say, we're at the start of the move. So obviously we failed to break out of this trend line. So we adjust, move it along, and press play. I think it's a little while until this gets tested. Okay, so we're just testing it here, breaking out, and then we break back down again. So here we see we actually get a breakout here, and what I would have expected in real time is I would have expected price to come up and test this next resistance here. Let's go down to the lower time frames. Oh, in fact, I forgot, didn't I? Look, see, and this is why you want to go down to the lower time frames and make sure you're actually connected to a candle. Forgot to do that. There we go. So let's just see if that changed anything. I don't think it did. So that would have then become out there. Okay, and then daily. Yeah, happy days. Move that to there. Move that to there. Cool, so that's our actual trend line. Happy days, didn't change too much. So let's have a look at where we got to on this trend and why we didn't make it up to the weekly level. So if we take a look on the daily time frame, you can see if we look left, we've literally just hit this resistance just here. Oh, not quite actually. It's this level just here. There we go, start of that little leg of the move, and as you can see, previous support, previous resistance. We'll just color code that so we can see which one it is. So as you can see, come up, didn't manage to break past daily resistance, and so then it failed. If we go back to the weekly, so now we will adjust our trend line. We can get rid of this level of resistance, adjust our trend line to here, and let's play. So testing, trying to break out, and again, fail breakout. So this is where I'm talking about, just because we've broken out of a weekly trend line, it doesn't mean you're going to get a huge move. As you can see, even if we adjust it, you know, it just does nothing really. It just breaks down. So a bit of a fake out, something that we'll come on to on a future lesson. But if we go down to the daily, let's see what happened. Let's just quickly adjust. Don't know what I need to keep adjusting this trend line to the most recent. There we go. So again, on weekly, does that change anything? No. So let's see what happened with this breakout, why it didn't go any further. Zoom in a little bit. So where are we? We're just here, and as you can see, failed to break over this level, which was obviously, if we remember back in the support and resistance lesson, this would obviously be a breaker structure because it would have made a higher high, didn't manage to do it, rejected, and then it just results in the move failing. So again, going back to the weekly, update the trend line to the most recent, would have been there, it failed to break out, so then we'd move it to there. Play it a bit further, rejected, looking to try and break out. Again, nothing really happening. And again, if we look left, there's a reason why. Weekly level of resistance just there. Just change that to a weekly. So again, weekly level of support, comes up to the trend line, rejects, tries to break through the trend line, but there's a level of weekly resistance there, and fails. So again, just because you break through this a huge trend line doesn't mean you're going to get this massive move. So you've got to be aware of what else is on the chart. So as I say, weakest form of support and resistance, in my opinion, doesn't always mean you're going to get a huge move once it's broken, and you've got to use it in confluence with other indicators or other support and resistances. So we can carry on playing this. I think that's pretty much it. Let's update it. So we'd be going to there. Let's have a look what happens. I think this is where we actually get a half decent breakout. So again, we do get a decent breakout, but this time, where does it go to? Next level of resistance. So as you can see, that's all it is. It just gives it the fuel to move up to the next level of resistance. So I think I've sort of made my points on that. So some modern day or current day, I should say, rather than modern day, get rid of this. So some current day examples. If we go to the S&P or the ES1, which is basically the S&P futures, I like to use the ES1 rather than the S&P, because you don't get all the price gaps, because the ES doesn't close on normal trading hours. It has extended trading hours. But this is one that I highlighted quite a few times in premium. So you've got a really obvious trend line here from swing high to swing high. So again, multiple rejections, but also if you combine that with a level of previous resistance, which you got just there, and it's spot on. So you come up, you've got this, as I say, you've got this tap of resistance on this weekly trend line. You break out, you go to the next resistance, and you reject, and you've actually still respected the trend line as well. If we go down to the daily, as you can see, so nice little rejection there. If we go to let's go to Ethereum present day. Let's go down to let's say daily time frame. Oh, we got a level. I think we marked that out earlier. So yeah, let's go current day. Take a look at a potential trend line. So well, in fact, there's quite a nice one that you can see here on, so a bullish trend line. So if you went from let's make that a daily. So again, you've got this bullish trend line here from swing low to swing low. You have it broken, but again, where does it fall? All it does is it just comes down to the next level of support, which is just there, and it holds that. So again, it's not the be all and end all just breaking a trend line. So all you can do is come down to the next level. Again, if you then adapted that out to a little bit further, again, you get a nice little bounce here, starts to break, but again, you're just holding that exact same level that I've just deleted. So again, you're going to go there, hold that, and then you come down, nice little bounce, then again you break, you come down, next level of support. So it's one of those, you swing it to the next one, and again you get a nice little bounce here, but it's just one of those, sometimes it can be a nice little predictor of where the next higher low higher low or lower high is going to end up. But I wouldn't trade blindly just off of trend lines, because sometimes it's just going to fall through, and as I say, just because it has broken through doesn't mean like, oh, you're going to get this huge move. It's just probably going to go down to the next level of support and resistance. Let's take a look at maybe some bearish trend lines. So swing high to swing high. Again, okay, so you get a nice move here. Where does it go? Next level of resistance, which is literally just there, as you can see. So there you go, guys. I think I sort of made my point on that. Hopefully you found that useful. Again, if we go back to the rules I've set out, these are my rules for how I identify them. Doesn't mean they're the perfect way of doing things. Doesn't necessarily mean that it's going to be right every time. As I say, if there was a way, then that's the way everyone would use and the markets wouldn't exist. But it's definitely important to have a set of rules and your own rules on basically what works for you, what you've back tested and you think works. Because if you don't have rules, as I said at the beginning, you're just going to have all these random lines that you can use in hindsight, but then if you've not figured out your set of rules as to why you've placed or why you've plotted those lines, then they're not going to help you plot them in the future. So yeah, get a rule set, figure out what works for you, and go from there. This is what I use. It tends to work pretty well for me, but just be careful on how you use trend lines. As I say, use them last, use them with confluence, and don't overestimate what the breaking of a trend line may lead to. Without doubt, the toughest aspect of trading is the psychological and emotional side of things, and nothing is going to test your mental resolve more than breakouts, fakeouts, and deviations. They can ruin the most perfectly laid out trading plan and cause a lot of frustration, a lot of FOMO too in certain aspects as well. So what we're going to go through in this video, we've already seen a few examples of breakouts, fakeouts, deviations in previous lessons. We're going to go over them in more detail in this lesson and focus on them specifically, and also methods on how to avoid falling victim to them. So the first one we're going to focus on is time frames, fractals. So how breakouts, fakeouts, deviations occur on different time frames. So if we go back to the lesson on support and resistance, identifying levels of support and resistance, I highlighted how important it is to take note of what time frame you've identified that level of support or resistance on, so you know what time frame it then needs to be closed above or below for the level to be broken. So if we're back on BTC USD, we're on the weekly time frame, and we know that we've highlighted this level before in the past because it's the start of a bearish trend, as we can see, 2 candles in a row. And if we look across, really solid level of resistance, 11.9k. Now you can see these huge wicks multiple times, 3-4 times over this period from June 2019 to August 2019. These would have been examples of a fake out, basically. So if we break it down to the daily, this is why I say it's important to recognize what time frame your level needs to be broken on. So if we go down to the daily, we had loads of daily candles that closed above this weekly level, so it would have caught a lot of people out thinking we're going to break out, and you've basically got an option on whether you want to be a breakout trader or not. So if you're a breakout trader, you're essentially, as the name would suggest, you're jumping in the traders as soon as you think that a breakout's going to occur. Like, you'll go down to quite a low time frame and you think, this is where it's happening, I'm going to jump in. Now, it's a very risky strategy because, as you can see, if you were playing the breakout here, every time, unless you were scalping, you would have got stopped out because the move just didn't play out as you expected. You were expecting it to close the weekly level, so you're basically trying to front run it, jump in before the weekly candle confirms over this weekly level, so then you can obviously ride the wave up. Didn't happen, and as I say, we go back to the weekly time frame. There we go, and you just end up buying these wicks. Now, if we then fast forward to a little bit later, and we go to October 20, as you can see, once we do get a weekly candle close above this level, it absolutely shoots off. So in this example, it would have paid off to be a breakout trader. However, as I say, it's a very risky strategy because every single other time, so 1, 2, 3, 4, 5, 6, 7, 8 times, the breakout trade wouldn't have worked out, but that one time it did. So the way to avoid blowing up your account by playing a certain strategy is obviously that risk management. So having something in place, which is what would be your level of invalidation, where you say, right, this breakout isn't happening, I'm jumping out here before the move collapses. Because, as I say, if you're buying right along here, you want to be getting out before it melts really far. So that's an example of a breakout, fake out on a different time frame. Now, if we take a look at how I would like to play things. So, as I say, you've got the breakout strategy. I prefer to do what I like to call a retest strategy. So, very similar example. We've got this level here, so the start of this leg down at about 10k. So as you can see, multiple times it's been tested as a level of resistance. We finally break through. Now I would be entering on a retest of this as it confirms as support. So as you can see, it comes down nicely, taps it twice, and then off it goes. That's a much safer method for me because, as I say, you're coming down to an already established level of previous resistance, which is going to turn to support. Again, first test of support as well, which more often than not means that you are going to get some sort of bounce, even if it's only a small one. But in this one, as we know, we got a huge bounce up there. So that's a much safer way of trading. Again, it's all down to personal preference, but you've got this risk reward here because in this scenario, obviously jumping on and front running the weekly candle close before it did would have obviously paid off massively, but you've got those 8 times where it didn't. And what happens as well to a lot of people is they would have waited for the confirmation, or so for example, like myself, if I'm waiting for it to come back and retest, obviously we never get that retest. So it's one of those, and these moves are what cause people to FOMO and think, right, well, next time, as soon as it looks like it might break the level, I'm going to jump in. But then you end up having this, as I say, the 8 times previous. So don't let things like this sort of throw you off your game. Obviously, the whole point of developing a trading strategy is finding what works for you more often than not, putting the odds in your favor. So yeah, just be aware of instances like that. Find a trading plan and stick to it. So as I say, in this example, I would have much rather preferred to wait for it to come down and retest the support. And if it didn't, well, that's too bad. I'll just move on to the next opportunity. So that is an example of breakouts and fakeouts based on a time frame. If we go to present day and take a look at ranges, so if we go back to the daily time frame and that range we identified in the previous lesson, so we've got a pretty clear range here. So we've got this leg of the move here which marks the low. Obviously we want to make that a daily, and the top of the range which was just here. So if we went back and used the replay tool, so this would have been our range marked out. We don't need to do the mid-range for this. We'll just leave it as it is. I think we'll go 3x, we'll play it out. So this is the range here, coming up, test range high, and boom. If we just leave it there, you see we do get that candle close above. It confirms the support even twice in a row, and you think, okay, this is it. You know, we've closed above, we're breaking out the range, and we're going to go. But as you can see, we break back inside, and this is what's known as a deviation. So you've deviated the level and just closed back inside. Again, you could even, if this wasn't a range and this was just a standard resistance, which it is, but part of a bigger range, it's basically deviating that level. So it's not always a complete 100% guarantee that if you get a close above and it holds a support, you're going to go, because obviously if that was the case, then trading would be super simple. But that's what I mean about these breakouts, fakeouts, deviations, really testing people's mental resolve, because people, as I say, you would think we're closed above the range, we've closed above the level, we're holding a support, up we go. Not necessarily. It catches people out, especially the breakout traders again, because as I said before, it's a very high risk strategy. Catches the breakout traders out, and the people FOMOing in thinking we're going to rally, comes back inside and deviation. Now this is a good range play for a short, because once you see that deviation, it hasn't got the strength to break out, you're more than likely going to break down. And as we see when we play the move out, we actually go all the way back down and retest that range low. And if we carry on as well, we're going to get an example of a deviation on the bottom, and as you can see there. So we got a daily close below the daily level, bottom of the range, and then immediately we come back up. The amount of people that would have sold this thinking, oh, we've got the confirmation, or tried to jump in on this retest of resistance. Again, not necessarily a bad strategy. You're getting in on the retest, something I might have done myself, but then you've got to watch out for these deviations on the bottoms and tops of ranges as well, because once you get in, once you reclaim that level, then there's a pretty good chance you're going to rally. Let's see what happens. And there you go, actually comes back down and tests it again. But as you can see, holds it, and carries on. So again, 2 examples there of deviations and fakeouts, top of the range and bottom of the range there. And then finally, if we go back to our, so we need to get rid of this. If we go back to our Ethereum chart and go back through the, let's get rid of those, and go through the trend line lesson, we saw a lot of examples back in our 2017-18 cycle of Ethereum, where you'll get a trend line, a bearish trend line, swing high to swing high. Put that on the weekly. And let's use the replay tool. There you go, and we'll play it out. We'll go 10x for this one. We play it out. Again, adjust to the most recent. Play that. Wait for it to come up and test. So here we go. We get the breakout. So here's a good example of where the breakout strategy would have worked. You get a decent run there, and people are going to think, right, every time there's a break of a trend line, you're going to get a huge move. Now we adjust the trend line, get it out to there. So again, people are going to be waiting for a potential break of the trend line. They're going to try and long it. And there's an example there, fake out. So looks like we're going to run, especially down here. In fact, if we go down to the daily, see what that looked like just here. So as we know, as we identified before, it literally stopped at this previous high, its daily resistance here. Fake out, hits resistance, and then drops. And again, you need to have that invalidation in place so that you're not still holding the trade all the way down here. Don't just have an invalidation of of waiting for price to come back inside the trend line or anything silly like that. You need a nice tight invalidation, especially if you're going to play a high risk, high reward strategy like breakout strategy. So again, you're going to go to the nearest high, next swing high is there. Play it again, rejected, and again looks like you're going to break out, and you don't, nothing really happens. So again, the breakout strategy wouldn't have worked out. As we know, it hit this level of resistance back here. Just mark that out quickly. This level here, that's weekly level. Again, going back to that trend line lesson, this is why you want to use support and resistance as a confluence. Oh, sorry, and then we need to mark out the next level. And again, you get a little breakout, fake out here. Nothing happens. So as you can see, as I keep repeating, the breakout strategy is a very high risk because of the amount of fake outs and deviations you can get. Best way of avoiding it is having that trading plan, having nice tight invalidations, and being able to recognize, particularly when it comes to ranges and timeframes as well, when it's a legitimate break, and how to recognize when that trade isn't going to pan out the way you think. As I said at the beginning, breakouts, fakeouts, and deviations can ruin a perfectly good trade, but you just have to accept it. Don't be too, don't have too much pride to say, okay, it's not going to work out. Just read what the chart's telling you. If you can see a fake out and deviation occurring, cut the trade. Or obviously, if it's deviating in a positive way and you can jump on that trade, as we showed in the range play, if it's deviating back in from breaking out the top of the range, it looks like a good short. If it's deviating back into the range from the bottom, it looks like a good long. So hopefully that's going to save you, this lesson is going to save you a lot of mental strain, and hopefully avoid falling victim to a lot of the losing trades that can occur with breakouts, fakeouts, and deviations. Candlestick and trading patterns are two things that people who are new to trading and investing seem to get really caught up in, thinking that they need to learn every single pattern out there. But in my personal opinion, I think they're a waste of energy, particularly if you're, as I say, new to the game. Now, as I've said, throughout the course, people will have their own ways of doing things, and there will be people that use candle patterns and or trading patterns and are very successful. That's not to say that I don't think they work. I just simply think that as a beginner, you are much better off focusing your time and energy on just understanding the basics, which is obviously everything we've gone through on this course so far, which is your support and resistance, and trend lines and timeframes and all that sort of stuff. That's already a lot to digest as someone who is new to charts and to trading and stuff like that, on top of obviously all the psychological stuff you're going to have to deal with as well. So to then try and cram in all of this information on different candle patterns and trading patterns, I just think is way too much, and it confuses people. And it's also just too much to try and look for on a chart as well. When you're new to charting, you really just want to keep it really simple and effective. And even myself, who I've been looking at charts for 5 years now, I still like to keep it nice and clean and tidy. I don't have any desire or appetite to look at candle or trading patterns because I just personally don't think they're worth the time and effort. So I've literally just typed into Google here candlestick patterns, and as you can see, so you've got bullish, neutral, and bearish. You've got like a dozen or more patterns here, and that's just on candles. You've got to obviously zoom right in and see which is occurring, and then you've obviously got to think about the timeframes as well. So on a higher time frame, you might be seeing, I don't know, for example, a bullish engulfing, but then you go down to the lower time frames and you might be seeing a bearish candle pattern, and so which one takes precedence and stuff like that. And you can look through all these different examples and you can see loads and loads of different ones, whether to buy, sell, all that sort of stuff. And that is just a lot of information to absorb. And then that's just the candlesticks. You've then also got the trading patterns as well. So you've got bullish and bearish patterns. So you've got flags, wedges, ascending triangles, pennants, cups and handles, inverse head and shoulders, and then you've got the reverse of those. So descending triangle, head and shoulders, inverse cup and handle, etc., etc. You've got wedges as well. If we go to one with a bit more detail, so here, for example, triple top, triple bottom, diamonds, rectangles, which obviously just looks like a range, rising wedges, and stuff like that, falling wedges, all sorts of different patterns and stuff like that. But I really think if we take a look at this image here, which ironically is the cover to a book saying I was born to trade, as you can see from Amazon. Got no idea what the book's like. It's literally just the image that I quite like the look of, because it sort of proves my point, is that if we look at these dashed lines, they really just represent support and resistance, which is obviously what we've been covering in the course so far. So all of these trading patterns you can literally just break down to support and resistance. So look, double low, support, resistance, comes down, obviously previous support, breaks that, comes down, hits support, comes up, resistance, support, resistance, descending triangle, support, trend line, comes down, hits support, comes up, tests the trend line, comes down, tests support again, tests the trend line, breaks support. Uptrend 1, 2, 3, this is called. I mean, this is literally what we've been talking about on the support and resistance lesson. So you got two levels of support here, breaks the first one, come down to the next one, breaks that previous support, which is now resistance, comes up, retests, and away you go. Double highs, self-explanatory, breaks resistance, goes up to the next one, comes down, comes back down, that resistance now flips to support, back up to resistance, back down, breaks the support. So all of these, and head and shoulders is my favorite one. So literally head and shoulders, it looks like a really sort of complicated and technical trading pattern, that looks like you're sort of really smart by identifying it. But let's break it down here. It's literally just three lines of support and resistance here, as you can see. So we come up, break the first resistance, break the second resistance, up to the resistance here, comes down, retest this previous resistance, which is now support, breaks up, makes a new higher high. So going through that higher high, higher low, bullish trend work, breaks this resistance, comes back down, doesn't hold a support, comes back down to previous support, bounce up, retest resistance again, and breaks down. And especially with head and shoulders, because it's the most common one that people really try to highlight in the charts and identify. If we take a look at the head and shoulders trading pattern, you can't actually identify it as a head and shoulders trading pattern until at least 3/4 of the way through the move. So if we took price action from here, just up here, you couldn't say, oh, I think a head and shoulders is about to form, because there's no way you can see that all this is about to play out. Even once you get to this point here, this just looks like it's in an uptrend. It's broken resistance, come back, made a higher low, held a support, come up, new high, made new high. So again, you can't say, oh, I think it's going to come down, bounce off this level, hit this resistance and form a head and shoulders, until it literally gets to sort of this point here, where you've already got one shoulder, the head, and forming the second shoulder. That's only really the point where you can go, okay, now I think a head and shoulders is about to form. And as I say, it's kind of useless, because all you're really saying is, I think it's going to come up, test resistance and reject. So why do you need to know what a head and shoulders looks like, what a textbook head and shoulders look like, when you can just use support and resistance? The other thing you got to bear in mind is that all of these patterns aren't guaranteed to work, just like with anything, because as I said, with the other aspects of the chart, like support and resistance or trend lines, like if it was as easy as, oh, this pattern always plays out 100% of the time, then everyone would just trade that pattern, and the market just wouldn't exist. So you're going to have, like in the last lesson we talked about, breakouts, fakeouts and deviations. So you're going to have market makers that make it look as though a certain pattern is about to form, and then it's going to go the opposite way. So there are percentages of chances of these things playing out, which again, that's all trading is. You're not looking for the perfect setup every time. What you're trying to do is you're just trying to find out all the evidence of being able to put the odds into your favor, because as I say, there's no perfect way of trading. There's no perfect chart pattern or sequence of events. So when it comes to these trading patterns and candlestick patterns, I just think personally that as a beginner, you're much better off just understanding the basics of support and resistance and then applying those. If you then want to go on and start, learning some of these trading patterns and keeping a few choice ones in your head to go forward, then fair enough. And as I say, there are people out there that do trade chart patterns and candlestick patterns and are successful. But as a beginner, personally, I would just stick to the basics and learn those get those fundamentals nice and solid before trying to cram all of this extra, what I would deem unnecessary knowledge in your head, particularly as a beginner. So what we're going to do now in this video is we are going to put all the lessons we've just gone through into practice and do a live walkthrough of how I would break down a chart from top to bottom. So we've done a lot on BTC and ETH in the previous video, so we're going to do 3 fresh charts, 3 fresh assets, ADA, DOT and NEAR, and as I say, literally going to break it down from top to bottom and show you how I would basically look at a chart from the beginning. So nice clean fresh chart, obviously starting on the monthly highest time frame. Now, as we've said in the support and resistance lesson, I'm not going to bother marking out every single bullish and bearish trend. No point marking levels up here or down here. I'm literally just going to focus on what is the most recent or relevant levels. So I'm going to look at this both from a trading and investing perspective as well. So obviously investing, you're looking at a much longer period of time, much wider invalidation, stuff like that, whereas obviously trading is going to be a lot more precise. So I'll try and cover both. So in terms of a monthly time frame, what are we looking at? So the nearest monthly level of resistance is quite a way away. He's up here. I'll mark it anyway, just for demonstration. But that is obviously there. We'll put the text on. There we go. And nearest monthly support, we are looking at, if we look left, we are looking at this level back here, which is actually this level just there. Happy days. And again, we'll just whack the text on. There we go. So that is the monthly. I don't think we've got any trend lines really to work with on the monthly time frame. So we can now go ahead and check out the weekly. Now again, as we go through the time frames, we'll just make sure that all our levels are snapped onto candles. Happy days. So weekly levels, what are we looking at? So if we look left, we got any weekly levels here? We've got one there. That's quite far away, although that is the next level of weekly support. So we'll just go ahead and mark it out anyway. So that is, oh, actually, no, we've got this one just here. There we go. Nearly missed that one. So let's mark that out, give it the appropriate, give it a tag, happy days. And as you can see, nice little tap of support there, and we're almost coming down to it now. So see what happens. Now, if we look at resistance, we've obviously got the start of this little rally here, which could end up holding as resistance. And then if you break that, you're looking at a potential break of structure here where it comes up and tests this high start of that downtrend there. So quite a sticky area of resistance potentially coming up here at around 32 to 33 cents. Nothing to the left of that really that we're interested in. In terms of trends, let's grab our tool. So we've got nothing from all the way up there, I don't think. Nothing of interest. If we bring it down to the next swing high, have we got anything? No, nothing too interesting there. Let's bring it down to the next swing high, see what we've got. So potentially there. Again, not really anything too interesting. You can see we had this breakout, but again, it just didn't occur to anything. So what have we got? Have we got something here potentially? No, not really. So nothing really to identify in terms of trends. One last, we got a swing high here to this swing high potentially. It's a bit too far out. So let's bring it down to this swing high. So I'd say that's probably the closest we've got in terms of a trend. We got this swing high to this swing high here, so might come into play, especially if we break this level of resistance and go up to the next one. Let's go down to the daily time frame, see what we can see. So as we spoke about, guys, the majority of the work has been done for us with these higher time frame levels, and now we're just on the daily time frame looking at what we could potentially see. So we need to move that weekly level to there. We'll also just tidy up that monthly level as well, and again that trend line coming down here. So again, as I say, that could potentially come into play once we get in between these two levels, if we get there. In terms of daily levels, again, the next resistance is going to be just here, which is where the weekly level is, so there's no point marking that out. In terms of support, this previous level of resistance, which is now flipped, as we can see, and you can now see why it's important to either color code and or label all your levels so you don't get too mixed up. And then have we got anything in terms of, I don't think we've got anything in terms of a trend on the daily time frame. No, doesn't look like it. Swing high there. We had the breakout come up to resistance, so nothing really doing there. So that is ADA really. That's what I'm looking at. So what would I be looking at here? So potential short in terms of a trade off of this weekly level. Obviously, if we start breaking above, then we could look at potentially shorting this trend line or this resistance up here. In terms of like investment, if you've managed to buy some spot nice and low, this would be a pretty good place to take some profits. And then obviously if you start seeing it come back down, you could jump out hopefully to buy low, because I think we're going to see a test of this $23 weekly level coming up next. And that, as I say, is pretty much it for ADA. In terms of an uptrend, again, I don't think there's really much to go off. As you can see, it's quite far away. But again, if we, I'll just quickly change that to a daily. If we see price come down here and start testing this level of support again, it could be a nice confluence there to continue the trend upwards. However, if we see this level break, not only are you breaking the trend, but you're also obviously breaking this level of support and creating lower lows as well. So quite an important level there to keep an eye on. But as I say, that would be ADA for me. Let's move on to DOT. So again, we're going to go high time frame first. So where is our nearest level of resistance on the monthly time frame? That would be this level here. Monthly, give it the text, and support this level just here at the start of this leg of the move, down at what, about $3.75 there or thereabouts. Give it the set it as a monthly text. So yeah, and then in terms of trends, again, I don't think we've really got one to look at. No, it doesn't look like it. Weekly, again, a lot of the work done for us here by the higher time frame on the monthly. So weekly level, don't think we've really got one down here. We've got a weekly level of resistance just here. Weekly. Happy days. And again, actually, you've got this level just here, which could also act as resistance, very similar to ADA actually. We obviously had a little rally in the markets back in towards the end of November, which has caused these two levels to be formed. And yeah, in terms of support, no weekly support there, so the next support on the higher time frame is the monthly. Let's see if this trend lines up with anything interesting. Not really, it's a bit too far out. I'll put it on there anyway, but I don't think it's going to be a factor for quite a while unless we see quite an aggressive move up. But again, look at where that trend line meets that level of resistance. That could potentially be a decent shorting area in the future, in a couple of weeks time potentially. if it obviously breaks through this first level at $5. We break it down to the daily. Once again, most of the work done for us. So in terms of resistance, you can see we're looking to just try and pop above this level here, which would be a break of structure. As you see, it would be a new higher high for the first time in almost a month. So something to keep an eye on there. Give that daily and make sure it's tagged. And yeah, and as you can see, we've been making higher lows all the way up. So we started there, new higher low there, and we may well form one just here as well. We'll have to wait and see. In terms of bullish trend line, again, pretty similar to ADA. There's not really much to go on. It's pretty far out. In terms of a bearish daily trend line, I don't know whether we've got one. Let's have a look. No, nothing really of interest. And yeah, so in terms of support, in fact, support is pretty close. We've just got that level there, which, as you can see, so in a bit of a channel here, being squeezed, we'll see which way it breaks, either bullish or bearish. So again, nice little trading setup either way. If you see a break above here and hold a support, you could long up to this weekly level $5. If we see a breakdown, you could short down to these lows here, if we just mark that out. So either to that level down at $4.22 or a bit of a safer option at $4.27. And yeah, that would be my analysis on DOT. And then finally, if we go down to near, so again, starting on the monthly time frame, what have we got? So level of resistance is this level, start of the leg of the move just here, which we actually closed below last month. However, we could be looking at a potential, so this is interesting because you're either going to have a bearish retest or a deviation, and with it being on obviously a higher time frame like the month, it's going to take a long time to actually figure out which one that is. So yeah, it'd be interesting to see. Nothing really well, we've got no support until we come all the way back down to 50 cents, which is quite a way down, so probably not going to come into play for a little while. Nothing in terms of trends, so we can go on to the weekly and let's have a look. So in terms of weekly levels, let's just tidy these up here. So in terms of weekly, we've got this level at the start of the leg of the move here at $1.83. Let's give that a quick tag. And then in terms of support, wow, there isn't really much here, to be honest. It could be forming a new level here. I have to wait and see. But yeah, nothing much really on the weekly. Have we got a trend to work with? I don't think we really have. Again, that's quite far out, unless we go from this swing high to this swing high. Again, looks like a potential breakout, but you've got these two high time frame resistances, so wouldn't really put much stock in that. So yeah, not really much to work with here. If we go down to the daily, what can we see? Let's just tidy that up. So we had a nice hold of support just here, or actually a little bit of a deviation. Change that to daily, get the tag. And then what have we got in terms of resistance? So we've got this level just here, start of this leg of the move, rejected. So potentially next target on the daily time frame, $1.71, if it can hold above this monthly level, but it's quite a big range. In terms of the next support level that you wouldn't want to see broken if you're bullish. You don't want to see price start breaking below here, because then you're starting to see lower lows. So in terms of bullish price structure, you're going to want to see it continue up and test $1.71, hold a higher low, and then push on. But in terms of yeah, I mean, that's pretty much it. You could say we've got a range from this level just here to the lows. Let's just mark out, see where that mid-range ends up. So if we go from this high to this low. In fact, let's move that level to there. That's better. Okay, and you can see that mid-range just there. So that's interesting because you got that nice rejection off of that mid-range. Pretty much perfect, actually. So, in fact, what you could do is actually just pop that daily level just there for confluence. Get rid of that. So, again, you're going to be hoping for a break above $1.63 to then push on to that weekly level and then even potentially up to the range high of $2. So yeah, that would be, just in fact, last thing I forgot, trend. Have we got a trend on the daily time frame? So swing high to swing high. No, so we got that breakout. Not really. I suppose you could have that trend line on there actually. If we go, not monthly, we want daily. So as you can see, price getting squeezed in between the monthly level, which again we could end up actually still acting as resistance. So I wouldn't count that as support just yet. Obviously, as we identified in the higher time frame, this could just be a bearish retest as opposed to a deviation. We'll have to wait until later in the month, but we could see either this bearish trend line continue to hold as resistance and push price down, as I say, then meaning that the monthly level is going to hold as resistance, and then a test of this level, breaking of that, you're making lower lows again. Or we could see it break out of this trend line, go on to test $1.63 again, break above that, and if we see a break of both the bearish trend line and the daily resistance, then things will be looking pretty bullish and pretty good for a move up to $1.83 in my opinion, and then potentially $2 depending on what happens with this higher time frame support. Higher time frame resistance. In terms of a bullish trend, not really got one because there's literally 0 point in marking out that to there because it's a long way across, and you've got this level which is more important. So yeah, I hope you enjoyed that. I hope you found it useful. That's how I break down my charts. Everything that we've gone through in the previous lessons, so from higher time frames down to lower time frames, then you're looking for your levels of support on those different time frames. Then you're looking for trends and potential ranges. In this video, we're going to take a look at some of the charts you're going to want to keep on your watch list. So I like to call this little list majors. You can obviously name it whatever you like. That's not specifically what they're called or go by, but they're basically a list of charts that help me keep an eye on the bigger picture. So some of them are directly correlated, some of them are inversely correlated, and they give you, as I say, a general idea of what's going on in the wider market. Now, this list obviously isn't exhaustive. There are probably others you will want to add on depending on what markets you are trading and investing, but for me this is a nice little list. And as I say, it gives me a broad perspective of what's going on. So let's go through them. So first one we've got here is ETH BTC. So this is self-explanatory. It is Ethereum's strength against Bitcoin. So generally what this is used for is like a correlation of altcoins versus Bitcoin. So generally the general trend is that when ETH BTC is doing well, alts are doing well against Bitcoin as well. So again, this gives you sort of that broader picture of what's going on. So if you're looking at trading or investing in altcoins, you're probably going to want to have a little look at what's going on ETH BTC, whether it's a good time or not to be going long, short, etc. So one thing I'd like to highlight on ETH BTC, so we see back in the 17-18 bull market, obviously this was early in the bull market, early 2017. You can see ETH BTC absolutely flying against Bitcoin up until June 2017. So this is what you like to call alt season. It's basically, alt season is a sort of meme term for when altcoins are performing well against Bitcoin. You can see that lasted right up until about June 2017, and then from there is where Bitcoin really rallied hard against the alts. As you see, it bottomed out round about December 2017, which was when Bitcoin made its all-time high. So Bitcoin made its all-time high December 2017 at around about 20k, and then you can see that alts had their final little blow off top into about the end of January, and then that's when the entire market just sort of came down, 2018 bear market. But as you can see, Bitcoin hit its all-time high, and then you had this last little rally of alts doing silly numbers, rallying strong in both USD and Bitcoin value as well. So speaking of Bitcoin value, we now go on to the Bitcoin dominance. Again, these are generally inversely correlated. So obviously, if ETH and altcoins are doing well against BTC, then the Bitcoin dominance is going to come down. So pretty similar to the example I just showed. So Bitcoin dominance is going to show you how strong Bitcoin is doing against other altcoins. So if we take a look at the same time period, so we said about December 2017, as you can see, that was when Bitcoin dominance was pretty strong, and then it absolutely collapsed as ETH BTC flew up against it. As I say, that was quote unquote a little mini alt season blow off top. And then what we saw from the bottom of the bear market, Jan 2018, all the way into September 2019, you can see Bitcoin dominance rising up until we got a little peak September 2019, but then the major peak was this here at December 2020, and then this again is what you like to call alt season. This was when altcoins vastly outperformed against Bitcoin, so your altcoins were growing in Satoshi value and more than likely dollar value too. So the general rule for reading the Bitcoin dominance chart is when the Bitcoin dominance is low, when Bitcoin dominance is low, you generally want to have the majority of your portfolio in Bitcoin, and then when the Bitcoin dominance is high, you want to then have the majority of your portfolio in altcoins. As you can see, when Bitcoin dominance is low, it's going to rise, and so altcoins are going to suffer against Bitcoin, and then when it sort of tops out, that's when you want to be in alts, because then alts are going to rally, and you should see that inverse correlation in ETH BTC as well. Moving on then to another crypto specific is the stablecoin dominance. So in fact, if we just quickly flip back to Bitcoin dominance was very effective on its own up until sort of around 2018, 2019, when stablecoins sort of got introduced and used far more widely. Now, since that inception of, as I say, back in 2019, once stablecoins started being used more widely, that sort of skewed the Bitcoin dominance a little bit, because up until then it was purely Bitcoin versus alts. Now you've got obviously stable coins as well. So stablecoin dominance, again, used pretty similar to the Bitcoin dominance. When stablecoin dominance is rising, that means obviously money is coming out of Bitcoin and altcoins and into stable. So as we can see, November 2021, pretty much the top of the last bull market. As you can see, that's when stable coins dominance was low, and it's been on an absolute tear ever since. And if we take a quick look at Bitcoin, obviously November 2021 is where we peaked, and then we've come down. So an inverse correlation there between stable coin dominance and Bitcoin itself. So when stable coin dominance is running high, generally Bitcoin is going to be dropping, and then when stable coin dominance is dropping, generally Bitcoin itself is rising. And in fact, real-time example this week here, 9th of Jan 2023, stablecoin dominance having a really big red weekly candle, and Bitcoin having a really big green weekly candle. So yeah, that's how to use the stablecoin dominance and Bitcoin dominance charts. Now going on to some more traditional finance. So you've got the S&P and then the ES1. So basically the S&P is the chart for guess what, the S&P 500. But this chart is for the trading hours of the S&P. So I think it's generally 9 till 5, Monday to Friday, obviously US Eastern time hours. So it will be slightly different in wherever else you are in different time zones. But the ES actually opens for extended hours. So it goes on after the S&P closes and opens earlier as well. So I like to use the ES1 instead of the S&P, because you don't get these gaps in trading hours, and obviously there's just more hours that it's actually traded for, so you get a more fuller picture. So that's the only difference between those two. If we then go to the DXY, in fact, just one last note as well on the ES1 and SPX. Generally, risk assets are tied quite closely to the S&P's movement. So generally, when the S&P is doing well, risk assets are going to do well. Bitcoin itself as well has quite a good correlation most of the time to S&P. Again, it's not something you want to trade solely on. You don't want to just go, right, if the S&P is doing well, then BTC will do well. Sometimes they decouple. But yeah, generally, as I say, risk assets will follow the S&P. So again, if you're looking at certain stocks that trade in or invest in, you probably want to have a look at what's happening on the S&P to get that broader picture of what's going on in the market. Moving on then to the DXY. So this is the dollar. Now, a lot of people have sort of take this at face value and sort of think, well, if the dollar's dropping, then Bitcoin's going to rally, and then vice versa. Generally the case, but not a guarantee, not as strong a correlation as other charts. Basically, you got to remember that this is the US dollar. It's not the US dollar versus Bitcoin. It's not the US dollar versus S&P. It's the US dollar versus all the other currencies. So generally, of course, when the dollar's looking strong, risk assets are going to suffer. So as we've seen from May 21 all the way up until this top in September, October 22, obviously risk assets have been dropping, whereas the dollar has been rising. But again, it's not the dollar versus risk assets, BTC, S&P, etc. It's the US dollar versus other currencies. So sometimes that correlation isn't quite there, but it's a general good rule. When the dollar is dropping, you are going to see risk assets do well. More chance of them doing well when the dollar is dropping than when the dollar is rising. So that's how to use the DXY. And then finally, we'll come on to the VIX. Now, the VIX is a very, very handy tool to use. And the way to use it, simple saying, when the VIX is high, it's time to buy. When the VIX is low, look out below. So what we're going to do, we're going to take a look at some examples of where the VIX has been low and the VIX has been high and how that's correlated into the S&P, so the ES1, and BTC. So we'll switch it to the daily. Now, what I'm going to do is I'm going to show you the chart. We're going to start off when the VIX is high, time to buy, and then we're going to switch it up to when the VIX is low, look out below. And what I'm going to do is I'm actually going to do them separately. So you're going to see highlights on each chart. First of all, as I say, when the VIX is high, time to buy, and then I'm going to switch it to VIX is low, look out below, because it just makes it look a lot neater and tidier. So we'll start with when the VIX is high, time to buy. And here we go. So this is all of the highs on the VIX that we're going to highlight, and what we're going to see is when we have a look at the ES1 and BTC charts, you're going to see how these highs on the VIX correlated to price action on those two charts. So first of all, we'll start off with the 11th and 12th of October. Go to ES1, 11th and 12th of October. You can just see here, 11th, 12th, and then 13th, we've got this big spike of volatility and then a nice little rally. BTC, 11th and 13th of October, as again, pretty much the same price action as I said before. BTC and ES, or the S&P, generally quite well correlated. Little bottom, big spike, and then we went on a decent little rally. And then the next one is just a few weeks earlier on the 28th of September, ES1, 28th of September. As you can see just here, it's a little early. We got another little drop, and then we went on a nice little rally. 28th of September for Bitcoin. Again, pretty much the same price action, big spike down, and then we went on a decent little run. The next one is these two spikes here. So we've got the 13th of June and the 16th of June. So ES, 13th and 16th of June. Again, so this was the 13th, first big spike, and then the second big spike was the 16th, and then we went on that really good run. Again, 13th and 16th on BTC. So first big spike there on the 13th, and then the 16th. Again, it was a little early for Bitcoin because then we got another little drop. But then we did eventually go on that decent little rally. So as I'm going through this, you got to remember, don't trade solely off the VIX. It's a nice little indicator used for confluence, but as you can see from these examples, it's pretty good, but it's not perfect, as no indicator is. But let's have a look at some more. So what did we just do? We just did this double spike here. So then we've got this one, 2nd of May. ES, 2nd of May, I think is this one here. Perfect. Big wick down and then a decent run. 2nd of May on Bitcoin. Again, pretty much the same thing. Bottomed here. Little run before a big drop. And actually you can see that big drop on the VIX. 2nd of May. Boom. And then we dropped. Next one we've got is the 24th of Feb and 8th of March. So let's go and take a look at that. 24th of Feb, 8th of March. And you can see that 24th of Feb, boom, big wick there, little rally. And then we bottomed out again on the 8th of March and then again went on a decent little run. BTC, 24th of Feb, 8th of March, I believe is this here. Again, big wick, just like the S&P. Went on a run, come back down, bottomed again, 7th, 8th of March, and again went on a decent rally. What we got next is this one, 24th of Jan. And that 24th of Jan 22. Let's go ES1. 24th of Jan 22 is this one. Oh no, it's this one here. 24th of Jan, again, huge wick on the S&P ES. Come back down a little bit more before then rallying. So what's that? 24th of Jan, BTC. 24th of Jan is going to be back here. So again, big spike down, just like the S&P, and then went on a really decent rally. And then finally, we've got, I think it's this one here. So 3rd of December. Let's go to ES1, 3rd of December. You can see this bottom formation here before a decent rally. And then BTC, 3rd of December, was this huge spike down here. Look at that. Huge liquidity grab. And then went on a fairly decent rally after that. But as you can see, it had a little rally there, then bottomed out a little bit more before going again. So as you can see, a pretty good indicator, the VIX, but not to be traded on solely. It's just used as confluence. As I say, just like all of these charts here, they're used to see what's going on in the bigger picture, used for confluence, used to add conviction onto your trades. So, you know, if you think something's a good buy, have a quick look at the VIX. If the VIX is high, then it's probably a good confluence indicator that it's time to buy. Now let's take a look at what happens when the VIX is low. And as you can see, we've now got these bottoms on the VIX marked out. So do the same thing again. Let's take a look at the most recent low we've got, which is Friday the 2nd of December. Now this one isn't as good as the next one. So as you can see, Friday 2nd of December, not much on BTC. Went sideways, didn't really do much. And then the ES 2nd of December was actually a little bit more better indicator. As you can see, marked this little local top before a decent drop. So, and that's why I say back earlier, generally the S&P and BTC move together, but not always. There is sometimes those decoupling events, which is just shown there. Next one we've got is this bottom area here. So we're looking at around 10th to 19th of August. Let's have a look at ES, 10th to 19th of August. And you can see that peak right there, right in the middle of that range. So 16th of August, marked the local top before a huge move down. BTC, again, did the same thing. So 14th, 15th of August, marked that local top before a big drop. Next one on the VIX, we've got this range here. So 29th of March till the 5th of April. ES, 29th of March till 5th of April. There you go. 30th of March is that. Yeah, 29th, 30th of March. Local top, huge move down. BTC, where are we? Up here. So again, 29th, 30th of March. Boom, big drop. VIX, next one. So we did that one. We're on the... So this is the end of 2021, January 2022. ES, as you can see, so that's March. So we've got 27th, 28th December here, all the way up to the 4th of Jan, and then boom, big drop. That was actually the macro top of S&P as it currently stands. And then BTC, I'm sure many of you know this, end of the year, as you can see. So Santa rally up to about 27th December, and then a big drop. Back to the VIX. So that was December, January. So now we've got this one. 21st of October, a double bottom till the 4th of November. So October to November. So this is where it's not quite right. Well, not quite right, but not quite as well correlated with the S&P. So as you can see, was it 28th of October we started. We actually carried on rising up until the 5th of November. Then we got a bit of a drop on the ES. So was that 5th of November? That's where the VIX had its double bottom, as you can see, 4th, 5th of November. So we go to ES. We had a little bit of a drop after the 4th, 5th of November on the ES, but then carried on going up again. BTC, let's see what it looked like. And again, so this was the first bottom on the VIX 25th of October, then we come up again to about the 5th of November. As I say, we did have a little drop again similar to the S&P, but then we had sort of a second surge, and then Bitcoin finally topped out and dropped below. So again, VIX isn't perfect, but it's still a pretty good indicator to add some confluence. And then VIX, last one. So we did that. So it's this one, these three spikes here. So you've got the 24th of June, 29th of June, and 2nd of July. So let's take a look. ES. So again, let's have a look. 24th is there. Carried on climbing. 29th is there. And then, what's it? The 2nd of July had a bit of a drop, and then a last little surge before a bigger drop. Take a look at BTC. Zoom out. This actually did mark a nice local top on BTC, as you can see, right on the 29th of June, spiked up, dropped, and then we had another, again, 4th, 5th July, which is what we saw on the VIX, and then we finally got that big drop, which was actually the final drop before a huge rally. So, as I keep saying, it's not perfect, but it's a pretty good indicator, pretty good addition for confluence if you're looking at other trades, as are the other charts. So if you're looking at certain altcoins, have a look at how ETH BTC is doing. If you're wondering whether your portfolio should be more weighted towards Bitcoin or altcoins, you can use the Bitcoin dominance. If you're looking at whether you should be buying, should be majority in stables or majority in the market itself, crypto wise, you can use the dominance. Again, if you're looking at specific stocks, you can use the S&P, and then the dollar as well, as to whether risk assets are going to do well or not. And then the VIX, as I say, when the VIX is high, time to buy. When the VIX is low, look out below. So hopefully you found that useful. As I say, the list isn't exhaustive. You've probably got some other charts you might want to add, but always a good idea to keep a list such as this, so that you can keep an eye on the bigger picture and not get too lost in the individual stocks or cryptos or whatever it is you're trading.
So the truth about indicators, pretty clear on this. Less is more. It will be overwhelming if you are new to technical analysis. You will start getting a little bit caught out in some sort of headlight situation where you are looking at so many different indicators and you'll get confused. There's loads. Obviously, you can see my favorites. I've tested, played around with a lot of random stuff over the last 5 years that I've had this account pretty much. Pretty cool, right? However, when you go onto this and when you start looking and going deep, and we will go onto it and we will look at the most popular out there. I'm only going to look at the most popular. The reason being, you need to follow the crowd essentially. Yes, there's elements that you need to do opposites in trading and investing. However, if all the confluences of big money is utilizing a lot of similar sort of scripts, i.e. the same narrative, there's a higher chance that you're going to get absolutely destroyed unless you're on a much shorter time frame. So try not to go totally against it in terms of an absolute random asset on an absolute random indicator, which may just have low liquidity anyway. So just bear that in mind. So we're going to go through a lot of different ones, but what I will say as advice before you start getting really deep, test it, try it, utilize it before you start disregarding it. Don't be adding 6, 7, 8 whatever indicators, because if you're waiting for a confirmation, and I've fallen into this trap myself, you'll be there all week waiting for everything to tick over. My theory is always no more than 2 indicators. Now, what I class as an indicator is something that will give you directional bias. Some indicators on here are not really indicators, they're just like data or information. So you can get certain ones, which we will go on to, about daily open, monthly close, open and weekly. Stuff like that is good data. They're not indicators, right? Indicators is usually a formula which is giving you a load of data that is kind of made it so it kind of gives you an idea. So, for example, the relative strength index, or the MACD, or even certain things like moving averages, right? They're more like an indicator versus just data of open and closed candles, for example, right? So we're going to go through it. It will be pretty deep in terms of the utility of using these and what they actually do to help you navigate the market. As I say, less is more. Candle structure is key. Market structure is also key. Overall, most indicators are lagging. That is where the biggest drawdown is. You can preempt some stuff. So the first indicator that we're going to look at is the relative strength index. It's the one that I use probably the most of in terms of an actual indicator, not so much as a tool. So if you put in RSI, go to technicals, and it is there. If you want to favorite these, by the way, just press the start. I would ignore these ones. They work off different elements, but if you click on it and go over to the arrow, you'll get some information. In the old course, we used to have a lot of these kind of theory elements, but I'm just going to put it within here, and I'm also going to let you try and figure it out when you are actually looking at new indicators. But in terms of this, it's probably one of the most popular momentum indicator out there. It's been around for a while, as you can see here, 1978. It's been publishing a new concepts, technical analysis systems, and it has been adopted ever since. It is this. This is essentially how it works. So it's the average gain of up days and average losses and down days, as well as a formula as an oscillator. Over the course of 14 days is essentially the basic generic element of it. So the default is 14 days. You can speed this up a little bit if you're on the lower time frames, right? On the lower time frames, you want to get a bit of a quicker narrative, and sometimes it's nice to actually remove this down a little bit, or half it at least, in my opinion. However, in terms of the basis of how it's worked, there's a big element around this. Personally, I ignore this as much as I possibly can, because what people tend to do is, and one of the biggest misconceptions of this indicator, and I'll explain, is when it goes overbought or oversold, you need to buy or sell it. Often that's not the greatest way to do it, because, you know, when you see this, some traders believe it is overbought and the ranges, are too wide, and you alter those ranges. Now, for me, I would rather alter them, because when you think 30 and 70, it goes to 0 and 100. There's a lot of room there for it to go much higher, and you don't really want to sell part of a move that's going to continue going with momentum. Remember, in cryptocurrency or even in the stock market, sometimes things get crazy because of hype, and we call it dumb money. Dumb people will come in and just buy stupid things because of the hype, thinking they're going to get rich, right? That could throw you off massively, and if you're on a higher time frame, like the daily time frame or something, you probably find it'll go much higher. And it's like, oh, okay, oh dear, oh damn. But hey, it is what it is. But let's get it on the chart and let's go for it. I'm going to go in more detail about this in divergence in terms of how you can see it. That to me is one of the best things you can ever do, in my opinion, right? Reason being, you can kind of guess, not so much guess, but you can get a little bit of a forward-looking indicator with utilizing divergences, because, as I said in the previous video, the truth of it, a lot of these are lagging. They are, because this is set to 14 days as a default element, so it's a formula over 14 days. So sometimes you'll find it hitting the top. By the time it turns around officially, it's already happened, right? So you've got to preempt it. A divergence is one where you can kind of see a potential failure. Same with the swing failures as well. You can kind of utilize it as a chart, which is pretty awesome. So we'll come on to this in more detail. Remember your market structure. You can do your support levels and your resistance levels and your little element of line chart analysis, which does actually work in terms of understanding the market's failures, right? Which is awesome. So let's get into it, because it's easy. All you need to do, click on it. Now this is the default version of it in the new element to it. Now the one thing that I always do, and you probably know this is a trademark, I always have mine at the top. Why? You're probably wondering. I'm going to give you the tip. You know what really irritates me about TradingView? These buttons here. So when you're doing technical analysis, right, and when you're looking at the bottom and you're doing, like, you know, let me just put a line on here, for example. You know, when you're trying to put a line on here, this gets in the way. It really irritates me. So guess what? Put it up there, it doesn't get in your way. So you're probably thinking, wow, looks okay. To the new people in the world of trading and investing, often you find, and this isn't a dig, a lot of things are overbearing and very complicated at first. It's like anything, right? Oh my god. Even understanding TradingView can be quite hard. Even understanding the fact of a watch list can be quite daunting. But when you start adding indicators, woofed. A lot of these indicators that we're going to go through will be configured to a point of making it easier for you as well. This is because of it's my variation of understanding the asset. So let's go into the details of it. All you need to do, double click on it. You will get the information, Actually, no, you won't, because I made a mistake there. There we go. Make sure you're on the cross thing because you want to. There we go. Highlight it. There you go. Boom, boom, boom. Sorry, I'm rusty. Anyways, all this information may well confuse you. Now, in my opinion, you don't need all of these on. So, for example, I remove Bollinger Bands. We're going to talk about Bollinger Bands later on. I also remove, it's up to you, the moving average, because you're going to use candle structure for that. Now, the one thing that I will say is always move these. As I said before, sometimes they're a bit too much. Now, there's a caveat to this. You can actually move them and it's fine, but one thing I will say, try and look at these as a lower length on the shorter time frames, because when you shorten it, you'll notice one thing. There you go. It's a lot more violent, right? It actually, in my opinion, I think it works better when you do shorten these than when you do on the 14. Now, when we start looking at certain assets, you'll start to find that, you know, it's within the gaps, but obviously you can see certain areas. I mean, look at this, right? All the way up here, overbought situations, right? But yes, it does pull back. However, it carries on going much higher, creating a huge divergence, right? We'll talk about this in more detail, but I want to put the cross on in terms of planting the seed in your head. Look at all these overbought situations. Overbought. Have you looked at the price lower down? Still rising, still going crazy. So this is why I say don't put the biggest emphasis on the overbought and oversold situations. Look at what the RSI is telling you in terms of information on the structure alongside this, the freaking candles, right? Please don't go blind. I know so many people that go, oh, it's oversold. What do we do? Oh, it's overbought. Oh, what do we do? Be careful, please, seriously, because you will lose. Anyways, other things you can do with this regarding the look and layout. Now, for me, what do? I make it thicker. I also make it white because it looks better. Actually, to be honest with you, it's up to you how thick you want it. Some people have it really thick, but you kind of lose the structure element to it. So it's up to you. I prefer having it kind of like that, but I also have it less harsh. Up to you in terms of how I want to do it. Obviously, these indicators are going to toggle on and off anyways throughout this course. One thing that I like to do as well, I like to have a solid line just to make it really obvious. Now, the one thing that I do, I remove the middle line. Why? Because I don't need it. And secondly, I like to have that line on there as well. Up to you. If you want to keep the RSI background, you can. It's up to you. You can also change the color of that if you want to have it a bit more obvious or a bit more just standoffish. It's up to you. Like, we can have a purpley one, but I also remove the Bollinger Bands because on the inputs you can actually have certain elements of the Bollinger Bands on there. But for me, I don't really like it. That's my personal preference. Now, when we're looking at this in terms of analysis right now, you can see the market is very boring, right? Sorry, it is consolidation zone, consolidation into a bump. Now, there's not much you can kind of do on this other than looking at the obvious. Now, as I said before, you can utilize structure on these bad boys, which is quite nice. As you can see, if I just go left here, look at that, bosh. What happens here? Well, look at it. Market melt, right? Now, this isn't kind of just telling us how to suck eggs. Well, this is kind of the generic element of all of this. That is a monster level. That has been a level of resistance. It's also the exact same on the RSI. Would you believe? Utilize structure on both, right? If you can. If you see a very obvious level like that, utilize it. And again, look at this. Rejection. And then we finally went, whoa, bang. It's important, right? So remember your market structure. Now, at the start of the default of this, now you can do this if you want to, you don't have to. You can put a moving average on this. Now, when you look at the moving average is here. The simple moving average, 14. Personally, I would rather change it to an EMA, and also I'd like to have it much faster as well to kind of give you that little bit of a run to kind of see what's happening. You can obviously utilize this to help you in terms of understanding trend analysis, but for me, it gets a bit too noisy, so I tend to have it off anyway. So just as a little bit of an element to it in terms of understanding trend direction. If we go to like any other altcoin, you can see certain situations. Now, this is where it starts getting interesting. Obviously, you can see a trend. If I had that moving average on there, pretty cool. But one thing that I did say at the start of this video is when you start zooming in and looking at it in terms of more detail, right? So what we've got here, right? We have got an uptrend, a very clear and obvious uptrend of higher lows, hey, boom. But also we've got it on here as well. What started this move off was a very, well, I wouldn't say a slight, a massive divergence in the candles, but not very aggressive on here, right? Now, this is what you need to look at. Print this off. Now, I know this isn't made by us. We will be making our own graphics for certain things in the future, but highly recommend you print this off and stick it on your face. Not on your face or on the monitor, but you get the picture. You want to kind of ingrain this to see it. Divergences for me is key to understanding the RSI. It is a primary function of understanding reversals and continuation. Bullish regular is a reversal. Bullish hidden is a continuation pattern. Remember that regular, reversal, hidden is the obvious continuation, right? Because what you're looking for is momentum. And when you look at the hiddens, you got the obvious buy points. Why? Because it's a higher low, right? When you then look at the obvious of this, it's a lot lower, creating that lower low, creating much higher momentum, which will basically push it even higher. It's a bit of an odd one to explain that it's in total reverse, but it's because of where momentum is lied from and where it can go, because of just the way it's gone. Same with the regular kind of bearish stuff. You got the obvious in terms of, this losing momentum because it's a lot lower, but it makes sense, right? So you got to look at these as an obvious, right? It's weird, I know it's hard to explain, but when you start looking at that, yes, boom, yes, boom. Weird, isn't it? I know. Anyways, with the hidden stuff, this one I find much harder to look at because it's just kind of obvious. Always look for this pattern. Always look for this pattern. If you ever see a really obvious lower high and you start seeing a higher high, that's going to drop much higher. That's just the way it is, because it's just momentum is hit. It's went to an overbought situation and it's going to push much lower. That is the whole purpose of them. So download that. It's below and look at it, right? Ingrain it. Because when you start looking at certain things, when you start looking at certain elements to this, now what I will do here, if I just get the Trendline tool, you can see here that the price has made new lows, right? This whole area has made new lows and it's pretty important. But the one thing that has not done that is the RSI. You can see that it's actually created a higher low, which is pretty good. It's an indication of a reversal pattern. Now, when we start looking at other situations, and this is where it gets important, you can start to find that, well, trend continuation can be found in two ways. You can find it via the RSI, or you can actually find it by chart price. Now, you're not going to see many hidden bullish divergences or anything like that on these, because it's just, sometimes they just don't happen, but sometimes they do, and they're very, very obvious when they do happen. Now, it's much harder to find them, but for me, a continuation pattern, as I say, can be found in two ways. This way or via this. Unfortunately, on this run, it is not, but we will find some at some point. But what I will say is this, that one gets very, very close to it in terms of almost going lower. If that went lower, it would have been a very, very clear, obvious one when this is making a high, but it's kind of not there. As I said before, it's not quite there. Likewise, if you're looking at the bearish price action, what have we got here? Price is making a new high, but this is going lower. That is a very, very important characteristic in terms of a potential rejection. When you look at this candle and zoom in on that candle, it's an obvious rejection candle, and then obviously from there on point, that's kind of your point of call. But when you look and peel back the curtains a bit, you just look left, levels of resistance and stuff like that. So it's massively, massively important. But as I said, looking for these divergences, you will spot them all the time. When you start noticing them, you will spot them all the time. They're all over the place. It's just one of those things that's so mad. And again, when you start looking at the obvious support levels and structure levels on the RSI, you can also start to wonder, well, what's going to happen next? Now, this is an important factor. When you start looking at all these kind of stuff in, when we said about structure, look at this. It makes a lower high, a very clear and obvious lower high. So does the price action. And that's kind of an important factor with the rejection candles. Yes, obviously you can go much higher, but if this candle structure was going higher and this was printing like this, it'll be a divergence anyways. It's already showing signs of weakness. And when you look left anyways, you're at levels of resistance, give or take, just above it, and it failed to kind of stay above it, which is hugely important. So remember that. In terms of other situations, obviously you can see sometimes you'll do a candle restructure and there's no divergence. There's never going to be divergences everywhere, so you've got to bear that in mind. When you look on the shorter time frames or the higher time frames, you'll start to notice different variation. So if I just go into the normal time frames, this is on the 6 hour time frame, for example, here, right? You will start to see different things at different times, right? What you see here is a very, very clear and obvious divergence. Look at this. This price point is much higher than this price point, but the RSI is much higher. This is a clear indication of a divergence that is appearing in broad daylight. You've made a new high, right? Very, very clear. But what has actually happened here, overbought situations, and it's created an obvious lower high. That is an element to say, hold on a minute, there's a problem here. This is a high probability we're going to reject. When you start zooming out and looking at the charting structure, look left, you see all the levels of resistance in the past and also prior rejections, right? It's just crazy when you think about it. So they majorly help. I'm trying to find a hidden continuation pattern for you. Bear with me, let me find one. So if we go to the lower time frames, we'll go to like the, I don't know, 30-minute time frame or something. We'll probably find quite a few of them, to be fair. So when we're looking at this, so very, very clear and obvious. Look at these, right? Look at the RSI, it's going up, but the price actually going down. Very, very interesting, right? So again, you're probably going to find it's going to reverse some point. Obviously it reverses here and it continues going much higher. But again, when you start looking at this price point here, you know, you've made a high, but also this has made a low. This is a hidden divergence, and obviously it snaps back in. Again, you're looking at the continuation here, you know, boom, it just makes a new low. Continuation in that pattern carries on going. But what happens here, it continues going back up, but again, no hidden divergence at all anywhere, which is kind of annoying when we're trying to find it. But again, a regular bullish divergence, sorry, very, very easy. That's a very, very clear and obvious one. That's a very, very strong one, very, very clear and strong, which is a good one to see. But I'm trying to find, there we go, there's a hidden bearish divergence there, a hidden bullish divergence there. So a hidden bullish divergence, as I said before, where this has created a new low, right, randomly, but the price action is telling you lower high. You will always go on the primary function of the candles. You don't just go off this, use this first, then you go to this, right? Likewise with the divergence, you'll use a divergence on here first to see what the candles are doing too. So mix and match, right? That is a clear and obvious continuation pattern to the upside. That is what you're looking for. Clear, textbook, beautiful, lovely. Clear and obvious long, right? However, when you're looking at situations again, look at this. Double top on the, well, you could probably argue triple top essentially, all the way across, but look what the RSI is doing. It's nowhere near matching that. So that's kind of what you're looking for. Obviously in reverse, what you're looking for in terms of a hidden bear is obviously, you know, you can, you know, it's very, very clear. The opposite to what I've just showed you. When this is making a new high, this is making a new low, they're pretty much obvious. They probably will be able to find quite a lot of them. It's just, you know, when you're trying to look for them, it's quite painfully a pain in the ass when you're looking for them. Let me try and find one. Let me find a downtrend from a while back. It's because the price action is so bad at the moment. There we go. This is an obvious one. So you made a, you know, obviously a high, a low, lower high, but look how high this is versus that. That's what you're looking for, right? You're looking for situations where, oh, hello, the market has obviously made this. Okay, thank you. Oh, wow, you are much higher than you should be. And obviously, vroom, bang, continuation pattern. So when you go a bit deeper, and this is going a little bit into other lessons and other parts of it, you want to see where the structure will fall. This is roughly a 50% retracement, obviously levels of resistance at the past as well, obviously rejected off that level, and then boom, confluence right down into this sucker punch area. Wow. But hey, we will talk about that later on. Anyways, RSI, very, very interesting indicator, by far one of my favorite indicators, especially when you use market structure on it, especially when you start to see the understanding elements around divergences. They're very, very important. When you start to notice them, you'll start to notice them all the time, and they are very, very powerful. So the next indicator is the MACD. Very different versus the RSI, but it is still a momentum indicator. If you put in MACD, it's all here. Use this one. And again, go to the information, figure out what it is. It's been around a lot longer, but this uses the 12-day EMA and the 26-day EMA, and it's got a signal line of a 9 EMA and a histogram element, which is a combination of both, as you know, essentially the line, which helps. This is utilization of crossovers and obviously strength, and it is a very popular indicator. It's probably one of the most popular indicators for novices because it is actually very easy to use and to understand. However, it can be a bit misleading because of the lag. When you think about it, that is laggy. 12 and 26 day. We will talk about moving averages later on in in the next video essentially. However, the lag of it can be a bit of a problem. It is good though. It does work very well if you're utilizing it, but I would not use this on its own, right? So when we're looking at crossover lines and zero lines and stuff like that, and you've also got divergences too. So remember, you can do divergences on here. So when that is trending up and the price is trending down, you can start to look at certain situations, and it does help you in certain, certain information will obviously help you, but divergences can be very, very misleading too on this because of the lag. So just a little bit of caution, because it's much more laggier than obviously the 14 RSI kind of baseline, right? So when you add it on, this is what it looks like. It's pretty neat and tidy in terms of how it looks. Now, what I will say, it's quite hard to read when the price action is like this. As you can see, not much strength in the histogram. Now, one thing that I do, I don't change much of this. I do remove the zero line because it's kind of obvious to know where zero is, because it's where usually the change will happen. Now, you can change the colors and stuff. I leave all this like this. It's up to you in terms of how you want to utilize it. But for me, I like to keep it super simple. I don't change anything. There's no point. There's absolutely no point unless you want to change the colors, which you can. It's up to you. But what we're going to do, we're going to go into a random asset. We'll look at the FX market in terms of understanding the volatility of it, because it kind of does help you. Now, one thing that people utilize and look at this, and it does bug me a little bit, is when they're like, oh, look at this, there's a crossover to the upside, it's going to mean it's going to go up. Well, yeah, but you're probably reading it too late. What you need to start looking at is, in my opinion, the histogram. When you start seeing it going from red into green, that is where the interest happens, right? Obviously, in this situation, you can see it's very, very clear. It's perfect carbon copy. It's great. However, when you look at this side, this is where you start to see the weakness, where it starts going light. The next day, you're getting it going lighter again. This is starting to turn. By the time the crossover happens, you're already into the red, and you've missed half the move. It's already here. You could have sold much higher. That is where the lag is the problem. And when you start looking at it, this is what you need to start doing. Now, again, you can see the obvious here in terms of the situation of, there's actually, it's a very, very nice area, this where it goes into this rounding bottom. You start to see it's finding levels of support, and it's starting to show signs of momentum. And then the crossover does happen here. Obviously, yes, you can see the situation at lower high, which is good. You want that. Higher low, sorry. Which is what you want in terms of a trend going up, and obviously, yes, follow momentum up. And again, start to see a weakness and then start looking at selling. A trending market is what you need for this indicator. When it starts looking like a dog's dinner and looks like this, and it's like consolidation, obviously this is like a certain time period where it's not been very, very great price action on this pair. You can't do anything with it. So in terms of an indication, it's really, really straightforward when it's a trending market. So when we look at trending markets, what we're actually looking for is a market where, if we're looking at this situation, a downtrend here, if I just make that like that, you can see it's like making these lower highs, lows, lower highs, lows, lower highs, right? All the way through, the RSI has been showing signs of weakness, but not much strength. Obviously, it goes into a little bit of strength here, then into weakness. Strength, weakness, a little bit of strength, weakness, all the way. Look at this, all the way. Whenever you are below that, orange line, you should be looking at being out of position. It can be very misleading. So you can see the state of it. Some of it looks rather ugly, some of it looks rather nice. On the stock market, in my opinion, and on the FX market, I think it works better than crypto, just because it's got more data, it's more information, it actually looks a bit cleaner and neater and tidier. It just looks better. But you can adapt it for crypto, in my opinion, to make it look a bit better anyway. So what you could do, if you wanted to, you don't have to do this, go into this situation here and just change your oscillator type and make them the simple moving averages, so they're a bit more clear, and it will massively help you. You don't have to change any of the smoothing lines or anything, just make it just look a bit neater in terms of the smoothing average, and then you can start to read the data a little bit better, but it's not clear and obvious. But that's essentially it. There's nothing much to really go on. Obviously, lagging data is a huge thing. Obviously, you can see it's a little bit of weakness there. By the time you do the crossover, you might as well not bother. So bear that in mind when you use it. Use it in confluence with market structure. When you start seeing weakness on the chart, you may look and find weakness on the MACD, which will help you. But it is a momentum indicator. It will show you when momentum is going to turn, whether it is a reversal or a continuation. It will massively help you. But don't go too deep. Don't just rely on it too much on its own, because, as I say, can be quite laggy. Also, it can be a lot of misleading data too. Obviously, if you're buying into a pullback and eventually it starts to turn around, it may well take off without you and you may well get caught out. So just bear that in mind. So moving averages, exponential moving averages and whole moving averages, these are all very different, and essentially it's up to you what you want to use. Personally, I prefer using EMA. So if we look at moving averages first, this is a very simple definition for it. Obviously you can watch these videos as well. Basically it's the average price as a lagging indicator, as an oscillator over the course of days. So you can see here as an example, 20, 20, 20. That's a basis of 20 days. It's a very simple calculation that will help you with this. It's up to you how you want to use it, but there's obviously different ones. So simple moving average is, yeah, the most obvious, the most simple. On the stock market, 20 is a very, very obvious pick. When you look at weighted moving averages, it's got an element of weight to it in terms of different price points, which is obviously giving you a much different kind of less laggy type of element to it, but it's cool. The one that I prefer to use is this. It's just a bit more of an exponential. It moves kind of better with price. And with crypto, what I find that the Fibonacci numbers, the sequence of numbers with the EMA works very well. It's just one of those things where the 21 works very well, the 8 works very well, the 55 works pretty well, 89 also works pretty well as well. It's just up to you what you want to use. But there's very different elements to it. Now, it can get very confusing when you put a lot of these on, so make sure you keep it simple. But they are a great way to find out a couple of things. One, uptrends, downtrends. For obvious reasons, we'll talk about that in a second. Another one is support levels and resistance levels. They are a lot weaker than using traditional levels, but they do help you massively. It's a good level of confluence. You often find that I do have a moving average on my chart, and then you get the element of crossovers, which is where you tend to get a lot of people talk about them. Bullish crossovers, bearish crossovers, golden cross, all kinds of stuff like that, right? Or a death cross, right? Which is essentially this one. So when we talk about it, we'll go through it in a little bit of detail, but as you can see, there's a lot of information here that you can utilize. There's no point going too deep because I'm going to show you anyways. So we'll talk about the moving averages first, just a normal moving average, right? So let's just go to the stock market. Let's go to Apple. You could probably argue it looks pretty good, right? So moving average 20, sorry. Uptrend, downtrend. How do you know this? When it is below, it is a downtrend. When it's above, it's not an uptrend. You got to remember trend confluence of market structure, that when you start to see these higher lows kind of appearing, hello, you can kind of see when you're above the moving averages, hello, 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 boom. Quite a good little trade, right? Over a period of time. It's easy, right? That is it. That is a moving average. You need to look at a few things. Obvious reasons is, where is it in line with the pricing structure? That's a good point. Oh, hello. Nice alert. So it majorly helps in that obvious situation, that reading of it. Now, as I said before, you can add two. Moving average, right? Add a second one. Sorry, my phone's going nuts. I'll move that. There we go. So one of the ones that people talk about is a 50, which is kind of cool, and a 200 moving average or 100 moving average. It's entirely up to you. Now, these are very, very different, and these are known as a golden cross or a death cross. You can see that this situation, when the EMA or the moving average, sorry, crosses over, you know, there's no reason for you to sell until we cross below that level. Look at that as a long wee, right the way up to the moon. Crazy when you think about it. And obviously it gives you bearish vibes because we failed to get above that level and we rejected, and now we're coming back down. Again, if you want to customize these to make them more obvious and clear to you, you can change them for obvious reasons. So if you want to make one white, one blue, it makes it easy to read. That's kind of the moving average. It's very, very straightforward. There's nothing really much to go on other than that. As I said before, levels of support and resistance. You can see here, look at that, levels of support, boom. And obviously you can see here levels of resistance on this moving average, levels of resistance on this one as well, as it failed to get above. They do majorly help, and yeah, people do look at them. They are pretty damn popular. Now, again, going into the world of crypto, if we're going to look at the exponential moving average, which you put in EMA, it's the exact same thing, just a different formula, right? So if we click on two of these, what we're going to do, we're going to put two very, very common ones in. In my opinion, I think these ones are brilliant in crypto. It's just my personal opinion, by the way. Not financial advice, obviously. Now, an 8 works pretty well. Right, when you look at the 8, bear with me, let me just toggle this one off. The 8 just runs with price, right? On the higher time frames, you can see that it runs with price. Now, when you look at this, it doesn't look like much, but when you combine it with another one, like a 21 or something like that, you can start to paint a bigger picture of what price is doing in the grand scheme of things. Now, a crossover on here is actually pretty powerful, and what we tend to find is like the trend tends to run with it on a trending market, especially on the likes of altcoins. On the likes of altcoins, you can see it much more clear. That's just Ethereum. Dogecoin, for example, not greatest example, I could probably argue. BNB, actually, there we go, BNB is pretty good. So you can see this, but what I always say is as well, look at the Fibonacci sequence numbers, 34, right? The deeper it goes, the more interesting it becomes, and you can see levels of resistance respected pretty damn well. Levels of support, again, fail to get above, just respecting it. Then obviously it breaks up. You can see how it goes. It's pretty crazy. Again, you can make these even deeper. You can go 55 if you wanted to, and it depends on your trading style. But what you often find, look at the levels of support there on the 55. Pretty important. You will find that they will work in situation, but for me, crossovers are very wishy-washy. You've got to be very, very careful. And again, if you're going to go like 21 and then the 55 maybe, you'll probably find it a very, very different kind of beast as well. It's all about the combinations, right? For me, I like to do this. I like to have only one on there, but I like to have two, but I like to toggle them. Don't like to use crossovers. So often I will find, well, what's the EMA 8 doing? Right, I want to know, is it going to respond to the EMA 8? Because what you tend to find is like stuff like this, you'll melt below, you always want to fight back towards it, right? You will often find that with assets, right, especially on the high time, if you go to the weekly time frame, you will find that we're miles away from it. What we found here, the EMA 8 is sitting at $260. Will we go and retest that? Chances are we probably will, right, at some point, or if it doesn't, it will catch up with it eventually and do it. It's just dependent. Again, if you want to do this as well with a 21, which will be much higher, much higher. 21 is up at these levels of structure, up at 276, right where levels of resistance are. Are we going to go and retest it? Because often what you find when we zip away from it, we want to go and retest it. We've zipped away for a very, very long time. We've not went and retested it. This concept and mechanism works on a lot of things, by the way. It's just the way it is. You can see that like every single time I want to go back to that moving average price. Everything goes back to those moving average prices, even at the silly heights of all-time high levels, and everyone's getting really excited. Oh, EMA's down there. We're never going to go down there. Wait for it. It does. It eventually does. This is a weekly time frame. It will take its time, but you get the picture. Anyways, moving averages, exponential moving averages, they're the two common ones, right? As I mentioned, there's a moving weighted average, which is a little bit different. So this is a different formula, but again, if you want to use a generic term, a 20, you'll probably notice it's it flows pretty well, right? It's just a different combination. Not many people use these as much as the other two, so it may not give you the same results, right? So bear that in mind. And likewise, there's another one called the Hull moving average, which again, different proposition. If I click on here, it's just going to give you the definition. It's just a different sort of situation. It's got a lot of weighted elements to it. So it's just a multiple of the weighted elements. It's actually pretty good. So if you click on this one, you'll probably find that this is the least laggy and a bit more interesting. So if you go 20, for example, it actually just flows really nicely with the market. But I'd be very, very careful with it because it is pretty laggy. When you start to notice it doing certain things, you probably maybe missed half of the move anyways. So just be careful with it, right? So it's one of those things that you got to tweak. If you want to go a little bit quicker, maybe the 8 Hull moving average, you'll probably notice it actually runs with price pretty closely, like the EMA 8, but it won't be as laggy, but at the same time, it's got a bit of weight to it. So just be careful with it. So anyways, moving averages. There's a lot of different versions and varieties. The concept is simple. Where is the price candle in contrast with the actual line itself, the oscillating data? So the next tool we're going to talk about is a tool, not so much an indicator, but it is a tool. It is called the Fibonacci Retracement. What an indicator, what a tool this is. Now, this is a bit different. As I say, it's a tool. and it's all a sequence of numbers based off the Fibonacci sequence. It's like a relationship with flowers and stuff in life, how it all revert back. Feel free to Google it to check out the actual history of this tool, because it is pretty important, right? It's this tool here. If you go onto the third column and then look onto it, it is the Fibonacci retracement. I do not do the trend extension because there's a little trick. I will show you how to do extensions on here when I show you my actual setup, right? So when you go on Fibonacci, it works and it looks like an absolute dog stinner. When you first use it, it's like, oh my God, what is this? Let me explain it in more detail. So when you're in an uptrend, let's go into like the 2-day or the 3-day time frame or something. There we go. So when we're into an uptrend, what you're looking for is candle structure. The candle structure to tell you what way are we going. And it sounds rather obvious this, but you're looking for stuff like this. You're looking for when prices kind of reverted, a push to the upside, a breaker structure, and then a pullback into that higher low. That's what you're looking for. But what you're looking for in terms of utilizing a Fibonacci sequence is the swing low and the swing high. So when you get it that way, you want to look for an uptrend, right? Which is going to tell you where the price could potentially pull back to and where you can enter a market position. So let me just find something that, where's me arrow gone? Me bar's gone all, because it's a new chart, all my bars have gone doolally somewhere. Bear with me. Arrow marker has been found. So you want to go from this point here, okay, simple enough, to the high, the rejection. When you start noticing a rejection, you want to go, all right, where's it going to pull back to? Now, some people, you may find that this will reject. Now, this is why you don't just put an order in. We'll talk about this in risk management willy-nilly. You're waiting for a confirmation bias. So when you start then putting the tool on, you want to go from this low to this high. Now, we need to configure this because look at the state of it. It's a mess. This is what you get as a default individual. A dog's dinner. Horrible. So, double click on it and this is what you get. Now, I really dislike how it looks as a individual. Now for me, how I set it up is very, very different. First things first, I put the indicators to the right and I put them in the middle, and I also keep them as values, but I make the font a little bit bigger. All of these you do not need, apart from this one. All the other stuff you can have, right? I remove the 50 because it's not required. I remove the 23.6 because it's not required, and I keep it as those. But I add some extensions on here. So what I'm going to do, I'm going to show you what the extensions are when I just go and convert to my version, right? Print screen this, and this is what you need. You need to do some negative ones to add other extensions for both ways. Because when we then look at this Fibonacci, it's going to look very, very different, right? It's up to you how you want to do it. Now you can have dotted lines or you can have dashed lines. I quite like the dotted lines at the moment because it looks a little bit different. There you go. So you can see here, price point, swing low, all the way into the 618 levels, confirmation candle, hello, high. Or we may well start getting momentum to the upside. Look at where it went. One extension all the way over. The big extension all the way over. A monster move all the way from this point to that point. So what are the principles of it? It's telling you that the market's going to push back to a certain region. Now this, oddly, is like a little prophecy in a way, that people look at these levels as a matter of fact and they utilize them when confirmations happen. The 618 is known as a golden level, the golden ratio of Fibonacci itself, the 618. It's a very, very common number, and you probably heard it in life, right? It's a very obvious one. 382 gets used quite a lot, 786 gets used a lot as well. I like to keep it as these three. These are obviously extension levels and variations of numbers that are also related to these. Pretty important, right? So when we start looking at that, that's kind of how it works. Now, as I say, you can customize this to whatever way you want. You can have a line, you can have it as levels of resistance, you can just change whatever the hell you want. Now, let's look at a few other situations with this. Now, as I said before, that's an uptrend. When you're doing an uptrend, they're very, very straightforward, right? An uptrend is, you know, a situation where you could be looking at whatever price action, right? So like this, for example, that is again another uptrend. Obviously you can see hit this level, carried on, created a, you know, a higher low. Yay! Obviously, you know, it's very easy to show that because it's already happened. But as an entry point, and noticing that, hold on a minute, it's held. Support levels have held at a key level with confluence to the left. Remember that, confluence to the left. Always go of levels of support and resistance. Don't just plonk it on. Now, one of the biggest failures of most people in trading and in any analysis, they will just put in orders here, right? They'll just put in orders here, thinking it's going to bounce off it. And obviously you see here, boom, bounced. Cool. You're going to wait for this candle to close fully. And again, what happened? Oh, we went and retested it. Oh God. And then the next day we melted through it. And then obviously melting again. You got to be careful, right? Always wait for confirmation of a candle closure before you start making a move. So that's an uptrend, right? These extension levels work very well. So obviously on a default one, you don't have these other extension levels. That is why you don't use this, because it gets a bit messy. Utilize this, it makes straightforward. When you look at taking a profit, obviously look at these levels as well, potentially. Obviously failures, look at candle structure, potential failures, if it doesn't break above a certain level. So for example, in this situation here, you might have found that it may have made a lower high here and failed, bug out, because it's going to continue going lower. Right, so let's look at downtrends, right? They're very, very straightforward. It's just in reverse. So when we're looking at downtrends, we're looking at lower highs. So again, what we've got here, we've got the swing high and the swing low, right? So again, let me annotate this, boom. The top of the move, the pullback, pulled back into that level. Some people will think, oh, we're gonna go to the moon. And people were at this point in time, I remember it. This rejection was critical to what happened in the entire market. Now, the one thing with a Fibonacci is higher the time frame, the longer the gap, the more longer it's going to take time to do it. Now, what you'll find is some amazing price action calls by myself and other people have been called off Fibonacci by indicating certain levels of interest from nearly 12 months ago. This is why like 12k level on Bitcoin is pretty much important, or the 13k level, because it is a Fibonacci sequence. Likewise when I do this, right? So what we're going to do here, we're going to go from the top of this move here to this swing low. And already you can see $300 is a potential target level, which it did eventually hit in May, which is crazy when you think about it, right? So what actually happened? Pulled all the way up, right back into these sequences, right? Rejection of the 786 levels, and then it just continued melting. It melted and pulled right the way back up. Level of resistance to 618, and it continued going down. Level of support again, and it melted all the way down to the 618. Went right the way back up, resistance. Look at how these respect price all the way across. It's pretty damn important, right? So they do work very well. You can put this level structure on and it works. And again, you can see what happened. Even now, look at this. Put your line all the way across. That level there, that 305 level, left, a lot of resistance and support. Right, in the future, a lot of resistance and support. It's majorly important, right? This is why you should always utilize them. Now, on lower time frames, you can use them for trading. You can use them for whatever. Look at the weekly time frame as well. As I mentioned before, right? When you're looking at certain situations, the swing high, the swing low, pull back. I wonder if this is a level. I'm going to say it is. I don't know this, by the way. Nearly. Not far away. But as you can see, the higher the time frame, the bigger the gap. So try not to get caught out, because if you are in drawdown, you're going to feel the pain. Because if you are like, oh, let's just put an order here expecting to buy the dip, yeah, or obviously, yeah, you still be up. But you may be in a lot of pain. And if you're using leverage, which we will talk about in more detail later on, you will find that you will be in pain. So don't just preempt them. Wait for the confirmations and utilize them as a level of interest, right? Try and, as well, as I said before in previous videos, use the rectangle tool to enable you to have a much bigger area of like interest, so you could kind of ladder into it a little bit, so you're not just going fully balls deep at one point, because if you go all in at one point and it goes lower, you may well get liquidated, so be careful. $100 is a potential area, which is a random area of confluence. There will be another one at the minus levels, but obviously ignore that. but for obvious reasons, $100 for BNB, is it a possibility? Of course it is. Everything's possible in this market, you just don't know. Now let's look at Bitcoin. I mentioned it before in terms of an obvious level. If we do this swing high again to the swing low, you can see here, why is the 10k level so important? Now look at this level here, the 23, was critical level for a long time. Failed. We may well be failing going down to these levels. Level of structure here around 12k. The absolute area of the 618 is 10.5, which could be a level. I'm not saying it will be, could be a level, right? Hugely important, but you can see here what happened. Rejection at the 382. And then we did all around here a little bit and we rejected. As I said, went here. We'll see where we go. But obviously, another situation as well is why not go from here to see the recovery? There wasn't really one recovery at all. It was pretty dire and pretty rubbish. This is now acting as level of resistance and a huge critical one. I think we are going to go down towards that 12 to 9k level of Bitcoin, which will be in confluence with the previous cycle. But this Fibonacci level is a huge confluence, and you can see, look, even the previous levels, look left, resistance, look left, support levels and resistance. Here, huge levels of support. Mad when you think about it. So that is the Fibonacci. Highly recommend you use it. It works very well. As I said before, if you want to look for obvious uptrends, you know, you can utilize whatever part of structure. This is the weekly time frame. Look at this for a pullback. We pulled back almost to the 618 level. That's a huge retracement. You just don't know where it's going to go. So don't just preempt it, oh, I want to buy at 41k, because guess what? It went all the way down to like 27 levels. Huge. So use it. It's very good. So we're going to talk about volume. We're not going to talk about the obvious volume that we had before. So if I just go into here and press volume and just do that, we're not going to talk about the obvious here, right? There's all kinds of other volume metrics you can do. There's a lot of different indicators too, so try not to get caught out. There's some, different script version, which we will talk about scripts later on. It's up to you what you want to use. So in my opinion, I prefer the TradingView ones. These are other ones on other situations. So if you go on like this one, for example, you can kind of see they've done something at the bottom. Not quite sure how it works, so just try not to get too confused because you will get a little bit lost. Now, what you need to do, go to indicators, go to technicals, and then go to volume. Visible range volume profile is the main one that you want. Again, simple sort of stuff. It is the stuff on the right hand side. You've probably already noticed these, right? Definition is telling you essentially this is where orders are, where the profile of the history of the asset essentially is telling you where certain things are. And you got a red line called the point of control, POC, and that is the price of the highest time in terms of the highest trading volume around that level. So when you zoom out, it'll do it as a kind of an element of like the zoom in profile of the chart. So if you zoom further out, it will do all the data. You got the high and the low of the profile, and you got all kinds of different value areas, which are hugely important, right? It's a really simple way to discover your support and resistance. Obviously, the resolution of the chart is ridiculously important on here because the lower you go, the more interesting it's going to become, right? But as you can see, support and level of resistance, you can see where there's a massive shoot in terms of information, hello, which will tell you there's something of interest in and around that region, right? Volume nodes as well, very, very important in telling you, the height of the volume. It's important, right? So it's massively important that you understand the basics of this. Now for me, as I say, I only like using the visible range, right? Now it's already on the chart, but you just can't see it, right? It's kind of here. It's in a bit of a rubbish color. Let me just change this color. Now if I just change, bear with me a second, let me just go red, or I don't know. There we go. So we go red, green, whatever, I don't know. Random colors, just so we can see them, right? Now, you can put the values in there if you so wish to. You can obviously add all these different elements of like the volume ranges, the point of control for that asset. So obviously all the way down here is the one, and the potential developing ones. But if I zoom in, if I do zoom into this, there you go, you can see how it's whole changed, right? So what's actually happened here, it's given you an element of interest of here, and obviously the point of control. I've still not actually sorted this out yet. Let me just all make it the same sort of color. Actually, tell you what we'll do. We'll go to reset default. There we go. Back to default settings, right? So this gives you an idea of where things are. So as I said before, once you zoom it and around it and put it in certain places, it gets obviously moved around and it helps you out. So the point of control here is roughly here. But you can see where there's a big gap here. Very, very interesting. But the one thing that I like to do, I like to change what inputs I've got. Sometimes you want to increase the row sizes just so you can get a bit more data. For me, 100 is usually pretty good. You can kind of see a lot more information with 100. And you can see already it's looking a lot neater and tidier. Up to you in terms of how you want to do it. You can do it per tick, which obviously ruins it, but obviously numbers is the main one. So when you look at this, you can see very, very easily this level here is important. But what you also notice as well, there's a level here at 16,000 where it points out a little bit. That's also a level of interest as the volume then declines. When you start zooming in and going towards these levels, you can kind of see how this level is important. And obviously there's a massive gap here. There's a massive gap where we've actually bounced before. With a break below that, we're going to go down to the 16k levels again, in line with this. And as you can see, going lower down, you can see where things are. But this level here is the point of control. This is where the most volume has been traded. But as you can imagine, it looks pretty cool. Going on to Ethereum, again, if we zoom out and go to another place, let's go to like the 6 hour time frame, around this level. Again, point of control right at that level. Level of resistance up here, and obviously all this kind of level. And obviously if we drop below here, it's going to be free fall, potentially free fall all the way down to probably these potential levels here. I'm not sure if it's going to move if we go lower. No, it doesn't. I'll just check to see if it did or not. But as you can imagine, there's a lot of information you can take away from this in terms of just knowing where your levels are. Again, it's all about confluence. It's all about, right, left hand side we have support levels, resistance levels, whatever. On the right hand side we've now got a volume profile telling us where some things actually could be on certain time frames, which is hugely important. Higher the time frame, the more interesting it obviously gets, as you can imagine. But you can see here there's a monster point of control all the way down here. Will it get to $200? Probably unlikely, but if it does, you can probably bet it will probably bounce off it, which is probably quite a good thing. But there you go. The simple lines of volume profile. As I say, there's a number of different ones. If you go into obviously volume profile, loads of different scripts here. So make sure you check them out. So another popular indicator that I have used in the past, but it's been a long time since, is the stochastic. Now, I don't use the RSI version, I just use the normal version. It's a momentum range bound type of indicator, so it's very similar to the path of momentum, but it's a bit wild, I'll put it that way. On the lower time frames, it's a bit chaotic, right? So just be careful with this one, but it does do some incredible signals early. It's similar to the RSI in terms of utilizing divergences and being able to utilize that element. So you can see here, identifying overbought and oversold levels, divergence, and also, you know, bull and bear setups as signals. When it's in a trending market, it actually works very well. But as I say, in a non-trending market, false signals are a massive, massive headache with it, right? So it has been developed in the 1950s, which is quite a long time ago. It's been around for quite a while. It's pretty popular in the stock market especially, but it does work pretty well in cryptocurrency. But as you can see here, right, you see this uptrend, right, going crazy, crazy, crazy. But you can see how it's like chaos. It's absolute chaos. So you have to be very, very careful with it, right? And I will explain certain ways you can do it. And as you can see, divergences become very, very common and very, very obvious when you're actually looking at them. So keep in mind, divergences are pretty much king in the type of oscillators that you're looking at. Go to Stochastic and hello. It's mad. And I will say this again, it is a mad indicator, but it does work pretty well once you get a gist of it. When you're looking at strength, you can see that the crossover element to it is pretty powerful, but also, most importantly, when they actually do go into these overbought or oversold situations, it's basically telling you there's a potential pullback incoming, right? When it does happen, it's pretty brutal. But you can see here the time-wise in terms of why overbought and oversold in any indicator is a bit of a vague term, because it could obviously go much higher. This was overbought at 97.78 right hand side, sorry, you can see the value of it. So pretty impressive. And then obviously vroom, all the way down to 8 or 7. Yeah, give or take around 7.82, which is chaotic. And then guess what happened? Crossover to the upside, bang, up for another run. So that's on the weekly time frame. Going on to the daily, it becomes a little bit easier to kind of look at and read. You can kind of see certain situations where obviously divergence, huge, well, I wouldn't say huge in terms of candle structure, pretty weak in terms of this, maybe a double bottom, you could probably argue there. However, fundamentals are clear. You're in the oversold situations here where it's like people are like dumping and crashing and then obviously back to the upside. Very, very clear and obvious top there, lower high structure, nice confluence. You can see how you can use it. But sideways consolidation, for the first bit, it's like guess, help, I'm struggling. It's quite hard to get your head around. Likewise here, the way it kind of looks, it's pretty chaotic. But divergence is pretty cool. If this flings above here and this is going much lower, you probably argue there's probably going to be another divergence appearing. So it's always good to look at. Going on to like the 6 hour time frame or the swing trading time frame, even more chaotic when you look at consolidation ranges. So when you start seeing price range like this, it's best to just go and hold it for a bit and just ignore the charts essentially, because it's just chaos. When you start looking at indicators without a trending market, it gets really, really tough, right? But you can probably go back in time and read quite a lot of this pretty well. Obviously, you can see this crossover to the upside, low levels, cool, right? But what else have you got? You got quite a few things. You've got a little divergence here, not a great one, but enough to kind of get you going. Likewise here, look at this situation where you've had an obvious, a high into a higher low, and again into the overbought, crossover to the upside, and then obviously bounces back up, right up to the overbought situations. But again, look at the bit of a divergence. The price actually made a little bit higher in terms of body closures by a tiny little sliver as this was going down. So you can argue it was probably about to run down, and then guess what happened? Eventually, over time, it did. Nice little divergence here. But hey, that's it. There's nothing much really going. I would not recommend moving any of these elements. Maybe if you want to change the bands or like make them more fatter or better, to view things better, it's up to you. But for me, I wouldn't change anything. But yeah, stochastic can be chaos. It does work pretty well in certain markets. One more indicator to really look at, which is quite popular, is used quite a lot, is called Bollinger Bands, right? Put in Boll and Bollinger Bands. These have been around for quite a while. Not the most popular nowadays in terms of crypto, but you see it quite a lot. But they are quite a big popular tool in the stock market. You tend to see quite a lot of traditional market analysis using Bollinger Bands, which is pretty important. But it's a simple element to it. Created in the 1980s by John Bollinger, and essentially it's a visualization of 20 moving average of the upper band, the lower band, and in the middle. So it's basically 20 moving averages as like an envelope, if that makes sense. It's a bit of an odd one to explain, but it's kind of like this. And it works in a way that they've become range bound, where you can actually trade off them on the lower-ish time frames, I'd say. It's probably best, in my opinion, for this, because it goes a bit spacey in terms of the higher time frames. But it's been a long time since I used them, but you can see here how it kind of works. And the whole concept of the 20 moving average is a massively vital thing in the stock market, but you can also utilize this in crypto too. But sometimes with the volatility of crypto, please bear that in mind, because it does move a lot more than the stock market, where this was developed in the 1980s. You may find that, it's at an expansion level or it's at a contraction level, and it just blasts through it. And you'll be like, oh, oops. So just bear that in mind, right? So you can see here how it kind of works, very much like a trend element. So you can imagine how the moving averages of support and resistance will work, same sort of thing like this. It just makes it into a bubble. Good for trend management, good to show a trend, good to show either directional changes as well. It's pretty simple to use. Now, let's go on to it and show you how it kind of looks. Now, we're going to use the FX market so you can see it. So, looks relatively straightforward. Obviously, this is a nice, clear and obvious uptrend. So obviously, go into the back end of the band, right on levels of support, bounces right the way back up and goes and recaptures the middle band, right, which is hugely important. So the basis band, upper and lower. So they're all 20. You can change the deviations a little bit, but I probably wouldn't want to, just in case, because obviously it gets a bit chaotic. Keep it as default. Why? Because a lot of people will be utilizing the same settings. Level of support right on that deviation element there. Pretty interesting. But anyways, moving on. The strength of the trend is looking relatively good, but now what we're seeing here is a rejection of that level. But when you start zooming out and looking at it in finer detail, we've had a massive move, a massive bounce. When you add confluence of different indicators, it's pretty important. But that is it on obviously that. But in terms of BTC, if we're going to go on to that daily time frame on BTC, as you can see, it's a little bit more chaotic. It's not the neatest looking thing to plonk on your chart, which is kind of the point of it, where I like neat and tidy charts. It just looks like a load of, it's just a complete mess. Sideways action. again, like all indicators, relatively useless. So bear that in mind. Not the greatest in the world for that. Looking at the weekly time frame, you can see obviously how certain situations have obviously arose. But for me, I cannot see much benefit using this on a higher time frame. But on the lower time frames in crypto, you could probably get away with it on like the 4 hour time frame. Certainly when you go back on, let me go to some decent-ish price action from a while back. There we go. So you can kind of see how it does work. But again, it looks a lot neater and tidier on, yeah, you can imagine the likes of Apple stock. If we go to Apple, it looks a lot neater and tidier. It's a lot easier to use because it actually is going to levels and rejecting, hitting levels, contracting off that level, going on and going into these regions. Even on the daily time frame, it's just, you can see the obvious levels of trend analysis where you can see the momentum of a trend. Whereas when you go into crypto, it's just chaos. Like apart from this obvious downtrend here, you know, yeah, goes back up into the downtrend. But if you remove and you can understand structure, you're probably better off not using it in crypto. Personal opinion, not financial advice. Feel free to use whatever you want to use. But it's good to show as a variety. A lot of indicators and custom indicators, which we'll go on to soon, utilize the Bollinger Bands as a hidden element within it because of the deviation and the element of the upper and the lower bands, making it quite nice to kind of control what market movements are doing what. But for me, I would not use it just for the obvious other volatility. When things are ranging, it goes pretty chaotic and you start preempting things. And sometimes in crypto, when you preempt something, it can go wrong, especially when you're utilizing a leading market indicator, which is traditionally used for normal market analysis in the stock market or the FX market. So please bear that in mind. Anyways, next video, we're going to start talking about other indicators on there. So a lot of other indicators out there, for obvious reasons, I don't want to go through each indicator. Why? Because this course will just be littered with them. I've picked the most popular ones for obvious reasons because A, I've used them, and B, they are popular. Now, as I've said at the start of this section, you can go onto here and you can do research at any given indicator. So you've got indicators, you've got strategies, hugely important. Obviously the volume profile, which is covered, automated stuff, and candlestick patterns. Now, TradingView over the last few years since I've been teaching has majorly evolved into a different animal. Makes life so much easier for you to do stuff. Now, based off data, it's becoming easier to do technical analysis, becoming easier to do trading because the data is already there for you. If you are rubbish with, for example, chart patterns, which openly admit I am, it makes life so much easier. The VWrap automated anchor is a huge element, and this is kind of the stuff that I want to kind of cover in this video because there's a lot of indicators out there that I've not openly massively used in the past, but do have some sort of genuine kind of use case which can be good. So the first one is the volume weighted average price. A bit of a beast this. Lower time frames only, boys and girls, on this one. More for the day trader, because what this is, let me just change the settings on this to give you a good idea. Now for me, and I know a lot of people do use this in the group, is very handy, but for me, I only use the one line. It's a trend line, basically, but it's giving you the average weighted level of the volume in terms of the entire market for this, you know, asset essentially, right? Go to the lower time frames, you can utilize it as a really good level of interest. Look at that, bang. A lot of people use this to enter trades. It is the average volume price. It's very, very interesting to see how this actually does work, and you can see by just utilizing it, it does work very well. Now what you'd look for here, if it pulls back towards this line, it may well become another situation of an entry. Look, I'm going to try and find a downtrend. There you go. So again, with the downtrend, obviously rejected the VWrap around that level and obviously melted. Again, above it, going above. You know, it's one of those ones where it's a bit wild, but at the same time, it works very, very well. If you're above it, you go long. If you're below it, you look to go short, essentially. Obviously, apart from the obvious kind of boom up to the upside here. But you can see how it recovered right towards it, and then look at the long bias. So that's one indicator out there that's relatively useful, that could be of interest to a lot of people. It works well in the FX market as well. Other ones to go through, obviously automated stuff. Now, if you want to do a fib extension as automatic, it's pretty wild to see how this actually does work. If I go to the higher time frame, go towards the, there you go. So it does it in terms of the old school kind of methodology. It's not the greatest looking thing in the world, but it's an automated Fibonacci for you. You can, if you wanted to remove, I mean, it's up to you if you want to keep it like that. You know, you can change all these levels as well, and you can change the depth. But at the same time though, when you actually look at this on the daily time frame, you know, you've got, you know, this kind of level already pinpointed for you. Pretty interesting to see how it has actually worked. For me, not too keen on that, so just bear in mind. But as I say, a lot of stuff. But go to indicators. There's a lot. Absolutely loads of indicators. A divergence indicator. Why is this important? It is utilising the RSI, but remember the RSI video. This helps you understand and discover bullish and bearish kind of divergences. Obviously a little bearish one there, bullish one here. Very, very important, right? The problem with this is it's quite lagging, so it doesn't really give you it in real time. But if you want to just look back in time and look at certain things to kind of identify them, you can, which is really, really important in the grand scheme of things. Obviously you can see how the situation hasn't panned out. Sometimes trading and analysis doesn't always work out. So that is another teaching point that you can utilize. Other ones, there's loads, I'll be honest with you. The cloud, this is something that uses a mixture of Bollinger Bands and certain things. I've never used this and I don't ever plan on it because it just looks like a mess, but it's a very, very popular strategy, and a lot of people do use it in terms of edge to edge. So going from one edge to the other edge is a very important strategy, obviously in a trending market. But that being said, as you can see, looks rather messy and I'm not really fully clued up onto it. Other ones as well, obviously you've got other volume oscillators and stuff like that. You've also got stuff like money flow. You've got super trends, which is also a very, very important one these days in terms of the trend analysis. It's basically based off the ATR, the average true range, which is a very, very popular indicator, which I've never really used before, but it does help you in certain situations. If I go super trend here, it can kind of give you a good idea of when markets are bullish or markets essentially bearish. Personally for me, not my sort of style, but the average true range here, which is basically this, the ATR here. So this is utilizing these numbers here and obviously looking at the height of it in terms of situations. It's great for profit taking and stuff like that. But again, it's one of those pretty complicated indicators that once you get your head around, it's pretty good. But as I said before in previous stuff, guess what? You can find out exactly how to use it, and more than likely, you know, give you a good indication of everything to the calculations and how to use it and what you're looking for. Hugely important indicator for profit taking if you're looking at certain things like that, especially when it's going a bit mental. Obviously, there's so many other things. So obviously, momentum indicator, money flow, moon phases, which you gotta laugh, but people do this. Basically, indicate a full moon, bright circle, or a new moon. You're gonna laugh, I know, but some people do chart based off moons. It happens. I've never used it, don't plan on using it, but you get the idea. If you're into that sort of thing, you can. Don't know why it does it, but for some reason prices move due to that. But this is a great reflection to tell you that the stuff that I said at the start of this video, not so much this video, but the start of this series on this course, was all about there's like 1,000 million gazillion ways to skin a cat. I'm showing you all the indicators, there's thousands of them. There's so much out there, and I'm going to go into public scripts as well very, very soon, where people have edited these to make them even better or for their own narrative, and they're putting them out public. If you are a coder, you can do that. But every different time frame has a combination. Every single indicator has a combination where you can edit and change to see different things. For me, I prefer the popular methods because I like to go on volume and mass on a common asset, so you're not going to get caught out too much. But some people don't, and that's crazy when you think about like how it can give them a potential edge, but also it may have a limited amount of time. Some of the most popular things in trading have a lot of time in the market, which makes sense, right? So you need to bear that in mind. There's other new things as well, like technical ratings, which you can see here. It's a part of the algorithm of TradingView. So when you go onto an asset and you go onto this bar here, as I've showed you before, it's basically this bad boy. So it shows you that on the chart, which is actually quite handy if you're looking for it in that situation. But for me, when you're looking at this, obviously the blue means good and the red means bad. It's one of those, isn't it? It's crazy. But I hope this video has helped. Please, guys, do your research. Please don't just go balls deep on a fully live account on this. Obviously, you can look at the strategies as well. A strategy tester will help you in terms of the MACD. You can see what the overall performance is on certain situations, whether it's bullish or bearish or whatever you want to look at. But for me, publicly, I will say this: do not do too many indicators, because you will start getting your head completely gassed up with ideas and you get really excited about certain things, when in reality some stuff you don't need to. Okay, so bear that in mind. So let's talk about public scripts. They are basically made by people or traders or even coders, and they're very, very handy. They're very, very good. So you can see here, editors picks, top and trend. This is a relatively new feature. Some of them are actually made by TradingView too, which is quite good. So basically telling us that it's probably going to become one of the main ones. So it looks a bit wild. Top ones, usually pretty interesting. Lazy Bear is a massively unbelievable utility user of multiple indicators. It's crazy, right? So you see Super Trend, that's now become an all indicator. There's loads. Boys and girls, there's loads. As you can see, I highly recommend you have a little look and play, because you will find some little hidden gems, and I definitely have in the past. It's entirely up to you what you want to use though, right? One thing I will say is though, if you go on to TradingView, go into this side here, go back to home, and then what you want to do, go over to the community side of it and go to scripts. And then one thing you can do, if you just press indicators, for example here, you can see it in more detail, right? So you can actually search for stuff if you're looking for something specific. So let's just say, for example, we're looking for, I don't know, moving averages, random number. But a lot of people have made moving average. I've got my own moving average, which basically combines 6 of them into one, but nothing great. But ultimately, a lot of people have changed them into like just visually just looking much better and more neater. But one thing that I will say with this is, so let's just, this one's took my eye already. If you click on it, it will give you like sort of instructions in terms of how to actually like utilize it, and it tells you description, possible usage, the settings that you can use, and free to use. And guess what? You can copy this and make it your own. You can adapt it and change it, and put it on your chart as whatever you want. If you want to add them to your chart, all you need to do is press add this indicator to favorites. When you do that, you then go over to one second, there we go. Couldn't figure it out. TradingView has moved an awful lot over the last few years. Go to indicators, go to favorites, and then what you're looking for is that new one you literally just plonked on, which is essentially this. 36 people have used it so far. Random, totally random, but that's how you do it. It's super, super straightforward. But as I say, right, there's thousands. There's so many. You can be building the perfect trading strategy for a long, long time doing this. But editors picks is usually the best one to go for, because these majorly help. So for example, whatever this is just telling us certain levels by the looks of things. I'm guessing. I'm not 100% sure. Oh, so this is the open and closes of like certain markets. So if I go on to the FX market, this will probably work a lot. There we go. Oh, hello. All right, cool. So this is giving you some information of like obviously when the markets are open and closing. Obviously, if you go to the lower time frame, you're probably going to get a lot more detail on this sort of. There you go. So yeah, you can see the pivot points there. You can see certain levels of interest on lower time frames. But this is one thing that I do like about this, right? Oh, there you go. More detail, range in levels. Oh wow, cool. So you can get a lot of information just created off all these little scripts that people make, and I will show you in the next video how you can actually make these, which is pretty interesting, right? But the one thing that I will say as well, some of the stuff that you can do, and if I go into my favorites here, let me just find some of the stuff that I've been looking at recently. Bear with me, let me just find some stuff, because when you look at these, right, support and resistance indicators, for example, right, really, really interesting sort of stuff here. If I click on this, you can kind of get an idea that if you're struggling with support and resistance, you can get this to kind of do it for you, which sounds random, but if you want to learn, sometimes it's good to learn via utilizing this alone. It helps massively. So one thing that I do like is this market structure by this individual here. I can't really say his name. I follow him on Twitter and he's absolutely unbelievable. But to understand market structure, this will help you as well, like the lows, lower highs, lower lows, break of structure. Oh, where's this going? I wonder. It's amazing what these tools can do. And guess what? You can also do, a change of character, where we've actually had a change of character. So break of structure versus change of character is obviously two different elements, right? Break of structure is utilizing the obvious there's the same continuation pattern. A change of character could be it's done something totally out of character, and obviously like this could be a sign of potential manipulation, potentially. So all these tools will majorly help you, but these have been created by people, And it's mad when you think about it. So let me do one more example. Let's go into the trending ones. Let's just look at smart money concepts by Lux. And again, similar sort of stuff. This is giving you where the money could be, where the money could be then distributed much higher. And this is on a much lower time frame on the FX market. If we go to Bitcoin, again, similar sort of stuff. Like really, really nice looking chart, which is actually giving you a lot of information, especially when you're looking at break of structure, change of character. It just helps you so much. And this is like a free to use indicator, and it's all there. If you want to add even more, you can swing points as well. Different color candles if you wanted to show different sort of situations around the candles, like there you go, bullish and bearish candles. Sometimes it removes a bit of the fun in that situation, but when you look at all this, it's just all there for you. Confluence filter, pretty useful as well. Obviously you can see that it has changed a little bit there, but for me it helps massively helps in terms of where things are. There you go, the highs and the lows of the week, so the premium levels as well. There's absolutely loads on this indicator. That's crazy. Wow, crazy amount of information on this chart. But as I say, it's all free. Someone's made this, and well, I say someone, it's Lux Algo. They make a lot of indicators. They do pretty well with it. But at the end of the day, sometimes it's a bit messy. But if you wanted to get some information, you want to look at certain levels. Obviously, these are levels of interest. You can see that they're very, very clear on a 10-minute time frame. Go to the 6-hour time frame. Again, the levels that you're identifying, which they're obvious levels anyways, because of where swing lows, swing highs are, and rejections points and stuff. But when you're looking to learn about certain breaks of structures and stuff like that, hugely important. Anyways, I'm not going to go too deep for obvious reasons because you'll be there all day. But you can find a lot of indicators that can majorly help you in understanding the chart, even if it's data, even if it's a learning point like divergences and stuff like that. There's so much out there that can help you just become better at charting because you're seeing things in real time. Everything that you're seeing on the screen is data. Sometimes indicators are just made just to make the data stand out better, which is a hugely important. So the one thing that we do have here is our own indicator. You get this on the Traders Lounge. If you go to our website, you will see the package for that. It's up here. It's the Trend and Momentum Indicator Pro. It's basically a hybrid version of the RSI along with momentum elements around the ATR and stuff like that, which does help you massively gauge the market. So realistically, how it works is obviously you got the divergences, as you can well address. More importantly though, in terms of momentum of the flow of the market, as well as an obvious level of 50% level. I call this a trigger point. It's not really highlighted on there, but it's kind of what I use realistically, right? So what we can see here very, very clearly, obviously, yes, you can see this nice little divergence appearing. It kind of gives you a confirmation when price starts to move down. When we go below this red line, as well as moving averages and stuff like that, you've got confluences. Those will give you a gauge of, oh, the market's starting to become a little bit bearish. So it helps. 2-day time frame, 3-day time frame, whatever time frame you want to work on, it works on exactly whatever you want to use it on, which kind of makes sense, right? So if you are swing trading, you may want to look for potential longs. What gives you confirmation? Well, the momentum indicator may well give you that, confirmation. You've got hidden bears, hidden bulls as well on here, not to mention the obvious overbought, oversold situations where you may well find reactions of price. Going into like the 5-minute time frame, which I know sounds scary, but again, you can kind of see how things are kind of playing out here. It makes sense. Certainly when you're looking at trend momentum, when you are above this level, the price is looking relatively strong. When you're going below it, it looks relatively weak. It kind of works in a very, very easy sort of obvious fashion. If you're following momentum, it works very well, but not to mention the obvious added divergences. Look at that for a divergence pullback. Obviously, you're not going to go against a trend, but ultimately, it kind of helps you to maybe take something off the table. The final bit on indicators is you can make your own. I've kind of alluded to it a little bit, but you can. It's a bit wild. So all you do, go to Pint Editor and, you can basically go to add a new one or whatever. It's up to you what you want to do. Obviously, you can rename it, find stuff, do whatever, right? When you go onto these little dots here, you can also go to the reference point. So documentation. This is TradingView's programmed language. There's a lot of like educational elements to it in terms of how to use it. So obviously the user manual here, understanding how it works, the language, all the stuff within, as you can imagine. It's quite a lot of stuff. It's crazy. So understanding it makes it easier. Go to the primer, you can kind of see using the scripts. For obvious reasons, this tells you a lot of things as well in terms of how to use it. Now, the one thing that I will say is you can actually copy a lot of these. So you can see a lot of these. You can take the element of it and edit it, which makes life so much easier when you're doing it. So, for example, if I go on to, like, as I said before in previous videos, if you go on to, say, whatever scripts what. So if I click on this guy here, you can look at his scripts. And this is a one here where, it's open source script. So you can actually copy this and utilize it for your own use and edit it and adjust it up, combine them together and stuff like that. So it's pretty interesting that you can do that. But for me, it's way over my head. So obviously writing scripts, learning it all, absolute chaos. But if you are a genuine coder or interested in coding language, you can build your own little script, which is pretty impressive, right? So obviously an untitled script here, obviously, yep. Pretty cool when you can do it. Now, obviously you got reference points and keyboard stuff. So if I put the reference point here, you got all the built-in functions, all the built-in stuff that you can actually copy and paste over. It's pretty mad when you think about how you can actually do this all in one platform and within the cost as well, which is pretty awesome. The reference point here. So all the stuff here, same sort of situation as before in terms of just not the pop-up. But as I say, tutorials. Highly recommend you get on the tutorials. Probably a lot of learning involved if you're new to this, like I am. I'm not really that interested in coding. But for me, as a fundamental element, I would rather use other people's scripts than my own. But as I say, a lot of them are open source, so you can copy them and you can utilize them in your own way. Let's talk about a plan or your plan to start trading or investing. Both the same, but you need to use technical analysis. You need to use a degree of common sense in terms of your life, in terms of risk, and we'll come on to it. So you need to plan this first before you start thinking, right, how do I do this? What do I do? Because a plan is always good, right? Type of trader. Do you want to start scalping? Are you looking at day trading, which is, again, pretty complicated? Swing trading, positional trader, or just become an investor? The reason why I ask this and say this is because of this. You have a possible family, you have a job, you have other commitments in your life, and you need to understand time frames. So when you're scalping, you're probably going to be basically sub 5 minute time frame, which sounds scary and crazy, but you have to be on those lower time frames. Day trading and intraday sort of stuff, you'll be probably no higher than the 1 hour time frame. Swing trading, probably between 4 hour and a daily time frame, so a lot more time element that gets brought back to you in terms of that. Positional trader, you're probably looking at the daily to the weekly time frame on a much bigger scale. And the most obvious one is the investor side of it. The weekly and the monthly time frame, you hold in a position for a much longer period. Now, this is kind of always obvious, but you've got to ask, how busy are you? When you are looking at the charts, now with scalping and day trading, you might be looking at a chart for about 3, 4, 5, 6 hours a day, getting multiple moves in. Swing trader, in terms of my life, I like to check my charts every morning. I like to just look, before I do anything, I look at the charts. Especially in crypto, it's much easier to kind of navigate that. If I'm doing equities, for example, or something like that in the FX market, probably look at it a bit more because obviously there's 3 separate opening times to every market. So then there's always a bit of volatility, potentially. Positional trader is something that I do quite a lot of in terms of just how I navigate my portfolio. I like to buy low, sell high, and I like to take profits. So I like to look at it as that as a hybrid. Yes, I'm an investor, but if something's popped off, I like to go, well, I'm going to take my profits, please. It makes a massive difference. And this is a thing that people forget. How much time do you want to be looking at the charts and checking your open positions, your levels of invalidations? Because when you have actually committed to your time frame, you also got to maintain and manage it as well. So when we're talking multiple positions on like intraday, if you've got an open position on, you probably don't want to be running away to the shops or whatever. Yes, you may want to if it's, if you've got a really safe stop loss and stuff, but sometimes you want to keep an eye on it. I often find the more you keep an eye on it, the more trigger happy I become. That's my personal belief. That's how I manage things. I like to ignore things, which is why swing trading is much better for me, because I can set an invalidation, I can set my stop loss, and I'm committed to that. I'll just let it play out. If it goes to my TP, cool. I can obviously manage it if things have changed, but fundamentals of the asset is simple. It will go up or it will go down. If you're day trading or scalping, you've kind of got to be around and looking at it for obvious reasons. Risk. Ooh. How much capital are you looking to introduce for trading? Obviously, once you've got a methodology, once you've got your backtesting done and you are confident, you can start introducing capital. How much do you want to put in? What assets are you trading? Some assets are much harder to trade than others due to leverage factors and other bits and pieces that may well come about. For example, gold is quite hard to trade due to the leverage. Quite an obvious one, but what leverage are you looking to use? As I've said, just with gold has higher leverage to enable the movement of it, but cryptocurrency you could probably get away with much less leverage because the volatility in the asset usually, for the most part, is much higher than traditional markets. However, that being said, it depends what you're trading. How quickly do you want to reach your goals? Ooh, it's usually a controversial one, that one. Everyone is different. Every person in a room will have different risk appetite, and some people will want to get there quicker. It will depend on them. How aggressive are you going to be as a trader or an investor? What I mean by this is how many trades do you want to do? How quickly do you want to grow it? How many investments do you want to flip in terms of time? Some people flip investments very quickly. They're investments, but if it pops off within 2-3 weeks, I'll go, right, I'll sell that and then I'll buy something else that's a bit more shiny and new. It just depends on them. Trading goals, an obvious one, I know, but needs to be talked about. Is it through trading or investing? You got to pick both essentially, and we're going to talk about separate accounts later on, so you do not get confused, because people do, right? You don't want to be doing that. Now, the fundamentals of this is simple. Are you going to be specifically focusing on trading, or are you going to be specifically focusing on investing? I personally focus more on investing than I do trading, because I prefer that. Trading for me is a bit of fun, a little bit of a separate account where I can just play with the market and have a bit of fun and not worry too much about it, whereas most of my wealth has came from investing, which is good. My purpose now is to maintain that investment. Easier said than done when it's a much bigger account. It's the same with a trading account, right? So make sure you understand what is going to be your primary focus. To a lot of people doing technical analysis, they'll probably start off investing first, and then as confidence becomes better and more, use of the market, you will start to do more trades and you'll start to feel more comfortable within the market and understanding the market. Then you can start to obviously split it up a little bit more. Another obvious one, are you looking to hit a sustainable number before you pay yourself? This is obviously for investing as well as trading. If your portfolio goes, wow, that's amazing, I've done really well here in the cycle, you want to pay yourself obviously, but at the same time though, you just don't know where things are going to go. When I first became involved in investing in 2015, 2 years later, I was not expecting to be in a position to be able to go, I can quit my job and actually maintain this lifestyle. And obviously a year after that, I decided to teach. It's an amazing thing to kind of do, and I could literally walk away from all of this and just invest and trade and just be quite happy. It's just I want to give something back, because I do feel a lot of the educational side of it is an interesting point, because I think a lot of it is misinformation, and a lot of people try and get to a sustainable number, but then they get greedy and then they don't pay themselves, and then that's where it all goes wrong, which is a problem, right? Is it to increase time freedom from working? Now that's one thing that I have often questioned. Like, I left my job and I wasn't expecting to, and I took on this. In ways I'm working more than I ever have, but I'm enjoying it more, which is a bit of a weird one. But to some people, investing for the long term, if you're getting older, you want to try and increase the ability or the likelihood essentially of being able to retire a little bit earlier. Even if that is 5 years, 10 years earlier than expected, because you've built a really decent revenue stream or you've built a decent pot of money over a period of the last 20 years. I will always say that if you're about 30 years old, like the same age as me, and you do not have any index funds or any sort of investments going, in 20 years time they could be worth a hell of a lot more. You got to think of the long-term game. If that means that you've created an extra 50, 60, 70 grand out of thin air, and it allows you to retire 2 or 3 years earlier, or able to have a better lifestyle, you should probably go for it, in my opinion, right? That's ultimately the goal, and that's over a period of a long time. Another one that's a bit of a random one, obviously, is it just a hobby, or is it something that you love doing that is totally different to your normal average daily thing? A lot of people do not invest, a lot of people do not trade, a lot of people who are here are a bit of a different grain. They want to do something for them and they want to improve their lives, and it's an amazing element that a computer with some chart on it and investments and data can make you a lot of money if done correctly. It's all down to you. I cannot teach you your own mental game. You've got to learn that yourself. Once you figure it out and you've got a decent strategy, you can improve it and enhance it in line with what your risk appetite is and all kinds of good stuff. To some people, it's just a hobby. To some people, it's just a whim. We'll call it a whim in the UK, where you just, oh, I like that. You know, it's a little thing that you do for a month. Everyone does it. Go to the gym, want to work out, you only last for a month. Or you start a new hobby, you start playing a new game. To this, in my opinion, it's a lifestyle. And it could be a lifestyle for the next 20 years. And as I say, it may well increase your likelihood of being able to retire early or do better things in your life. Is it to accumulate wealth over a longer period of time? Again, key element. Is it over investing or trading? Now, as I say, if you're making good money over a period of years, it's a great thing. If you go through multiple bull cycles in the crypto market and you're buying low, selling high, there's a good chance you may well end up with quite a lot of money if done correctly. It's all about the game, right? But it's all about risk management, which is what the next section is going to be absolutely littered with very, very soon. Now, trading rules. This is very random, but you got to think of some trading rules as well. You got to kind of ground yourself. Are you only going to trade or invest when you're at home? For example, you don't want to be on the bus or on the train and someone says, oh, have you bought this? And you start scrambling for it. Don't do that, because often it's an emotional element, right? You've got to be emotionless, which is easier said than done. Certain types of setup only. So when we talk about setups in a second, you've got to think, well, is it mine? Is it going to fit within my parameters? Big one. Risk percentage. Is it always going to be the same? Or are you going to flicker between different ones? Are you only going to be trading the same couple of pairs? I recommend this, by the way. You know, you don't want to go too deep. You don't want to look at certain things. If you're trading the FX market, maybe trade 2 or 3 different pairs all the time. I would say the same in crypto. Don't trade too many. I mean, no more than 6 or 7 you want to look at. Most of the market moves the same anyways in crypto. Same with equities. Why would you want to trade something that you never heard of or you're not in the country? For me, yeah, keep it simple. Never trade on your mobile. That's a great rule. In all honesty, I don't understand why people do it. Personal opinion. For me, the trading and finance game is all about big screens. It's all about computers. It's all about understanding the market narrative. For me, going on a very, very small screen and trying to do chart analysis is very, very hard. You will often miss things, and sometimes the apps are not as friendly as you think, certainly when you look at it in terms of risk management. So for me, I always set that rule. It's just the way I am. I don't have any mobile phone apps on my phone in terms of charting. I have it just to check up on, but I don't act upon it. So that's the only reason why. Always set a stop loss no matter what is a great rule to have. Kind of obvious. We will talk about them in a later date. Now, trading methods. Now, these are just random. Everyone will have a different element to it. There's a lot I've missed, but it's just to kind of give you an idea. When you do a plan, you need to try and figure out what are you going to be trading as, i.e., is it going to be something like support and resistance as an example, which is a very, very good way of starting out. Are you going to use a Fibonacci, which is a good, confluence with support and resistance? What about this though? Are you going to be just looking at momentum? utilizing the likes of the RSI, the MACD, alongside candle structure, which is also very, very helpful. Market structure analysis, understanding change of character, break of structure, trend analysis, uptrends, downtrends. Are you going to become a breakout trader? Some people like to put a little triangle on their chart and go breakout, but for me, it's not really my sort of thing. Are you going to be indicator led? i.e., are you going to have multiple indicators that's going to give you a lot of different signals to enable you to go through it? So, for example, like the cloud, certain types of moving averages, MACD, RSI, or a combination of all 10 on each chart, and it's like absolute gobbledygook, but some people understand that. Are you going to be a volume-led indicator? Order books, volume profile, all that kind of stuff in terms of indicator kind of money flow, which does help. And finally, don't do this. Don't become a copy trader. Do not be like, oh, what are you doing? I'll just do that. I'll copy that. Everyone sees different things. Everyone has a different end game. Everyone has different risk appetite. Different time frames, different ideas will always merge into something random. Don't just copy it.
Risk management is literally the number one most important factor when it comes to trading and investing. Risk management will be what stops you from blowing up trading accounts and essentially losing a lot of money, whether that's trading or investing. So what I'm going to do is show you a real quick basic example of what risk management looks like using the same format that I use on the Earn While You Learn program in Premium. So first of all, we're going to start off with position sizing. So what I like to do is I like to only risk 1% of my trading account per trade. Now, it doesn't sound like a lot, and there's a reason for that, and that is because you really, especially when you're starting out trading, you really want to start out small because you're more than likely going to lose a lot in your first year, 2-3 years of trading. It's a long road. So you obviously want to be much rather be losing a smaller amount than a huge amount. A lot of people go swinging for the fences straight away, and as I say, they come out on the losing side. I've done it myself, and as I say, I regret not starting off smaller. So what I would say is risk 1% of your account. So what that would look like, say you had $1,000 in your trading account. On each trade, you're going to place $100. So you're going to put $100 on the trade, and then you're going to place a stop loss 10% away from your entry, taking into account leverage. So I've got a quick example here. So this is a tool you can use on TradingView, which is wrong bit, which is just here. So you've got it on the long and short position. So I've got a long position here, for example. So this line here at the sort of, well, not middle, but you know what I mean, which divides the two colors, it would be your entry, and then that's your profit, and that's where your loss, your stop loss will be, as I say, in a long position. Obviously in a short position it's reversed. So when you're taking into account leverage, so if you were to use 2x leverage, for example, obviously that you're going to multiply the profit or loss by 2. So in this example, if you've got 2x leverage on, then if you hit your TP, which is at the top, then you're going to make 20% profit. If it hits your stop loss, then you're going to make a 10% loss. Okay, so your stop loss is only going to be 5% away from your entry because you're using 2x leverage. Obviously, if you're using 5x, it's going to be 2% away, etc., etc. So as you can see, the higher up leverage you go, the smaller room for error you have. So $1,000 in your account, $100 on each trade. Your stop loss is 10% away, but taking leverage into account, if you're, for example, as I say, using 2x leverage, it's going to be 5% away, and that means that obviously 10% of $100 is $10, which is 1% of $1,000. So that way, even if your stop loss gets hit, you've only lost 1% in your account. You've lost $10 out of 1,000. It's no big deal. You can then just chalk it out to experience, journal it. What went wrong, how would I change it next time, and then move on to the next trade. And if you stick to this religiously, you shouldn't blow up your trading account because you would need a lot of losses in a row before you blow that account up. So start small and be disciplined with your risk management. Now, Going on to risk reward. So as we've got down here, I like to operate on a minimum of a 2-to-1 risk reward. And with that 2-to-1 risk reward, as you can see, you only need to be right about 40% of the time. So again, nice basic demonstration. Let's say you got 10 trades, and let's just say for argument's sake that all 10 trades are either going to hit stop loss or your take profit area. So if you're profitable, you're going to make a 20% gain. If you're wrong and it hits your stop loss, you're going to make a 10% loss. So 10 trades, out of those 6 trades, let's say, out of those 10 trades, let's say 6 of them hit your stop loss. So you would have 6 losses at 10%, which would be minus 60%. However, your remaining 4 all hit your TP and make you 20% profit each. That's obviously going to make 80%. So your 4 wins are going to actually cover and then give you profit on top of your 6 losses. And that's an example of why risk management is so important, because it doesn't matter if you lose more than you win. As long as you're disciplined and you've got obviously done the maths right, and you stick to your game plan, you don't need to be right all the time. A lot of people believe that trading is about getting it perfect every time. You really don't. As this example shows, you only have to be right 4 times out of 10, not just to break even, but to actually be profitable. So just a little basic lesson in there. Obviously, it's completely up to you how much you put into your account, how much you risk per trade, what your risk reward ideally wants to be, etc., etc. But just a nice, real basic example of how easy to make it, but how important risk management is to help you avoid eating up those huge losses, which are going to affect you mentally and probably end up leading to you blowing up your account, which is not what any of us want. Backtesting is a really important part of developing a trading strategy, particularly if you're using indicators, as you can literally just go back and see how your trading strategy performed in the past, and then obviously get an idea of how it might perform in the future. So one tool on TradingView that you've already seen me use in previous lessons is the replay tool. However, one aspect that I've not shown you yet is that you can actually use this built-in buy and sell feature. So basically, if we just knock it back to a random point in the chart, let's go down to the daily time frame, for example, and you can literally press, say, a buy button, and then you can sell the position whenever you deem. So let's see if we're getting some profit here. Boom, sell, and then you can do the same if you want to short. Happy days. And then you can literally see the profit just down there. So that's a really cool way of rather than you're using old school pen and paper, you can actually do it on the charts. So you can do it alongside your TA. And then what you're going to want to do once you've done some back testing is you're going to want to do either paper trading, where you are quite literally just following the market current day and sort of writing down where your entries and exits would be and seeing how that worked out. Or what I would suggest is slightly better than that, is basically doing paper trading, but with very tiny amounts of money on an exchange. So in the lesson we did previously about risk management and position sizes, rather than using like a proper sized account, maybe use an account that's literally got sort of 10 or maybe sort of $100 in there, risking $10 on every trade. So then you literally lose $1 should the position go wrong, because obviously you're still testing, you're still working it out. But the edge you have on doing that as opposed to paper trading, not only do you get used to pressing the right buttons on the exchange so you don't make any mistakes when it comes to your larger amounts, but also you're actually getting a feel for actually putting some real money on the line. Because even though it's just $10 or $1, whatever you're risking, that actually makes a big difference to just paper trading. And you actually initiate the trade as well, rather than just sort of putting pen on paper and saying, oh, maybe I'd have entered here, maybe I'd have entered there. That you're actually pressing a button, and you can't lie to yourself, basically. So really good idea if you're going to develop a trading strategy. Use the replay tool. Record how well the trading strategy was done, and then use it in real time as well, as I say, either paper trading or using a very small trade. So when it comes to building a watch list, what you're going to want to do is try and keep it fairly concise. So what I mean by that is you don't want so few, so we're talking obviously specifically trading, you don't want so few that you're not going to see any moves, because if you literally just had 1, 2 or 3 trading pairs, you're not going to see trading opportunities all the time. There are going to be days where those 3 trades just aren't on, so you want quite a few options to be able to cycle through, but then you obviously don't want loads that it's going to take you a long time to actually go through those pairs on a daily basis. So in my personal opinion, I think 10 is around about the perfect range of enough to give you enough variety, but not too much so that you can't get through all of them at the same time. Also, when it comes to making your watch list, this is obviously either trading or for investing. You can actually, a pretty cool feature in TradingView, you can have these little subtitles. So as I mentioned in the charts to keep an eye on, these are my majors. These are what I keep on all my watch lists, no matter what, because they're quite important, as I say, to keep an eye on. Then you can literally add, you can add a section just there, as you can see. So we'll call that maybe trades. There we go. And then you can move that down. And then maybe, so add some random symbols, crypto related. So we had ADA dot and near before, and happy days. And then maybe you've got like your investments or something like that. So then you could knock that down and go investments, for example, and then add, I don't know, random one, let's go Matic, for example, and stick that on there. So once you sort of get into the swing of trading, and you've got quite a few trades behind you, what you can actually do, I use a service called EdgeSheet, which gives you all sorts of statistics and follows your trades and gives you all sorts of information like that. Obviously you can do your own via like a spreadsheet or something like that, but track your performance on each pair, because what you'll find is that there are certain pairs that you trade really well with and you can read really well, and others that you just don't. So for example, on the Earn While You Learn, I think I lost all 4 trades that I took on Sol USDT. So now going into the next year, I'm just not going to touch it, because there's no point. You might as well stick to your strengths, find what the pairs you're really good at trading, and then trade those, because no point making life hard for yourself. You know, swallow your pride and say, okay, can't trade that one really well, can't read it that well, I'll stick to the ones I can. So that's another example that you might want to use as you go deeper into your trading or investing journey, even if you do some sort of longer term swings and stuff like that. Figure out what pairs you are good at trading and what you're not. Drop the ones you're not good at and stick to the ones you are. So one of the main reasons it's very difficult to provide a sort of cookie cutter, one size fits all trading strategy is simply because everyone has a different life. So some people are available at different times of the day, some people have different responsibilities, wives, kids. Some people have work a lot of hours, some people few, some people nights, some people days, etc., etc. So it's very difficult to find that one size fits all. So you need to personalize things for yourself, whether it's a trading strategy or an investing strategy, whatever that might be. You need to find that time of the day or every other day, week, however, whatever time frame you're operating on, where you can consistently have time on the chart. So I saw a massive improvement in my trading performance when I started the Earn While You Learn, because it meant that at the same time every morning I had to get up and look at the charts, and by doing that consistency, that routine, that made my trading a lot better. So as I say, whether it's trading or investing, you need to figure out how that consistency and routine can fit into your life, obviously without with it having a minimal effect on other things. And that's probably the first thing you need to identify before you then go on to develop a trading strategy, because if you can only get onto the charts once or twice a week, then there's no point you trying to learn how to scalp on a 5-minute time frame, because you're just not going to have enough time to put those trades in. You're probably going to want to look at like a higher time frame strategy where you're looking at daily and weekly candles, or maybe even monthly candles, stuff like that. So find that time you can get on the charts, build your routine around that, and then build your strategy around your routine.
So the importance of a separate account is massively important when it comes to trading and most importantly investing. Some people get caught up in the headlights of an asset doing something, whether it's going up or down, and this often means, selling their existing investment bag to trade it, to try and make more money. Now, what I will always say is separate, because imagine this on the chart, right? Just a random example. Bitcoin pushes to the upside here, right? And you've got an investment bag that you actually bought as an investment to think, oh, well, I'm just going to buy it down in these levels for the long term. And then all of a sudden you flap it. It's like, all right, I'm going to sell it. This one worked out well, but what about if you did it wrong? What about if it carried on going higher and your investment actually, it's just like, oh, damn. You'd be careful. Likewise, the other way around. It's trying to sell it for it to go lower to rebuy more, and it carries on going up as well, which is always a big problem. All the opposite. They get the drift, right? So always have a separate boundary. Always have trading accounts, which we will talk about towards the end of this course, what you can use. Put money in there just specifically for trading. Just specifically for that. Your investment spot bags should be A, on your ledger anyways, and B, should be long term, as in risk reward of a much higher element, where potentially you could be buying at 16k levels, looking to distribute about 40, 50, 60, whatever in the future, right? Long term. So please remember that. Please don't be like flapping at things because, oh my God, there's an opportunity here. Sometimes doing it that way is the worst way. Try keep him totally. In terms of building a plan, you kind of have to have a few ideas, and this video is all about some little potential ideas you can use and utilize to build your own trading strategy, your own little thing that will clearly work. Now, I want to go over to the Ethereum chart on like whatever time frame. We'll go to this section here. It makes life a bit easier because it's moving. Now, for me, you got the obvious support and resistance, right? With regards to that, depending on your time frame, you need to look at certain things. For me, I like to do a top to bottom analysis, which has been covered via guys in this course. Now, going from those higher time frames to see key levels, going a little bit further down into whatever. But obviously on the lower time frames, you're going to be not looking too much at those bigger levels, but more the levels within to enable you to get to that destination. So support and resistance may well be buy low, sell high at certain key levels. Now obviously you can see what's happened here, but when you're going down, you can see where all the previous levels are. So obviously if you're looking to potentially go short here, it's a massive area to kind of drop into, but also you got all these levels of interest. But with regards to that, it depends on what time frame you're using. Now let us just go on to say the 4 hour time frame. Let's try and do some more examples. Now when we're looking at levels like that, it's usually important that we get a good idea of what could be happening in the future, because when you look at like levels like this, could actually be a big level for the future as well to keep an eye on, because that's where the market could go. Now, as I say, with support and resistance is very, very subjective. It's obviously depending on what time frame you're looking at, what asset you're looking at, and obviously where the market currently is. Right now, we're more in the channel of like where we are right now, i.e. down here. This level here, where we've literally just rejected off, so if I just pop a box here, we got a lot of interest in and around this region where we've actually consolidated for a bit, we've actually bounced around support levels, resistance levels for a bit, and now we've rejected again. So stuff like this becomes a massive important level. Obviously looking at the prior levels as well, just a big box, nice here. It's straightforward. It is super straightforward when you think about levels on a chart. It just depends on what area you're looking at. Now you can see that this was a level of interest where we've actually pushed through, went into the middle of the range, and then back into this level, and then obviously back up to this region here, which, as you can see, to the left. So that's an idea that you can kind of ponder with on terms of whatever time frame you're looking at, just simple support levels and resistance level. Now, another thing you can also do as well is look at the likes of Fibonacci to aid that confluence point. With a Fibonacci sequence, right, you've got to look for the swing low and the swing high. It's pretty clear. This is the bottom of the move, this is the top of the move, right? When you push that all the way along, even looking at that, we pushed all the way down, level of support found, went up, failed, went lower, broke below the 382 into the 618 levels, and then we found a level of interest around this point, closure, and off we go. we rejected right at that level. Huge level, huge spike to the upside, and we've rejected. This is all on the 4-hour time frame, and it's just market structure. When you remove all the information around from that, now it does look like a bit of a mess, but you pushed up, you broke a structure here, and you pulled back into a range where it then became a level of support. So breakout of resistance into levels of support, and off we go. That's it, simple. Now, in terms of the next move, you're looking for the next swing. Now, it's up to you which one you want to use. Now, for me, I wouldn't use, this is obviously the bigger move, so I'll probably start off at this point anyways. In terms of this was the start of the move, you can see how big it is on the lower time frames. Go on to the daily time frame, it will look a lot better. Bear with me, let me just try and figure this out. There you go. So on the bigger time frame, that was what we were looking at. We looked at this, up to here, this is the move point. This is the next swing. This is the swing low to the swing high. If this then closes, you've got a potential pullback from this region, which could go towards here and then potentially even higher towards other levels, which, guess what, right in confluence between this level of structure, this level of structure, this level of structure. So Fibonacci could be a massively important factor in terms of how you look at the market. Other things as well, moving averages, up to you. Whether you want to use stuff like this, you can, you don't have to. But as I say, just trying to jog your memory in terms of stuff like, golden crossovers, death crosses, whatever it may be. Now, the most common one that people look at, which I think is probably the most pointless these days, is the stuff like this, the death crosses and stuff, essentially here, right at that bottom, not really worth utilising realistically because you're getting a massive drawdown until it obviously melts further. Now, up to you. Personally, I would never use the stuff like the death crosses and golden crosses. It's far too subjective. On the stock market, not too bad. However, on crypto, far too volatile. So try and stick to something a lot lower, maybe the 20 and the 50, a lot better, a lot easier to kind of understand, because you'll see very, very instantly how much easier it is to look at certain things. Now you can see that bit of a mess. Utilize them as not crossovers, but as levels of resistance and support, as you can see on a lot of them. Quite useful, very, very useful. It's up to you. Again, same with the EMAs. EMAs, fantastic tool. I would always recommend using just one EMA. So for example, in this case, the one that I like to look at a lot is the 8 and the 21. So the 8 EMA basically follows the price pretty closely, but becomes a very good level of interest and confluence on the higher time frames. Another one is also the 21. Now, when we go into the 21, it's just a very, very clear action of where the price actually going, which is actually pretty useful, but also becomes a very, very, very important level of resistance, which is where we've kind of failed. May well be going to go and retest that at some point soon. It makes a big difference, right? But that's kind of the simple lines of it. But obviously you got, as we know, the RSI. A lot of people like to combine this and other indicators such as the MACD. When we look at this, bear with me, let me just remove some of the noise. I'll just utilize it like that. So when we're looking at this, for example, that is obviously your RSI. Cool, we're in. Now, another thing that people like to do as well is use the MACD as well. So have the MACD and the RSI on the same sort of chart and analysis, and utilizing momentum for what could be happening in the future, right? So when we got divergences and momentum flowing up to the upside, and obviously a crossover to here, you may well be looking at, well, potential longs could be happening at these points, right? Momentum is changing, it's more to the upside than it is to the downside across the baseline, well, the midpoint or whatever it's called. I think it's a baseline. But yeah, you get the idea of where this is going, but at the end of the day, I still find that these are incredibly risky in a market condition like this because it isn't really fully trending. In the past, when we look at the past data, you can see very, very clearly overbought situations and are massively inflated, as you can see here with the MACD all the way up here. A huge level where you can actually see, oh, hold on a minute, we actually could be coming down. And then again, you see, the trend element of the market structure. Oh, okay, potentially looking at, weakness here. Okay, it's showing off. And again, you can see it here as well. Same sort of situation, turning around, going below that midpoint. Utilizing momentum is a hugely important factor. So in terms of all this, you need to figure out what works for you. What indicators you like the most look of. There's loads of stuff out there. There's thousands of indicators. I don't want to go too deep on this because I will be here all day, because you can go through so many different things. But the one thing that I want to say will remain true. Market structure of the candles is always important. The most important thing is understanding what trend direction you're in. Utilize the tools available to enable you to become better at seeing trends. Don't go against it, follow it. Now, as your trading plan will progress, you'll get better. You should be paper trading or just like dummy trading essentially as much as you possibly can to enable information to look good. You can use a strategy tester if you so wish to, but go back in time, see what it does on the backtesting data. Is it actually going to work? Obviously, forward testing is where you need to do the proper tests. But for me, the information is all there for you. It's just understanding what works for you. Every time frame that you use will be different for you, no matter if you're an investor or a trader or whatever you want to utilize. It just makes more sense. But the fundamentals are clear. You need to understand your own trading style, your own trading methodology. You need to build it. If you build it, you understand it, and then you can go from there. This is in a horrible downtrend. You can just see it by market structure, right? But it's starting to see like a little bit of slow grind and consolidation. Whether this level holds or not is another thing. But it's interesting to know that a lot of people will be looking at shorting this. Personally, I would rather not, because no one likes a short bottom. But the reward of it going through that level could be huge. And if your trading plan allows shorting, you may well find that, you know, when you can play both sides of the market, no matter what, you know, way in the no matter what indicator you use, it doesn't matter where you're shorting as long as the methodology works, which it should. So let's talk about profits. It is very subjective and also very tribalistic in crypto to take your profits. A lot of people have the narrative that, oh, if you buy and hold forever, it will be okay. It really isn't. Look at the chart in front. This is Ethereum, right? Just an obvious outlook. And if we're looking at BTC, similar sort of situation. Even though over the course of time, yes, if you bought when I did back in 2016, 2017 sort of time, you're up quite a lot. However, not everyone is as fortunate as myself or others around you. The fundamentals are simple in any investment class. Profits are subjective. It depends on so many narratives, right? And this is why I'm trying to do this now, so when you go into the risk management, you can understand the importance of it. But in the psychology course, you understand why it's also important to enable growth. You may be on a lower time frame. You may have already made enough money from a really good entry, i.e. buying down here, for example. Every single time we go into a bull cycle, we pull back. We pull up, we pull back. We pull up, we pull back. Pull up, pull back. If you took profit on every single parabolic pump, you are protecting your capital and you're able to then potentially grow your capital via redistributing back lower. But not everyone can do that. Not everyone wants to do that. It's subjective also in the tax matter as well. A lot of people don't want to pay taxes because you are in control of your own destiny with taxes, i.e. how much you sell, how much you buy, all kinds of good stuff, right? But there's other indicators to look at. There's other indicators in terms of moving averages. There's Fibonacci stuff. There's support levels, resistance levels, target levels, time frame target levels, swings. There's so many different variables. It's unbelievable. But a lot of people will not like it if you take profit if you are in a very heavily led community-based crypto asset or even a stock, right? If you are selling something, and maybe it's because I've got probably a following, maybe, possibly, but still, if you are vocal on social media saying that I have taken profits, now that's where my problem lies. Is I'm in that situation where I like to be transparent and I've got a following and I like to do a journal. When people find out that I am either selling or moving my assets around, they often question, oh, what's wrong with it? It isn't because it's going to die, it's because I want to make and keep my money. So it is very, very subjective. Please make sure you've got your own targets. Don't copy other people's, because you may well find that in hindsight it might be a wrong decision or a right decision. You just don't know, right? So bear that in mind when you are thinking about your stuff. Always hodl something, keep hold of something, but always have something that you can obviously distribute and play around with, because everyone wants to make money, right? So we're going to talk about risk management, the unsung hero of everything that underlines the fundamental element of trading. Without risk, there's no reward, and risk management is the biggest thing for why people fail. Most people have a really good knack of finding a good profitable strategy, but they don't give it enough time, they don't use risk properly, and they often over risk, and then when the losses do pile up, you lose money. You could have a 30% win rate and still be profitable in dollars, which is crazy when you think about it in terms of a trading strategy. Personally, I don't like that. I don't like losing, so I like to have a more high profitable kind of strategy that works well with momentum. However, what you find is a lot of boom and bust traders. Now, I think looking at any chart, going to the line chart, could show you anyone's net worth of a portfolio, right? Random as it sounds, you get boom and bust traders where in a bull market, they risk and risk and risk in longs and just keep going up and up and up. And obviously, yes, you make money. But as soon as it changes, as soon as that tide and that trend changes, you have to change your risk, right? Because you'll just lose all your money. And a lot of people's portfolios will look like this in terms of just a normal boom and bust sort of trader. It's a bit scary when you think about it. However, what you're looking for is more of an exponential kind of line that does kind of just fly up, essentially. Not so much fly up, but just goes up, but not in an aggressive level, but just nicely. Not like boom, bang. You get what I mean? It kind of makes sense. Now, in the next few videos, I will talk about it in more detail in terms of risk reward, in terms of percentage levels, all the sort of factors that you need to kind of consider. But one thing I will say in this early introduction is you need to pay respect to it, because you need to protect your capital at all costs, whether you are an investor, whether you are a trader. Being able to not get caught up in all the drama and all the emotions on likes of YouTube and Twitter is a massive factor, even on our platform, on premium and stuff like that, or even when you're getting excited about this course. You will want to invest straight away. You've got to have that degree of knowledge and information to help you. Risk management will enable you to take losses, will enable you to take profit, and most importantly, just manage it. Sometimes people will say to me, oh, should I sell? Well, why should you sell? You need to ask that question yourself. Are you worried about further downside? Have you over risked anyways? What is the question prompt that has allowed you to do it? It's a big fundamental problem that we have in this market, is because you want to make more money, but you don't want to lose it. And most people end up losing it because they have already bought at the wrong levels. Buy down here, you got all the upside to worry about taking profit. Buy down here, not too bad. What about if it goes lower? Even better. Even if you buy here and you buy down here, that's a good strategy. Buying here and selling down here is a terrible strategy. You got to remember that for risk management. So with risk management, in my opinion, it is the unsung hero. It enables you to do so much more with your money. It enables you to understand what you're doing, and it will allow you to take risks that are actually calculated and planned. When you know the plan, when you know what you're doing, it's fine, because as soon as a position goes against you and you're in drawdown and your risk management is poor, you'll feel it quickly. All of a sudden, a 2% move is like, oh my God, I've lost a lot of money here already. Oh dear, it's going to get worse. And my stop loss is all the way down. Where? Be careful. So the unsung hero, always pay respect to the risk management element. If your risk management is on point, your strategy, no matter what you do, could make you money through consistency, which is a very, very scary prospect. So risk management and a percentage rule. Hugely important, this, and it also requires a little bit of a calculator. It depends on you. This is a massive factor in terms of why people lose money, is because they over risk without understanding what they're doing. If you've got $1,000 in an account, you don't want to be risking $500, $600 on a trade. It's kind of stupid, let's be fair. So what do? A little bit of a trick, and it helps you understand leverage as well, which we'll talk about in more detail later on. But when you are on the likes of Bybit in crypto, you got the order price, the quantity of what you want, and then you've got, obviously, are you going to go long, take profit and a stop loss, or are you still in short, TP and stop loss, right? I'm hoping you're gathering it. There's not much information you need. When you're going to go long, you need to understand, well, where are you going to take profit? where is your stop loss. Now the stop loss element of the percentage rule is where this is very, very apparent. You should only be risking a couple of percent per trade, and that is what you are willing to lose when your stop loss is hit. You are in full control. You need to work your way backwards from your stop loss. So when you do your analysis, for example, so let's just look at Ethereum here, right? This is what you do. You would work out, right, what do you want to do? Now this is going to be totally random, by the way. I'm just going to throw that out there. So let's look short. We're in a downtrend, and let's just say that you're looking to do orders in between this kind of level here, right? And you've got a clear invalidation somewhere, whether that is at a certain point up here somewhere as an invalidation that, hold on a minute, it's not looking great, right? It's not the greatest example, but it's giving you a kind of an idea that you're looking for potential confirmations of rejections at this point for a potential leg down. Now, important factor, you are in control of your destiny, and we will talk about the risk reward tool in a second, in terms of where your stop loss, this bit up here, is going to go. Now obviously your TP could be where we, oh, that's on the side here, for example, randomly. Now obviously the risk reward's huge, but the amount that you put on a trade in terms of quantity and order price will determine how much money you can have on a trade. Tip, how much money you can have on a trade. Now, for obvious reasons, no matter where your stop loss is, this box should be a percentage of what you are looking to lose in a trade. So let's just put 50 on here. Actually, that's in BTC, that's random. I don't know, 0.0, I don't know, 0.1. Bosh. So the value cost of that is a decent chunk. It's 1,600. Obviously, for obvious reasons, it is on leverage 2x, not massive, right? But for obvious reasons, right, let's just say 25% drop on a 2x, obviously half that, 12.25, whatever, right? Not too bad. However, you don't want to lose that amount of money. If you are looking to risk 1,600, you need to have at least quite a decent chunk of a portfolio, because that is $210 you are looking to lose. So if you are looking to risk, say, 3% of your account, it has to be whatever 3% is as an equivalent of that versus 210. You can probably do the maths. You probably argue it's quite a decent chunky account. Obviously, if you're looking to take profit and make money, you know, yes, you can make 400 per trade if you're looking to do a 2-to-1 ratio. Give you an idea, right? So whatever you are doing, you're working back from your stop loss level. So whenever your stop loss is at a certain point, you will know, right, if it's too much, I risk less. If it's not enough, I risk more. Does that make sense? I hope it does, because that percentage rule should be pretty much the same across the board. If I was to say, improve the stance of this, riskier moves, risk less, more obvious and more kind of good situational plays, whether that is a part of your method and you know it's a higher probability, maybe risk a little bit more. But the percentage should always stay the same, whether that is 3% every trade as an example. Could be less, could be more, up to you. I like to do 3%. So one thing you can do as well, go onto Google and put in percentage of, and then what you're looking for, oopsie, I don't even know if the website is, work out percentage of, there we go. So what you'll find, there you go, a percentage calculator basically you're looking for. You want to know what your account is. So when you've got 3%, for example, when you say you've got 5,000 in your account, you are risking $150 every trade. For obvious reasons, if you start winning trades and it starts going up, obviously you just keep doing the same thing where you add it and then obviously the risk will go up. It stops you from losing massive chunks of money every time, unless you lose 10 in a row. That's obviously different, but there's a high chance that you're never going to lose 10 in a row. You'll always have a break even, you'll always have slight profit somewhere. It's just the way it is. But when you start making money, you start noticing this. But what people tend to do is they tend to increase their risk. They tend to go 10%. Like, right, sweet, let's go for it. And then all of a sudden they lose that one trade. It's like, oh no. They start losing their account. So that is why the percentage rule is massively important For me, this is what my specific rule is. It sounds rubbish when you've only got, say, I don't know, $150 in your account and you're using 3%. It's like, oh, right, cool. But it grounds you, it keeps you going. And at the end of the day, if you are looking for a 2-to-1 or a 2-3, so a 1-to-3 sort of ratio, you can make some good money. And we will talk about risk reward tool in a minute. But please remember this obvious tool thing. Just keep it simple. Boys and girls, keep it simple. You should not be risking a lot. Trading is all about compounding, it's all about growing. If you do 100 trades in a year and you win 60 of them and they're all at the same level of risk, you will have made money somewhere, because no matter how high it goes, it's the amount that you lose. If you lose 40% of your trades and you're only losing 3% of your account, but every single winning trade is 6% more, like, or double, or whatever double ratios are, you're fine. Absolutely fine. Very, very profitable. The risk reward tool, a very, very simple tool to use, and it's just very, very common, simple maths, realistically, right? For every one thing that you're risking, you want to make more of. So, for example, let me get my little text box out. If you're looking for a trade setup and you are risking, say, $100, that would be the 1. For every $100, you're looking to make 2. Make sense? Good, because you're doubling it. So, with that in mind, say you're risking 3% of your account, so 3% risk is your stop loss, which is basically, I don't know, $100. For every single time that you're trying to double the amount of money in that risk bag, your profit line should enable you to make double. Make sense? Good, because you kind of want to do that. There's no point going for a 1-to-1. There's no point going for a 1 and a little bit, because you're going to lose more than what you're potentially going to, get rewarded with as risk, if that makes sense. It's quite hard to explain. But for every single time that you're making double the amount, you're going to be, making money. So every 100, you could be making 200. For every 100, you could be making 3. That is how the ratio kind of works in simple kind of adequate maths. It becomes pretty hard because you're trying to make 5 times the amount of risk. And if we put this as a visual representation, you will start to see. So this is why your entries should be bulletproof. This is why they should be on point. And this is why also laddering in, which we will talk about later on, will make it a little bit easier, but also becomes a bit more complicated on the old mathematical brain. So in terms of the requirements here, let's just say the invalidation level is going to be above this region here. Nice little tight stop loss, for example, right? So in line with this, a 2 is the 2 here in the middle, right there. So if you get stopped out here, you will lose $100. If you go to here, you will make 200, because it's obviously double the amount. As you can see, monies, yeah. 3, boom, down here, right? Makes sense? So you're looking for setups like this where you've got minimal losses above you or below you, whatever way you're going, and you are looking to make more money, right? This is why I swing trade. This is why I love it, because I can look at the overall bias of the market and keep hopefully a tighter stop loss and let it ride, let it just do its thing. Some people do monster trades. Now, some of these risk rewards are monstrous, right? Look at that. Imagine that on like a decent leverage, you've got a nice little position, and ultimately you can grow your account pretty big. It's quite a big factor, because all the data will be found on this sort of situation here, right? So when we're looking at all this sort of stuff, you can see it all. So for example here, if you were to put 1 BTC in randomly, I know, and you're going to put a 10% stop loss, and like obviously from that point you want to make some more money, obviously that in terms of risk reward isn't too bad. If they're both 25 and 25, it's the same amount. If you're willing to lose 10% and gain 25% in terms of that element, you're making $2,100 and you're going to lose $842 for every single time. 50, boom. 100, boom. So obviously going up to that level, risk reward wise, huge. So remember, this is the most important number. Always remember the risk side of it, right? The red number, the red element of it is 100% important. Always keep that the steady flow. That is how you use the risk reward tool. Now, when we start to delve into this a little bit more in a simplistic manner, when you remove the zeros, this is literally what you've got and what you're working with. Now, For me, I don't like to go too deep with this in terms of like, oopsie, I'm making a complete balls up of this. So when we're looking at this in terms of simplistic actions, a lot of people record their risk reward. I personally don't, right? I don't like, because it's a bit of a pain. I like to use a platform called EdgeSheet, which enables me to see how much I've made in terms of all that kind of stuff, in terms of monetary value. Percentage numbers matter, but in terms of risk reward, this is huge. You do not want to be, in my opinion, if you are looking for a trade that is a 1-to-1 or lower, it's kind of pointless. It's a poor setup, right? No matter what you're on. What that would indicate is you are basically risking the same amount for a 50-50 split, right? Obviously, you're never going to win every trade, but what you want to try and do, if you can have a big trade and you make 4 times the amount and you have a couple of bad trades in between, it's not bad, right? Because it allows you to make money, and this is always one constant fixture in your life, which makes sense. So yeah, when I do like spreadsheets and stuff, I don't do it manually. I use EdgeSheet, and it kind of records how I've done in terms of like risk as percentages of the account, which is good. Some people record these, which is fair enough if you want to. So let's just say if you've, whatever the risk reward of the account is, you add it up in terms of what you've got in terms of overall bias of the account in terms of profit or losses. But for me, it's too complicated for my brain. I like to just use EdgeSheet, which is a really good tool, which I will recommend in later videos too. So the one thing that is, in my opinion, pretty important, it can be a bit of a pain, which is why syncing things up to external software, which we'll talk about at the end of this section, will help you massively, scaling in and scaling out of position. Now, when we look at this, for obvious reasons, you can see like there's a big area here of interest, right, which could lead to a rejection. Now, the one thing that I always say is always wait for candle closures, but on the lower time frames, you're going to have more candle closures, especially versus the daily. So if we go down to say the 6-hour time frame, you may find that there might be more opportunity to ladder in this area with confluence of these shorter time frames with better confirmations a bit earlier. You can see here there's a massive amount of noise around this area. Now, you may well want to ladder in and get some potential positions as it's in the box, right? As it's trickling up and as you're seeing signs of weakness. If you are using confluences of indications and indicators, you can get pretty close to an area where you can have a pretty tight invalidation. So that's the whole point of it. It's dollar cost averaging into a box to enable you to get a much better order, because sometimes going all in here, for example, is great in certain stances if it goes and hits it and then turns around quickly. But what about if it doesn't? What about if it carries on going and it goes halfway up and then it continues to go down, right? So you've got to look at that factor. Now, in regards to it, it is quite, let's just say, contradictory, because I am saying wait for a candle closure, but at the same time you may well get cheeky little wicks like this, little cheeky wicks to the upside, which could mean opportunity to make a little bit more of a better order. Because with this example here, you can see very quickly how this has went down. You can also see it here with this wick here. Now this is where it's quite scary, because you are waiting for certain levels. Now you may, right, and this is going to sound daft as well, but hear me out. You may have already had an order in here for quite a while, right? You might have already looked at this area and thought, wow, we're in this area, tickled it, tickled it, tickled it, tickled it. Whoa, hello, gone for a big drink here. If you had orders plonked lower and utilizing the fact of this region here as a potential invalidation where you're not going to buy any more and you're going to have your stop loss just below that level where certain things are, you could have a really good dollar cost averaged entry into a trade, which is kind of what you want realistically, right? And that's the thing, it's like, it sounds really contradictory that saying, well, if your average order is here, and obviously looking up here, it's a 35% move, it's monstrous. And obviously if you're looking to the left here, you could probably argue that, yeah, you could probably have a really nice clean order and quite a tight stop loss in all fairness, where realistically you got a lot of wiggle room, and obviously you can go much lower, but realistically though, you're looking at certain structure points. It's crazy when you think about it. So instead of just trying to go all in on one, try and order a few little ones. So what you want to do is you want to split it up. You want to split up your order into 3 or maybe even 2 and put an order in here and an order halfway, because the order halfway will enable you to get more units at a better cost, and it will also move the order down a little bit. So for example here, if we just use an obvious kind of line here, when we look at this sort of situation, let me just make this thicker so you can kind of see. Now, it does sound a bit daft when you say it, but if you're going to put your order in here and you're in, cool, right? Obviously it wakes up. What about if it does wake up? Your average order will obviously go up, which is good, especially if you're going short. If you're going long, you obviously want it to go lower and as low as possible towards these lines. As a swing trader, you want to try and get as close or as far away from certain points in terms of your risk management. So you don't want to be too close to the point of your TP, for example, but you want to be far away from your TP as possible, but also not too far away from your invalidation, because then it's a pointless trade as well. So it's one of those, it's a bit of a mixed bag, but the importance of that is hugely important. The same for scaling out, right? So when we're looking at this move here, right, for example, random example. So this is a short move. You're looking to kind of look at potentially taking profit from obviously moving from this box into this box. Essentially, that is what you're looking to do, right? So creating an obvious kind of pattern here, which, yeah, let's just be honest here. It's, bear with me, where's my favourites bag on? There it is, hello. So what we're looking for is you're going from up into this box, and you're then looking to get into this box at some point. Scaling out into this box is a good thing, because the one thing that you don't want to do, and this is going to sound daft as well, even though you've made money, you will feel like, oh, bugger, because you may well take all your profit here at this $1,000 line or $1,073 line, right? Cool. What about if it just does this over a period of time? Yes, there's obviously opportunities to get in and out of a position, but you could leave an element running. You do not know. Obviously, that's a massive scale, that won't happen. But sometimes things go rocket boom. Let me show you an example here. If I just go back in time, let's look at some random candle structure, right? Actually, let's look at this. This move here is pretty good, right? And obviously you can see there, you've got a whole level where it's impulsed and it's pulled back. It's done. Okay, cool, right? Happy days. It's pulled back into a level. You may have a TP here of a breaker structure or above this level here where it's right where this level of structure, you're thinking, right, I'm out. Happy days, I'm out. Take my money, run. But it actually moves up a hell of a lot more than that region, right, up here. It moves another 17%. I'm not saying you're going to get another 17%, but if you took out 50% here, cool, happy days, right? But it's went up even higher. You could have had even more in a position. You could have taken out even higher, even towards this fib level. So you've got to look at that as a factor. So scaling in, scaling out, hugely important. Always keep something running just in case, because by the time you've taken some money off the table, you should have already moved your stop loss into break even, which is kind of hugely important. So there's another factor as well, a little tip there, a little alpha tip if you're interested. If you have like an order, and this is how I would do it, let's just say you get an order in around here somewhere, your invalidation is going to be, I don't know, I'm going to look, it depends on candle closure. So for imagine stake here, imagine your candle closures around here. Obviously you don't enter before a candle closure, but you're looking left here and you've got a lot of invalidations. We'll go above that 618 level, and you're looking for a level where it's going to be pretty decent risk reward, right? So if you're going to look at that as an entry and you get to this point here where your TP is roughly 1077, all you need to do is move your stop loss to break even. Now, the one thing that I always say, whenever you, at any point of this trade, whether you are looking to go to 2 to 1 or to 1 or whatever, when you move your stop loss to break even, where then you are absolutely risk free, always start scaling out. Take 10% off the table. That should be your point of being able to scale out of a position, because over the course of time you're going to make more money, right? Simple as that. You're going to make much more money, which is important, because you always want to have your account growing. So that element alone will enable you to keep growing, because there's nothing worse than being in a position, which is mad when you think about it, where you're making money and then all of a sudden it zips back towards your stop loss and it stops you out, and you had nothing to do, or essentially you've had no money to show for it, which kind of sucks. So if it moves far away, you need to be aware of that. So hopefully that helps. Now there's 2 points to this video. It's kind of obvious, stop losses are very important. There's 2 methods you can use. Higher leverage may mean not using a stop loss, but using the correct percentage of what you are willing to lose in your account i.e. what you are risking, this will be explained more in the understanding how leverage works, or the safest option, utilizing a stop loss, which is easy to work out. A stop loss allows you to pull yourself out the market effectively when trading. This is not a thing or a factor when you're investing. If you're using a stop loss when you're investing, it's a little bit odd because you can't technically. If you are, you're using an exchange to do so, and you got to be careful. Always utilize a cold wallet for crypto. Likewise, if you're investing in stocks, you're not really going to be fully at the races with a stop loss unless you're on a CFD platform, right? Which is not good. Don't want that. So a stop loss will pull you out of the market. So let's look at this, for example. Let's look at clear invalidation. So let's just say we are trying to get orders in much higher. Much higher. If we're coming into a certain range of interest where we may well fail, which might be the 618 level, we're looking for a potential area where we could fail, right? Up here could be a great place to kind of plonk that level. Obviously, the percentage doesn't really matter. It matters on how much you're risking. Remember that. So you can have a really big, wide, juicy sort of stop loss and not have a great trade. But this is a poor example of a trade you'll probably miss anyways, because why would you want to go in that much drawdown when you can have orders much higher? Get my picture? Good. So a stop loss can help you in two ways. That situation where there's a poor entry, a stop loss may help you. But when we're looking back in time, when we're looking at certain situations, we may well actually find that what if Ethereum here rejects at this point here? As I said before, right? You've got clear invalidation lines. So let's just say you're going to go around here. You got a clear invalidation line where this point is, right? More than happy to be like that. And let's just say going to go down to this level here for potential reward. What will happen if it shoots above and goes towards the 618 level? It will pull you out. But as I say, you don't want to be just plonking orders in before a candle close. You want to have some sort of certainty that you see in signs of weakness. So for example, with this picture here, boom, the next day, weakness, a very bearish candle. And then on the opening of that candle, you can start looking at potential entries and obviously get an entry here. Still got a decent risk reward, even if you're looking at this level here, right? And you get an entry level here, for example, you know, you've still got a clear invalidation where it could be going, and obviously a very, very horrible looking candle, which is kind of gone from that rejection point, and it is a level of resistance. So that majorly helps, and obviously you can see what's happening in terms of the return here. It did do something, but as you can see, not the greatest of reward. However, that being said, you've got this level here to keep an eye on. This is a clear and obvious level. You could have taken a little bit of profit there, but what could have actually happened now? You could have been holding this trade for ages. What about if it goes right the way back up towards your entry, which it nearly has? Kind of sucks, right? So you got to be somewhat careful with it. Now, with a stop loss, it will enable you to be wiped out of the position completely when your idea is now invalidated. That's the point of it, invalidation. So it's not that you're wrong, not that you're right, but the one thing that you do not do is this. Do not just be like, all right, cool, I'm going to set my stop loss here. Let's just say you entered a, I don't know, let's just say you good idea. You entered a short here, right? So for example, with this situation, you had an impulse, you had a pull back into the 382 and went like that. We went down. It's like, right, great, awesome. Now we've shot up to the upside. We've obviously got more to go with this situation, right? This could still fail around here. However, you don't know that. But your trade, right, what you've done, you put an invalidation above a certain point, and you can see your thing, just your candle going right into it. What people tend to do is do this, just let it just go up, go up, go up, it's fine, go up. And then all of a sudden you've lost all your money because you have deviated away from your plan. You have increased the risk on a trade by moving your stop loss away or removing it altogether. That is the worst thing you could do. Stick to your plan. So if your plan was on this trade was to use 618 level as a potential area of interest where you can get, see it do whatever, this could still go towards here and carry on melting and go down towards these levels here. Of course it can, easy, it's still lower high. It could well happen. Keyword could. But don't be preempting, it's alright, we'll just do this. It's stupid, don't do that. So I'm going to try and explain to you how to use leverage and the principles of it, because people do get confused and I understand that. Now, I want to make it really simple. The only thing you need to worry about is your position margin. That is how much you have put down for the monies that you are going to get with leverage, which will be put in the quantity and the value section over here. Entry price is your average weighted entry price, market price, and your liquidation. that is something you shouldn't have to worry about if you're using leverage properly. Obviously, your realised and unrealised profit. Very, very straightforward, right? It is. It looks daunting, but leverage is king if you know how to use it, right? Trust me. Honestly, if anyone tells you don't use leverage, well, they don't know what they're talking about. So, let's put it this way. You want to buy a long position on Solana and you want to be able to have a decent stop. Actually, no, we'll do short from this point here. And we're going to utilize $15 as an invalidation, right? Or maybe a little bit higher than that. This is how it works. So obviously you're looking at an order now. Let's just go last price. We'll use 100 Solana. Now, what 100 Solana is as cost is 444, and it actually works out because of the 3x leverage up here. $1,300 is what you get in terms of value proposition added on the leverage. If I do this and go to 10x, for example here, let me just do this as well, 10x on both, which is always good. You can see the value cost has changed massively, right? Because what you've done is you've actually changed the leverage as you've changed the number in the sum, right? So in that case, 1,000. So you can do 1,000 if you wanted to. It's up to you, obviously, what you want to do, but I'm only joking with that one. But as you can see, right, 500 is roughly $673 at risk. Obviously, if you change the leverage, it'll do it again. I've got $3,091 in my account. If I say, well, bear with me, 3,091, I want to lose roughly $92, which is 3% of my account. That's what I want to lose, kind of. I don't want to lose it, but you get the picture. Go to your stop loss situation, and what you want to do, you know that your stop loss is going to be $15, right? Which isn't too bad. Now, for some reason, this is not working and it's irritating me, and I don't know why. So it turns out that it's doing that as a random. Oh, hold on, is that right? Bear with me. I'm probably doing something stupid. Bear with me. Let me just see if I am doing anything. I'm not, by the looks of it. But for some reason, it's just doing that. Maybe it's just totally wrong at the minute, because that doesn't seem right. Or is it because I'm on 10x leverage? It may be because I'm on 10x leverage and that is actually a lot of money, which is probably the reason why. I'm probably just being a bit silly. But yeah, what you want to try and work out is going back from, I want $15 as a stop loss, but I don't want to lose more than $92. So then you need to rein it in massively, right? So again, if you go 15, right, you already know, oh, I can't do that trade. It's probably way too much. Okay, what can we do? We can reduce this. Let's try 250. Okay, it's now here. Oh, that's still quite high, realistically, when you think about it. Now, what can we do now? Oh, we can actually go even lower. 100. Oh, wow. So the value of that is looking much better, but it's still quite low. This is the biggest element to leverage trading. People want to make money, but actually what's actually happening is you can't really make money unless you got big money, unless you're risking high amounts. So roughly around $55, about $90 that'll do, is where your stop loss will be. You'll lose $91. You have at risk on this trade alone is a decent chunk, right? So roughly that is what the cost basis is. But obviously you're going to lose quite a bit of money because of the leverage. You will get liquidated on this trade, right? You need to lower your leverage. So if you go down to 3, cool. So again, that's what makes it work better. Now, if I then change this, let's go 55 again. There you go. So what the cost actually will be isn't too bad. Oops, I've probably cocked this up, bear with me. I'm a bit rusty. Go 55, boom. So there you go. You are risking $244 and you are going to lose $89 on that stop loss. Now, obviously, if you want to make, TP, we are looking to go short anyway. So let's just say go down to these lows here. We'll say $10, for example, just to give you an idea. You could be making $186 or $85 if it goes to that TP, which kind of makes sense, right? So that's what you need to do. You want to work backwards. Now, Ash, what is at risk here? This, your stop loss. Your $88 is what you are losing. Now, I could move this leverage to whatever the hell I want, providing it's not too high, and it'll be fine. You just have to adjust these numbers. Now, always stick to a simple sort of leverage pattern, and then always work back from your stop loss of what you're looking to lose, which is what I did then in a roundabout way, but I totally forgot about it because I'm a bit silly. Ignore me, it's been a long day. But you get the picture, right? You are not losing $732, which is what will appear over here. But oh my God, you're not. It's times by 3. You will lose if you get liquidated that, but you won't because you have a stop loss. If your stop loss hits, you'll lose 89. If it doesn't hit and it goes to $10, you'll make a $185 profit. This is why people rush trading. It's a timely process over a period of time. Now, that, in my opinion, isn't the best trade setup. If you're looking for a little bit more, you could make a bit more money. But that controls everything. 3% of whatever. Now, obviously, if your account keeps growing and you go to, say, $5,000, right? You could have $150 at risk. If you've got a $15,000 account, you could risk $450. It's all relative, right? You will not lose 25 trades in a row. If you do, there's something definitely wrong with you. But at the end of the day, you're only risking what this is. This is why I planted the seed very, very early in the previous videos about stop losses, about the amount of money that you're losing on a trade is all based on the risk reward. Keeping the percentages all the same, because this is what you need to worry about. Too many people go, oh, leverage, let's go to a 50x or whatever it is, right? Which you can see here, crazy, right? Look at this, boom. It's like, okay, you're going to risk $55 on that trade. Would you? Probably not, no. If you start adding the 5s, you'll start to see where things are going to go. It can get pretty crazy. You can see the amount of numbers, but you've actually risked a lot of money, but your stop loss will be very, 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 very tight. It'll be ridiculously tight. It's 0.5%, basically, give or take around that point, or a percentage mark on a lot of assets. Yeah, it looks great when you do that. You're thinking, oh, sweet. If it goes to $9 profit, I want to make $24,000. Yeah, lovely. But in that sense, you got a massive risk of getting stopped out. So be very careful. Another thing to worry about is cross leverage. Now, this is what I like to use as well, because this allows you to balance the account much easier. So if you go on to, you can use whatever leverage for this essentially, because what it's going to do, it's not going to stop you out. It's going to utilize your risk management. Now, this is where it gets dangerous, so be careful. Now, when you're using cross leverage, what it'll do is it'll use your equity balance, your available balance essentially, right? So let's just say 10x cross leverage. Let's just say we're going to put in 55 again, give or take, random number. Cool, right? The cost is the same. If we're going to go short, you know, it's a very, very different kind of ball game because of the amount. Because I've got so much in my account, sometimes I like absolute because I like to keep my numbers straight. If you're a bit more, I like my positions, I like my market structure, I like a bit of wiggle room, cross might be for you. But you've always got to remember, you still need a stop loss. A stop loss will majorly help you anyways, regardless. But when it kind of runs away with you, it could make you more multiples being on cross. Because when you start seeing, let me just put an extra 5 on here. There we go, a bit more realistic. You can kind of see what's potentially could be happening, obviously, in a cross. Now, if we go on to, say, a 3x cross, again, like what it was before, it'll be the same figures pretty much, right? Give or take, it'll be the same figures. Let me just move this back to where it was. You can see here, if I go down to 15, 15 stop loss, 92, and again, if we're looking at 9, it's still pretty much the same figures. But what you've noticed is this is a little bit higher. I believe it's a little bit higher. I don't know unless I made it up. It looks a little bit higher because what will happen is the cross leverage will get more and more interesting as, you know, as it goes across. It will probably increase the leverage as it goes because of the safety in numbers. But for me, I would rather use absolutes because it's much easier. It is way easier. And if I go to like 18 or whatever, you know, you can probably start noticing the leverage will start running away. So, in my opinion, use absolute, isolated, or whatever it's called. Absolute in some platforms, isolated in another. Use that, it's much better because what you've got is essentially the full amount going in, so you know exactly what is happening. So it makes life much easier. Always set them to 3, or, you know, I would never go above 10. Don't go above 10 because basically 10% move the wrong way goes against you, you could get liquidated. If you don't have a stop loss on and you've just been a bit negligent, you'll find a big problem. Anyways, all you'll lose is position margin, which is the position cost of what you're putting down. Don't worry about all the other values, trust me. So something that you need to be very well aware of is acting on your emotions based off other people's. Don't do it. So ignore the noise. Signal groups, YouTube videos, Twitter setups, stuff you see in Telegram, Discord. Be very careful because you're going to start seeing noise, and the noise is going to hurt. And you can probably see here already like a lot of the kind of fear and greed and the elements of negative bias to try and get you in, or even positive bias to get you in as well, whether that is a long or a short position. You need to do your own analysis. This is how traders become good traders, because they block out the noise. I've always believed that trading tuition to show you how to do trading is much better than actually copying. We do an earn while you learn with premium, which is basically a transparent element to show that you can grow an account by doing whatever. It does help you in certain ways, and it's a bit crazy when you think about it, because you need to have a little bit of a community element to learn. But if you are literally copying someone's idea, there's a real big problem. Why is it a problem? Because everyone has a different time frame, different span, bias, utility of use with indicators, seeing different things. There's 1,000 ways to skin a cat. There really is, right? So avoid that. Another thing to avoid is obviously signal groups. Don't pay into these, because when you start getting people just distributing buy here, stop loss here and take profit there, you're going to start thinking, well, this is quite lazy. Yeah, some will do okay, but some won't, right? And when you start losing, it's horrible. Now, the one thing that I will say with these, what these groups do, they get you in a group. They get you into a referral link, probably a really knockoff crappy exchange, and or a forex broker as well. So they can make even more money on you. So there may well be a subscription in line with these to get signals, more signals, quicker signals, whatever. Pay monthly for them. There's some of them are ridiculously priced at $200, $300 plus per month, and then you got to join their little exchange or whatever. And whenever they things go up or down, you'll get paid, and they'll get paid. Sorry, not you, or for obvious reasons, right? It's pretty crazy. So you can see quite a few different random ones. These are just random ones here, as you can see, premium channel. So don't do them. The reason being, you don't learn. You don't learn at all, and you probably will find an exchange on here at some point. Oh, there we go. Registered and trading on MXC. It's not a great exchange, boys and girls, I'll be honest with you. So with that in mind, you need to be careful. For obvious reasons, when you start putting in crypto trading on here, you'll start learning that all these videos will, they will create a little element of FOMO, which is quite scary. So please, guys, be careful, because there's no point doing this course if you're not going to do it yourself. You will become a much better investor, a much better trader if you are doing your own thing, because you have control. You are able to physically do it yourself. Now hold your horses. We're going to talk about paper trading, right? Because it's a fundamental flaw you will have if you are doing this on paper and you are not using real market simulation. You can easily go, I'll buy it there and I'll sell it there. It looks easy, right? But you're going to be kidding yourself. There's two options you've got. Option number one is go into TradingView and go down to trading panel and then connect a paper trading account, put some money in and utilize the buy and sell signals that will come up here, or there'll be like order books up here as well. Because obviously you can utilize any of these brokers if you so wish to, which we will go into in the next section of this course regarding what the difference is between obviously crypto brokers, FX brokers, and obviously stock brokers. But it's all the same in terms of paper trading, right? So that's that. The other option, and the one that I recommend the most, especially in crypto, is trade with a little bit of money, a little bit. So instead of putting in, say, $1,000, maybe start off with $50, for example, right? Learn the process of stop losses, learn the process of limit orders, market execution orders, etc. on a real life simulation. Why real life simulation, you say? It's a blockchain in certain cases, it's an order book in certain cases, it's liquidity and spread in other cases, right? Every exchange, every type of asset will have different perks. If you're in crypto, you'll find that sometimes you may not get the orders filled because of the slowness of like what's happening around the entire market, right? It just happens. In the FX world, you may have large spreads, and they're unrealistic spreads because there's not much volatility or liquidity in the market at that current time of which you're trading. And the same with the stock market. It might be closed. right? So you got to remember that too. So all those kind of factors you got to kind of put into kind of one element, and it's all about practice, right? Highly recommended you do it, really do. So this goes for backtesting a strategy. This goes for certain environments that you may not want to trade in, but you want to give it a go, or you're trying a brand new methodology, right? As I say with backtesting, you can backtest anything, and you will find it probably will work in the most instances. However, it's all about the future trading, forward testing essentially is what we call it, is because you want to make sure that it does actually work on a real live market. So when you press connect on here, it'll just basically, simulate some money here, random monies, hello, and all you're going to be doing is, you can press certain things. I think I've got mine knocked off in terms of like in terms of buying. If you go into your settings here, I think it's on trading, there we go. So you got buy and sell buttons you can add on, instantly add orders if you so wish to, executions, position, appearances, all kinds of stuff, right? So when I then click on obviously sell, it'll come up with all the stuff, and this is my paper trading account essentially. Happy days. It's relatively straightforward in terms of how to use it. It's pretty traditional, but it gives you an idea that you can actually do that very, very easily, very, very quickly, and yeah, you don't have to fork out money. However, what I will say, keep it simple. I would always recommend just keeping it simple, no rush, because the hair and the tortoise is a massive thing. You will make money if you're good, but you need to become experienced. Practice makes perfect, as they say. So congratulations, you've maybe, I don't know if you're watching this, if you've reached it, hello, welcome to the ending. This is the end of the course. There is going to be a psychological course as well. There'll probably be a link or something floating around my head at some point in life to kind of point you to that direction. So yeah, if you enjoyed this, leave a thanks, subscribe to the channel, and yeah, we'll see you very, very soon.